Good morning. It is 9 a.m. on Tuesday, March 1st. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sozzi. Let's take a look at what's going on in futures this morning after what has been a volatile period. That volatility continuing, but we are seeing a little bit of weakness this morning. It's not as weak as we have seen in recent days, although we had that late day comeback yesterday, and the Nasdaq off by 1/3 of 1% right now. S&P futures down 1/5 of 1%. Dow futures down almost 1/3 of 1%. All of this, life during wartime, I guess. A host of global companies work to reduce their exposure to Russia. We've got details, and next hour we'll discuss the potential hit to the Russian economy. Among those companies, by the way, European oil giants BP and Shell. Coming up, we'll speak to the chief financial officer of Chevron about that U.S. oil majors exposure. Plus, Target comparable sales fell short of forecasts last quarter, but its full-year forecast seemed to reassure investors. Those shares up by nearly 14%. We're going to have Brian Sozzi's conversation with CFO Michael Fidelki. But first this morning, we have to get the latest developments of what is going on between Russia and Ukraine. Reports of increased attacks on the part of Russia. Our Jennifer Schomburger is here to give us the very latest. Good morning, Jen.
Good morning, Julie. Ukraine's capital bracing for an all-out assault as Russia escalates its invasion with a massive convoy of Russian ground troops making their way towards Kiev right now. At the same time, Russian forces struck the central square of the Ukrainian city of Kharkiv, an act Ukraine Zelensky called a terror against the city. Russia's renewed aggression comes after a first round of talks between Russian and Ukrainian officials ended Monday without a ceasefire agreement, but with a decision to meet again in coming days. Russia's financial markets remain largely closed for a second day as Russia's central bank has put in place a trading ban to try to limit the damage of tough new Western sanctions. But Russia's central bank has acknowledged that Western sanctions are stopping its ability to intervene and stem the Russian ruble from collapsing. The Kremlin spokesperson Dmitry Peskov said during a press call Monday, according to reports, that, quote, the economic reality has considerably changed. The U.S. and its allies have moved to stop Russia's central bank from using foreign reserves to support its currency. The Bank of Russia on Monday more than doubled interest rates to 20% to try to halt the plunge in the ruble, which still cratered some 30%. Western allies also cut a group of Russia's banks out of the SWIFT system. That's, of course, that crucial global payments messaging network. Now, President Biden is set to give his first State of the Union address tonight at 9 p.m., where he will address the latest on the Russia-Ukraine situation. So a very fluid situation. Julie?
Yes, indeed. Thanks so much, Jen. Appreciate it. And we also have been monitoring the many companies globally that have been reducing their exposure, examining how to reduce their exposure, eliminating their exposure to Russia. There are a lot of different permutations of this, and we've been trying to piece through them this morning. Within the energy space, of course, we know BP has said it is going to get rid of its Russian oil holdings. Shell has said the same. It's unclear exactly how. Total, by the way, says it is not going to put new money to work. So there's all kinds of different ranges of what various companies are doing here. It's unclear because there are reports that the Russian government is saying it is not going to allow these types of divestments. So it's unclear, even if the intention is there, execution-wise, how it is going to happen. Who would then buy these assets if companies are going to offload them? So a lot of questions around that. We've had a number of automakers and other types of companies. MasterCard, for example, has said effectively what MasterCard's announcement entails is that it is complying with sanctions and not allowing certain types of transactions to go through. A lot of the automakers that have production operations have been pausing them. In some cases, again, you know, Saz, there's sort of a mix here between companies that are aiming to get rid of operations, those that are idling operations, in some cases just because it is difficult to get business done on the ground at this point, or to get supplies, for example. Then you have some of the entertainment companies. Also, Disney said it's not going to be releasing new movies. So there's just a lot of different flavors of this that we are examining.
And this is how an economy implodes, Julie. Big multinational companies essentially leaving Russia here, one after another. Another company we can add to the list is computing giant HP. CEO Enrique Laura is telling me in a conversation that he and his company have halted shipments to Russia. Take a listen.
It is a very difficult situation, and the most important thing for us is really the humanitarian side. We have been in daily contact with our employees there and doing anything we can to protect them, to help them to go through this situation. At the same time, of course, we are following the regulations and the sanctions from the US. We have stopped all our shipments to Russia, and we really hope that peace will be restored as soon as possible to the region.
So let me get that. You have stopped shipments to Russia.
We have stopped shipments to Russia, correct.
And Julie, just like we saw with BP earlier in the week with their divesting that nearly 20% stake in Rosneft, it's coming at a cost. So BP is seeing a $25 billion charge to get rid of those assets or exit Russia. It's also coming at a cost for a company like HP. Laura is telling me that it's going to be about a 3-cent profit hit as it pulls those shipments out of Russia, or just stops those shipments to Russia, I should say.
Well, in the case of the BP, there's still some uncertainty surrounding it, right? Because it's as much as $25 billion, but how is it actually going to offload that stake? It talked about selling it back to Rosneft. But is the Russian government even going to allow that transaction to go through? So there are a lot of questions about this. And I think we should make the point as well, as we talk about the hit to the Russian economy and what the Russian people and Vladimir Putin are willing to withstand here. One of the overarching themes that we've talked about is that this response is probably unexpected on the part of Putin. He didn't expect this level of sanctions. He didn't expect this level of Western companies saying they were going to pause or restrict operations in Russia. Didn't expect the level of Ukrainian military response. So, it's very interesting. We'll see if that remains and what the response on the part of Russia now is going to be. That still remains, I think, one of the big unknowns.
Also, the big unknown, Julie, is when will these companies go back into Russia? I didn't hear Laura's tell me anything about, hey, Russia needs to do this, so we will start shipments again. And we're not hearing these companies offer up any guidance on what they want to see here, which is suggesting that this situation, at least from corporate America, they're planning for potentially not to do business in the country for, who knows, 6 months, a year. It's unclear when these things will start to be reversed.
Well, the longer this goes on, the more the markets maybe get used to it, right? Let's bring in Lizanne Saunders, Chief Investment Strategist at Charles Schwab. And this is something that tends to happen, right? Even something as dramatic, Lizanne, and she's joining us on the phone, even something as dramatic as a war, the market adjusts, especially the longer it goes on. Where are we in that adjustment period here? And what do you think that the market is pricing in?
Well, so adjust, yes and no. I think there are some aspects to this crisis that are a bit unique, not least being that the feeders through the energy channel potentially exacerbating an already difficult inflation environment, and in turn, maybe changing the thinking around the Fed, plus the potential for, liquidity issues cropping back up again. So, yes, we can look back at prior, initiations of a military event and find that they have generally had a short-lived impact on the market, unless, of course, they turn into something more protracted that has global economic implications, or in this case, inflation implications. So I'd be really careful about dismissing this as just yet another event that has a short-lived impact on the market.
Lizanne, have you just found it surprising we haven't seen that really big drop in the market? We've seen recoveries intraday. It's been some of these closes have been, I think, stoking some optimism out there. We have oil over $100 a barrel. We have the Fed still likely to raise rates in a couple of weeks. There's a lot here coming at the market very quickly.
There is. However, the market was in a downtrend prior to Russia invading Ukraine. I think we have to remember that. So if you even just last year, which was obviously well before the invasion, The average maximum drawdown within the S&P was 19% last year. Within the Nasdaq, it was 43% last year. You already had the average maximum drawdown for the Nasdaq and Russell 2000 down more than 20% year to date before Russia invaded. So the weakness was there. The initial reaction was to see that momentum exacerbate on the downside. But I think there's so much short-term money in the market, algo-driven, quant-driven, that might key off, technically oversold conditions kicking in, sentiment reversed really quickly into bearish territory as a contrarian indicator that might have provided some support. So I think this notion that the market's been, fully resilient through this suggests that you're not focused as much on what the weakness came into play prior to the invasion. I think just there's been some bottom fishing that is happening given the weakness that preceded the invasion.
Liz Ann, one of the moves that's been pretty remarkable is the weakness preceding the invasion had at least partly to do with the expectation of the Fed raising rates. I'm looking at a 10-year this morning that has made an incredible move downward in yield, and that's happened all across the yield curve here. Do you buy that? In other words, do you think that indeed the Fed is going to be much less hawkish here because of what's going on in Russia, Ukraine?
Well, I'm not sure if that's solely the message coming from the move down from 205 to 178 on the 10-year. I think given what's going on in Russia, Ukraine, especially with the weaponization of money that the Western world has decided to at least initially combat that with, I think that has led to a flight to safety into havens, inclusive of treasuries. So I think a lot of that buying just is because of the uncertainty with regard to Russia, less so about a message with regard to Fed policy. That said, first of all, it's 2 weeks between now and the Fed meeting, which these days is a lifetime, both in terms of the news coming out of Russia, Ukraine, but also the fact that we've got another jobs report, we've got another CPI report. Yes, you are seeing movement around in terms of number of rate hikes expected. We were never in that 6 or 7 camp, felt that it would probably be lower than that. Simply because the Fed also plans to pull the lever of the balance sheet. But I think with any potential liquidity issues, that's to be more in focus between now and the next Fed meeting to see whether there's impetus to pause altogether and not, launch off the zero bound. I'm not sure that's yet the best bet, but again, 2 weeks is a lot of time in terms of the implications for the Fed, and it's certainly possible that they hold off on raising rates, even if that's not yet built into market expectations.
If one is looking at their portfolio right now, Liz Ann, what adjustments should they be making? Should they be raising cash? Should they be tilted more to defensive names? How do you think about it?
So first of all, the whole notion of raising cash to say, go to cash, who's the investor? What's the risk tolerance? What's the time horizon? What are the income needs? What does the rest of the portfolio look like? What we have been emphasizing is that we're in the midst of all of this volatility in the market and intraday massive swings and sector rotations that are coming fast and furiously. The one area of consistent leadership has been quality, high quality, value, lowercase v. I'm not saying the value indexes are consistently doing better, but the factors associated with value, strong free cash flow yield, dividend yield, positive earnings revisions, strong balance sheet, low debt, pricing power. Those factors have been consistent leadership areas, even within sectors like the growth trio, tech, consumer, discretionary, communication services that have had some real downside moves that sort of value high quality, even within those growthier segments. So that to me is what investors ought to focus on. And then the other recommendation we've made is maybe up the pace of the frequency of rebalancing. If you're a calendar-based rebalancer, meaning you do it maybe quarter end or year end, let the swings in your portfolio dictate when you should be maybe adding into weakness and trimming into strength, and stay in gear that way without trying to forecast what the next 3 to 5% move is going to be up or down.
Love it. Actionable ideas for investors, Lizanne. And you've been consistent on that value message as well. Lizanne Saunders, great to talk to you as always. Chief Investment Strategist at Charles Schwab. Appreciate it. Before we go to break, just wanted to check in on shares of Target, which of course was out with numbers this morning. Earnings per share coming in ahead of estimate last quarter. Comparable sales missing estimates, even though they were up 8.9%. But it seems like the forecast for the full year operating profit that will post a percentage gain, when some analysts on Wall Street had been looking for a decline, that really seems to be putting some wind in Target sales this morning. We're going to dig into it more deeply around the opening bell. And coming up next, we are going to be speaking to the CFO of Chevron on the day of the company's investor presentation, in which it announced a sizable share buyback authorization. That's next.
Chevron shares are in focus as the oil giant holds an investor day in New York City. Ahead of its meetings with the street, the company lifted its annual stock buyback guidance to a range of $5 billion to $10 billion. Prior guidance called for $3 billion to $5 billion. Also disclosed a $3 billion purchase of biodiesel maker Renewable Energy Group. Joining us now is Chevron CFO Pierre Breber down at the New York Stock Exchange. Pierre, nice to see you here this morning. To say the very least, there is a lot going on in the oil markets. We're seeing a lot of calls on Wall Street for oil going to $120 a barrel to $150 a barrel because of what's going on between Russia and Ukraine. Help us understand how high is high in the oil market.
Well, thanks for having me. You know, markets are always volatile. Undoubtedly, there's geopolitics that are raising the prices now. We want the war in Russia and Ukraine to end as soon as possible. But this was started well before the Russia-Ukraine crisis. We've seen demand recovering very strongly as the world economies open up, and supply is responding, but supply is lagging. So we're seeing an upcycle now, but we expect prices to moderate over time.
Pierre, I want to dive right in and ask you directly about the Russia-Ukraine situation. It's my understanding that most of your exposure in the region is from actually oil fields in Kazakhstan and then there's a pipeline that heads through Russia to the Black Sea. Talk to me about that exposure, how you were thinking about it right now, and whether, even if you wanted to, there would be a way for you to work around that holding.
We don't have any production in Russia, unlike some of our other peers, but you're right, we have a big operation in Kazakhstan with other international partners, and the transit route out of Kazakhstan is in part through Russia. That's really world infrastructure. It's really infrastructure that's necessary, just like natural gas is continuing to be piped into Europe. It's important for those barrels to flow, and our operations are continuing unimpacted.
And so, pardon me, just to be clear then, there's no plan to shut down that pipeline, for example, or find, I mean, looking at a map, it's difficult to see another way to get the oil from Kazakhstan to some kind of seaway. But just to be clear here, there are no plans to change that.
Again, the pipeline is operating right now. It's the primary route for Kazakhstan crude to get to world markets, and the world needs the barrels, and the energy's flowing just like other energy flows are continuing.
To that end, Pierre, the demand continues to be strong, like you mentioned earlier on, but you did hold your CapEx guidance, I believe, for this year pretty steady. Why not increase that, just given how prices and demand are right now?
Our capital is up 30% versus last year. It's within the guidance that we've given. So we have a significant increase of capital, both in this country and around the world. And we're growing our production. Our traditional production is going to be up 2 to 5% this year when you exclude some international contracts that are expiring. And we're investing in new energy, so we can really do it all. We can invest in traditional oil and gas. We can invest in new energies like our major acquisition we announced yesterday. We can grow the dividend, and we can buy back shares. And so we're doing it all.
Take us through that acquisition that you did make yesterday, a biodiesel maker here. How does it fit into your operations and your longer term plans?
Well, last fall we laid out an energy transition strategy, and as part of that we set a target to have 100,000 barrels a day of renewable fuels. And so in combination with REG and the activities that we have ongoing, and we also announced a joint venture with Bunge, we're building up that business. And so that's going to be a big business that's going to help meet customers' demand for lower carbon fuels. So like for airlines, for trucking companies, for other uses that replace diesel with a lower carbon alternative. Now we'll sell a lot of traditional diesel also, but there's customer demand for this, and so we're growing it, and we're really excited by the REG acquisition and working with them to really have a premier renewable fuels offering for customers.
So Pierre, as you look at the balance of fuel sources going forward, because I know you guys are targeting 10% growth in your shale operations this year as well. So it's not like, it seems like you're growing everything. It's not as though you're cutting back on traditional fossil fuels, right? As you also ramp up. It's an and rather than an or strategy, it seems to me. What does the appropriate mix look like 5 years from now, 10 years from now, for example?
Well, again, we laid out 2030 targets as part of our energy transition, but you're right, we intend to do both. We have a traditional energy growth, I said 2 to 5% this year, but it's really 3% compounded over the next 5 years, and the world needs this energy, and so we're going to provide that. At the same time, the world wants lower carbon energy, and we're growing that. It's from a smaller base, but it's growing faster, and we can do that with an efficient capital program, growing the dividend. We increased it 6% earlier this year. It's up almost 20% since COVID, and as you said, the increase in the buyback, 5 to 10 billion. So we really can do it all. We're a much better company than we were even pre-COVID, both in terms of our ability to generate free cash flow. We had record free cash flow last year, could be even higher this year, and invest in new energies like the acquisition we just announced yesterday.
Here, we had the Goldman Sachs team on, and they were talking a good bit how the market is still undersupplied given where demand is. And I believe they called out potential for a super spike in oil prices. Is that something you see in the cards here at any point this year?
So I've been in the business 32 years, and our commodity has cycle, that's the nature of it. And we saw the reverse when COVID hit and the world shut down. Demand moves a lot faster than supply, and that's why you saw prices go as low as they were and famously negative one day. And now we're seeing the reverse. We're seeing demand recover much faster. Supply is catching up, but there's a lag in terms of the investment cycle. So again, we're doing our part. Our capital's up 30%. We're growing our production, and I think over time you'll see supply respond and markets will rebalance.
All right, we'll leave it there. Chevron CFO Pierre Breber, good to see you. Good luck at your Investor Day. We'll talk to you soon.
Thanks for having me.
All right, coming up, Target is out with better than expected earnings, but a softish outlook for the first quarter. Nonetheless, Target shares are up about a little more than 13% here in the pre-market. We'll dive into the numbers next.
We're watching earnings this morning in addition to all of the Ukraine and Russia related moves in the market, and Target beat estimates. Adjusted earnings per share coming in well ahead of what analysts had been predicting. Revenue pretty much in line with estimates. The comparable sales number was weaker than estimated, up 8.9% versus the 10.4% that was estimated there. And Brian says it's interesting that the stock is not reacting negatively to that comp myth, but is rather seemingly investors focusing on the outlook for the year, particularly some reassurance on operating profit and margins.
Julie, is earnings season ever going to end? It feels like we've been reporting fourth quarter earnings for 3 months. It's almost the first quarter time. It's just, it won't stop. No, but Target, look, I would say the quality of this quarter was a little red flaggish. I understand the market likes to see the big earnings beat. That's what stocks tend to trade. Companies come out, beat big on earnings, stock price goes up. That's what historically happens here. But let's keep in mind here, Target did come out and warned that the first quarter operating margins are going to be, quote, well below what they produced last year. Now, I talked to Target CFO Michael Fidelki. We'll run that interview a little bit later. But again, I think he did highlight perhaps a little inflationary pressure in the first quarter, perhaps a little caution in how consumers are spending, given everything going on in the world. So there's that. But to your point, I think the market is ultimately trading on the earnings beat. And I'm just looking at the story we have on it on Yahoo Finance on the homepage right now. Their longer-term outlook. They provide a very upbeat longer-term outlook, looking for a high single-digit percentage EPS growth rate. That was a lot better than the street was looking for. But my calculations, the street was only looking for about 8% earnings growth from Target, looking out over the next 3 years.
Yeah, and it'll be very interesting with this surge in commodities prices that we have gotten as a result of Russia's invasion of Ukraine and the economic sanctions, whether we will see companies start to adjust their forecasts even further related to inflation. Will it be a temporary spike in those commodities? It's tough to tell. There you've got the opening bell on this Tuesday morning. Chevron ringing the opening bell at the NYSE. We were just talking to the CFO, Pierre Breber, over there. And obviously, that's one of the companies that's affected by this spike in commodities, although in its case, more of a positive effect rather than a pressure on margins. So that's something that also is interesting to note. Energy stocks, by the way, the best performers by far thus far this year within the markets that have been otherwise pretty volatile, but energy stocks have held up relatively well along with oil prices. We've got stocks opening up lower here. The Dow in particular is off by 0.5%, leading some of the early declines. One of the other things that's really been catching my eye is something that's been catching a bid, and that's treasuries. Liz Ann Saunders of Charles Schwab telling us just a few moments ago, it has to do with people looking for what they perceive as safety in these markets, and Treasury is traditionally one of those places. So you've got yields coming lower as people buy those Treasuries and send prices higher. So that's a phenomenon we're going to continue to see. One would imagine that we're going to see more volatility in Treasuries as well, particularly with Jay Powell testifying before Congress tomorrow, the Fed chair, of course, and then the Fed meeting coming up in just a couple of weeks. But let's move on with our never-ending earnings train, shall we, Brian Sazzi?
It just won't stop. Make it stop.
Let's talk about Kohl's, the next one on our list here. Kind of a similar theme, though, to Target, which was interesting here. Weaker sales in the fiscal fourth quarter, but the company coming out with perhaps a better than expected forecast. So those sales, again, kind of in line here. Earnings per share beating estimates. Full year earnings per share going to be $7 to $7.50. That is better than estimated, Saz.
Well, you're my bud, but I have to push back here. This quarter put up by Kohl's does not resemble anything like what Target put up. I mean, Kohl's earnings per share down 1%, sales up 5.8%. This quarter was markedly just underwhelming compared to what Macy's put up about a week ago. Certainly very, very underwhelming compared to what Target put up here today with their comparable sales up 8.9%. Why the stock is moving higher here in the pre-market. Kohl's coming out saying they're going to buy back $1 billion in the stock. Again, teasing a key investor day on March 7th, where I'm sure that team over there put together a 150-page slide deck on trying to fight off activist pressures. And speaking of activists, I briefly texted with Jonathan Duskin. He's the activist pushing for change here at Kohl's. He took issue, I think, with the buyback from the company, saying they're essentially spending his money to go out there and buy back a stock, which is an interesting hot take, I think, on this quarter. But again, March 7th is the real day for this company. That is time. That is when Kohl's has to put up here some form of credible long-term turnaround plan, or Duskin, who has nominated basically a whole new slate for the board, he can win this battle.
Saz, it's not me saying this stuff. It's the stocks saying this stuff. It's people are buying it. I should also mention, I'm seeing some comments now from Michelle Gass, the CEO, that the company is engaged with unsolicited bidders. Doesn't hurt a stock price when you have a comment like that either, I think, No,
but here's a company that really, Julie, I think they've tried to do everything in their power not to be taken private, not to be split up. They just do not want, I would say, to maximize value. So, I think Duskin and his activist campaign makes a lot of sense, and it's definitely far from over.
Definitely is. Let's talk about Zoom for just a moment here. That company's forecast is short of estimates. Sales going to be about $1.07 billion in the current quarter. Analysts had been looking for $1.1 billion. This is even after the company's numbers last quarter beat estimates. Something else that is important for Zoom here, the company is changing how it reports something to investors. Before, it told investors every quarter the number of customers that have more than 10 employees. So, how many large customers had they signed up? Now, the company is going to report the number of quote unquote enterprise customers. It's customers that buy through the direct sales team or through one of its partners. So it's not about size anymore. It's about, I guess, how that customer comes in, which is kind of interesting. I guess this is as the company gets bigger and evolves. Maybe, I don't know. I wasn't quite sure what to make of that change, but it seems like an important one.
Here's another company changing the numbers it discloses to highlight the numbers that are going well for them. Enterprise business is essentially the fastest growing business for Zoom right now. That those smaller accounts, that is no longer growing. Those accounts powered the company throughout the pandemic. Now it's slowing down. And I do think while you're not seeing a bigger reaction or pop higher in Zoom shares, they were talking a lot about in the earnings call last night, Julie, their enterprise business is expected to grow about 20% year over year in terms of sales for this year. That is a little bit of a slowdown to what they saw this year. And that consumer part of the business, or the everyday Joes, such as myself here, that might use Zoom for various calls, that is expected to be flat in terms of sales this year. So I think the market does not like to hear that as well.
And one final note, the company introduced a $1 billion stock repurchase program and also appointed the CEO of ServiceNow, Bill McDermott, to its board.
End of the show.
It's an interesting move there, and perhaps one to watch going forward, right? That both you and I kind of sat up and took notice at that announcement last night.
Yeah, no. McDermott has been on with us a lot. I call him Big Deal Bill. He has a lot of experience in getting large deals done in many years, acquiring very large companies when he was the CEO of SAP. And I think this is Zoom sending a signal that it needs to do a big deal. Something may eventually be coming, and they need a guy like Bill McDermott on the board to help them navigate any process.
Does he know that you call him Big Deal Bill? Or did you
he's
just
going to after I send him this clip.
Call him?
After I send him this, he will know. So I'll report back tomorrow.
Perfect. All right. Before we go to break, there's just one more mover I just wanted to mention, and that is Lucid, the automaker, cutting its production target for this year. It now expects to make 12,000 to 14,000 cars. The goal before was 20,000 cars. And it is saying this is because of, quote unquote, extraordinary challenges with its logistics and supply chain. Remember, this is a luxury electric vehicle startup. And its goal for deliveries was not met last year either. So this is something the market is definitely not liking today. And we're seeing those shares tumble in today's session. All right, we're going to take a quick break. When we come back, we are going to check in with our Jared Blickery on the floor of the New York Stock Exchange about everything going on today and putting pressure on the market. We'll be right back.
Let's head down to the New York Stock Exchange and check in with Yahoo Finance's Jared Blickery. Jared, Chevron ringing that opening bell down there. Any oil barrels, real life oil barrels down there? Any photos?
Yeah, I hit an oil slick, but I recovered my balance. Nice interview with the Chevron CEO there. I'm looking at the Wi-Fi Interactive. Not a whole lot going on in the indices. Pretty quiet day so far. But I want to get to the bond market just real quick because we're seeing another huge drop in the yield curve. And you can see that in the 5-year, the 10-year, the 30-year. That's after dropping a huge amount yesterday. You can see the 5-year down 8 basis points. Julie was noting this earlier. We were back in a territory we haven't seen in about a month, 3 or 4 weeks ago. So going to be tracking that. That is not good news for the financial stocks. And in fact, that is the only sector, or one of the sectors in the red. It is down over 1%, almost 1.5%. So really taking it on the chin there, but not any big outsized losses in the other sectors. Now, also looking at energy. Crude oil, WTI holding above $100 a barrel, up another 5 or 6%. Energy up 2%, followed by utilities, real estate staples. That's a defensive setup. And going back to the S&P 500, still hasn't been able to clear resistance over the last few days. So we'll have to see what comes of this. But all in all, kind of in no man's land here for the S&P 500, especially given the range. You can see on this year-to-date chart, just haven't been able to punch through 4,400 here, 4,500, really the big level. So got to see if any short sellers are attracted if we manage to punch up into that range, guys.
Hey, Jared, I know that you've been looking into sort of some maybe misperceptions that are reflected in the market right now. Based on a note out from Goldman's Dominic Wilson, where are those misperceptions?
That's right, and this is also somewhat contrary to a note from Dr. Marko Kolanovic over at JP Morgan. So I'll highlight, and I think it just speaks as to the fact that Wall Street really has some very strong differing opinions about the market, and that means that those opinions could be worked out in a very volatile fashion. But let's go to the Wi-Fi Interactive. I have a couple of notes here from that Goldman Sachs Dominic Wilson note saying, we think the market might be underestimating the risk of tighter supply and oil pricing. We were just talking about WTI, which remains a key risk from the ongoing conflict. So we think that the risk premium that's embedded in WTI, crude or Brent, here should probably be larger, arguing for higher oil prices. And indeed, that's what we're seeing this morning. Also, the second thing, we think the market is starting to overestimate the impact that the conflict will have on Fed trajectory. And so think that the front end rates are ultimately likely to reverse this recent rally. Now, when we talk about the rally, we're talking about the rally in bonds, not the yield. The yields have been crashing. So I think they're arguing that we're probably overdone to the downside on this crash in yields over the last few days, going to be revised to the upside. I've been talking for a month now. Are we at peak Fed? I've been asking that question. We might have passed that point and actually swung the pendulum to the opposite side where people are underpricing the risk of the Fed in the market right now. So really interesting to see that. Also, JP Morgan, Kolanovic saying that the worst might be behind us on the sell-off. You got to listen when Kolanovic gets bullish on the market. I would hasten to say that January 10th, he also got bullish. Didn't work out as well, guys.
Jared, watch out for those oil slicks down there. You got to be safe, brother. Jared Blickery, I'll check back with you later. All right, Bitcoin prices are on the move as the benchmark crypto has climbed above $40,000. Yahoo Finance crypto reporter David Hollerith is here with analysis on the market action. David, so my day started. I got onto the Yahoo Finance platform, so our Bitcoin price is at about 43,000. I'm now on the platform. Bitcoin price is up close to 13%, over 44,000. The ticker is the top ticker on our platform. What's going on here?
Ryan, Julie, so the lesson of 2022 is that Bitcoin and other cryptocurrencies follow risk on assets. So they move, typically, we've seen an increasing amount in correlation with, something like the S&P 500 or the Nasdaq composite. So we've been thinking of, a lot of analysts have been thinking of cryptocurrencies as sort of your risk on technology stock. Now, in the last day or so, we've seen 24-hour trading that is pretty much broken that narrative. And so what people have called this, who pay attention to Bitcoin, they call it a decoupling. So we've seen a higher and higher correlation of Bitcoin and other cryptocurrencies with risk on assets, especially last week, where the correlation between Bitcoin, the S&P, and the Nasdaq at different times during the week, they both hit all-time highs. Now, as of yesterday, the correlation is dropping. It's still a short-term trend, but what this is telling us is that the market of buyers for Bitcoin right now is changing. Now, the obvious thing that everybody's sort of pointing to and looking to is the crisis that's happening in Ukraine, and also the Russian sanctions that are being placed by NATO allies. So it's really difficult to tell what exactly that means in terms of, we're seeing data for more buyer demand in those markets. But from what I've heard from analysts, it sounds like there's much smaller buyer demand that's happening across the world right now. And I think more than the specific crisis or sanctions evasions or something like that, it's speaking to sort of this narrative that's still, while very uncertain, it's sort of showing that Bitcoin and cryptocurrencies are being looked to, at least in the short term, as sort of a hedge again.
Bitcoin bulls back out in force. David Hollerith, thanks so much. All right, coming up, I talked at length with Target CFO Michael Fidelki about the company's quarter and outlook, both of which are sending shares up pretty significantly here in the early going. We'll be right back with that conversation. Target is out with better than expected earnings as consumers shopped, and shopped some more during the holidays. The company is warning on margins for the first quarter. Talk with Target CFO Michael Fidelki about the quarter and the road ahead.
So when you look at the quarter, our 9% growth, the headline I'd leave you with is that it was driven by traffic. Almost all of that growth came from traffic. And so that means consumers with their feet and their clicks picking Target more often. And so that's an incredibly healthy sign for our business. If you step back and look over the last 2 years, we've now crossed the $100 billion threshold as a retailer, grown by over 35%, $27 billion over 2 years. And so we see a lot of strength in the business, and that gives us confidence as we look ahead to grow next year too.
As a CFO of Target, does inflation keep you up at night?
We certainly are watching the inflationary cost environment closely. But I'll tell you, Brian, where we tackle that challenge is through the lens of our guest, and we're focused on protecting value. We have a lot of levers we can pull in our business to combat inflation, and price is the lever we pull last, not first. So making sure our guests find incredible value at Target is our focus day in and day out. You can see the evidence of that in costs going up faster than retails at Target, and it's working. That traffic growth that we saw in Q4 is a testament to guests finding Target, more and more engagement over time.
Right. Out of the many other things you should be worried about is inflation. You know, there's also life, et cetera, et cetera. But yes, first quarter, you mentioned that operating margins will be well below last year. What's driving that?
Yeah, there's some unique things in last year's results that I think is going to make profit choppy quarter by quarter. But if you step out from the quarter to quarter volatility, the thing that I'm encouraged by is the growth we expect on the year. We expect to grow the top line. We expect to grow the bottom line. And the thing powering that growth is our investments. We'll remodel more stores. We'll open more new stores. We'll invest in some of those fulfillment services that guests have come to love. Drive Up is a perfect example of that, where we launched that service several years ago. We've made it better over time, adding fresh and frozen products that we didn't have in the assortment to start with. And as we listen to our guests, they've said, gosh, it'd be great to get a Starbucks as I complete that Drive Up order. And so that's something we'll be testing this year too.
Does it also reflect, though, the outlook, a cautious consumer spending environment? Listen, Target does not have stores in Russia and Ukraine. Supply chain is not exposed there. I get it. But we've seen a big rise in gas prices in this country the past week, the past month. What's your view on the consumer?
Yeah, so there's probably not one single view on the consumer. We see a consumer that's wrestling with the current global challenges. We see a consumer that's focused on this last phase of the pandemic that we're in, but also seeking a return to normalcy. We see a consumer that's feeling the impacts of inflation, but also has a pretty strong personal balance sheet. We see a consumer that's focused on price and value, but also willing to splurge in important events like Valentine's Day that was just really strong for us. And so, we found success by really listening to the consumer and making sure that we're finding ways within our multi-category model and within the ways we make it easy for guests to shop to put forward an offering that has guests continuing to choose Target, and they have.
There's a lot of sticker shock out there, Michael. I talked to a lot of the consumer products CEOs. They're out there raising prices. This morning, I came across gas prices in California are hovering around $5 a gallon. Do you think U.S. shoppers are likely to trade down this spring?
Yeah, we're monitoring the consumer really closely as we go into next year. And it's tough for me to predict exactly what consumer trends will play out for the year or what might be at the top of the guest shopping list. We know it'll be a consumer that's focused on value, and that's why protecting value is so important to us. We also know we've got a really durable model because we have strength in so many categories. It's easy for us to stay relevant no matter what's at the top of that guest shopping list. So in my house, it might be a kid who's outgrown their clothes that drives a trip to the apparel floor pad for that trip, or it might be restocking the pantry with a heavy food and beverage order. And so there's so many ways for us to stay relevant. That served us really well over the last couple of years, and I would expect it to next year as well.
As you know, I'm a frequent Target shopper, and I've seen, and it's not just dedicated to you guys, but empty shelves. I guess it's a high-class problem to have that, of course, in part reflects supply chain challenges. How far are you along to addressing this?
Yeah, over the last couple of years, we've been making progress quarter by quarter. We're never happy when the guest finds an empty shelf, but I feel like we've made good progress as the pandemic has played out over the last couple of years, and we're working really closely with some of our vendor partners to shore up any places where we've got work to do. I will say, stepping back, I feel really good about our inventory position as we head into 2022. Our inventories are up about 30% to last year. And so the teams have done a wonderful job navigating what's no doubt a complex supply chain to have us in a strong inventory position as we step into the year.
As part of fulfilling and getting those products on the shelves are the workers themselves. Now, Target has come out here saying they're lifting their wages where you have led in the past, but still $15 to $24, depending on location and job. How hard is it to attract talent in this market here?
So I'll tell you, Brian, those investments in team, are the best investments we make. And they aren't a just here and now investment. We've been on a journey for years to invest in the team, laying out a path to get to a $15 starting wage, which we did a couple of years ago, adding investments in wage to the increases that we talked about just yesterday, expanding benefits offerings, adding tuition-free education support. All of that is an investment in the team to deliver that exceptional experience that's driving growth. And right now, that's serving us well. We track things like the metrics around our ability to attract and retain a great team. And those metrics look for us stronger today than they did pre-pandemic. And so that investment's paying off, and the team is paying off that investment with their support of the growth we've seen.
You're in New York City for your first investor day as CFO of Target, I believe. Now, you put out a longer term outlook. And one thing that caught my attention is Target looking to spend $4 billion to $5 billion on CapEx. I believe you spent $3.5 billion in 2021. If an analyst came to you and asked you, Michael, where are you spending that additional money over the next few years? Where are you spending it?
Well, the headline for all of it is it's about growth. I'm excited for some of the projects we have in store for next year and beyond. And it starts with our stores. So investing in remodels. We've laid out a plan to remodel the chain. We're only about halfway through that journey. So there's a lot of targets waiting for us to put our latest and greatest thinking in your local store. And we know the guest response when we do that is strong. I'm excited about the new stores that we'll continue to build, find markets that don't have a Target today and be able to add one. We'll continue investing in our fulfillment capabilities. Again, Drive Up is a service we've seen guests flock to over the last couple of years, and we're excited to make that service even better by testing Starbucks and returns.
So hundreds of remodels over the next 3 years, and how many stores will you open this year?
Yeah, we'll accomplish more than 200 remodels in the year to come. We expect to open in the neighborhood of 30 stores next year, but that's a multi-year journey to make sure we're refreshing our stores with our latest and greatest thinking and to find those markets that could benefit from a Target that doesn't have one today.
We're waiting some manufacturing numbers, and we got some manufacturing numbers from market. Market Manufacturing Purchasing Managers Index coming in at 57.3 after the initial flash reading for that index of 57.5. This is for February, and we're awaiting the same figures from the Institute for Supply Management, just another organization that tracks it. Their numbers coming out at 58.6 for February. That is better than estimated. Prices paid coming in lower than expectations at 75.6, 77.5 was the expectation there, and also ticking down from the prior month. Very interesting there. New orders stronger than estimated, and unemployment coming in a little weaker than estimated. So interesting on the prices paid in particular, a little bit lower than had been expected. You see stocks right now looking a little mixed. The Nasdaq peeking into the green just barely. We've got energy in the pole position today, leading gains, and financials. Big banks doing pretty lousy today. We're going to get more details from that on that in just a moment from our Inez Ferre. And also coming up, we're going to chat with JP Morgan's head of emerging market economics and commodities research on the economic impact of what is going on in Russia, not only to that nation specifically, but the ripple effect. We'll be right back.
Welcome back to Yahoo Finance Live on this very, very busy Tuesday morning. I'm Brian Sazi alongside Julie Hyman. Markets are back under pressure as the situation between Russia and Ukraine intensifies and more Western companies pull assets out of Russia in response, seeing all three major indices solidly in the red here. Dow down almost 300 points, S&P 500 and Nasdaq also under pressure. Here's some other things we are watching for you right now. On the mark, Target shares are popping as the company beat analysts' earnings estimates. The company did warn on first quarter profit margins, though. Target CFO Michael Fidelki tells me the consumer is hanging in there despite multiple fierce inflationary pressures. In focus, HP shares are on the move as the company lifted its full-year profit outlook. CEO Enrique Lores tells Yahoo Finance HP has stopped shipments to Russia, even as it will hit their profits by about 3 cents. And chewing on a quarter, we'll talk with the CEO of JM Smucker about the company's latest quarter and outlook. Now let's get over to Inez Ferre, who's standing by with a look at the markets. Inez.
And Brian, taking a look at the 10-year Treasury yield that has been falling. Take a look at our Wi-Fi Interactive board. The 10-year Treasury now at a 5-week low as investors seek a flight to safety, driving those yields lower, down 7 basis points at 1.77%. This is not good for bank stocks, which are lower. In fact, take a look at the sector action financials right now lagging. You've got energy that's in the lead right now. And if we just take a look at our bank chart, you can see a lot of red here on the screen. Also, I want to just pull up a 12-day chart. Take a look at this. Quite a bit of red under pressure for bank stocks. Looking also at the energy stocks, and what I had just been mentioning, energy stocks, some of these in the green. Let's take a look at what's happening in commodities, because that's where a lot of action is taking place right now. We are watching both Brent and Wti Crude Futures. We're looking at WTI up more than 6%, above $100 a barrel at 101.93. That's a high, a 7-year high. Looking at Brent, disregard this number because Brent right now is up 6% at around $104 a barrel. Also remember that tomorrow is the OPEC Plus meeting. Looking at some other commodities, we're watching gold futures, which are up more than 1%. We're also taking a look at palladium, that's up more than 7% right now, soaring. We are also watching corn futures up more than 4%. Remember, Ukraine is a big corn producer, exporter, and also watching wheat futures up more than 5%. Both Russia and Ukraine are both big wheat producers. Julie, Brian?
Inez Ferre, thanks so much. Okay, JP Morgan is out with a major warning on the Russian economy. Strategists say the Russian economy will significantly contract soon and enter a recession. Joining us with more on this call is JP Morgan Head of Emerging Market Economics and Commodities Research, Jahangir Aziz. Jahangir, good to see you here this morning. Take us through, look, all morning long we've been talking about companies, big multinationals, pulling assets, pulling operations out of Russia. How will that impact the Russian economy this year? Where do you see growth going?
So look, the first round of, sanctions that happened a week back seems like a lifetime back. We had sort of, described it as having a modest or a moderate impact on the Russian economy, but the ones that came in the weekend will have severe impact. So essentially, what has happened is that, with all of these banks now under sanctions, and that, except for energy that has been carved out, everything is under SWIFT sanctions. So except for the non-energy part, Russia basically cannot really trade exports or imports. Maybe there is some trade that can happen outside of the hard currency, which is essentially going to be one that is related to China, most likely settled in CNY. But I think the biggest shock, obviously, was that CBR, the Central Bank of Russia's, $630 billion of reserves, was virtually brought down to zero. They have some gold, which is not really usable, and some CNY, which will support this China trade. So all of a sudden, an economy, even though there was, growth was slowing down, inflation was picking up, rates were rising over the last 6 to 9 months, you still had two very strong pillars to the economy. You had a current account surplus, and you had a central bank with about $630 billion of reserves. Both were essentially dented very, very sharply by the Sundays, by the last set of sanctions. And so without any real support from CBR, clearly, you must have seen it already, the ruble is almost in a free fall. Inflation is spiking. The central bank had to double its lending rates to about 20%, and that necessarily will have a very severe impact on the Russian economy. Now, how long it will last, difficult to say. We have about a 20% annualized decline in growth in the second quarter itself. For the year as a whole, about 3.5%, 4%, but those could easily become worse as the days go by.
And we were just throwing, Jahangir, the Russian ruble there, which, to remind our viewers, that's the dollar versus the ruble. So that's by how much the ruble has fallen. How much of this damage is irreversible?
That's a difficult question, but it's a great question. I think we need to look towards Europe and to the change in their energy policy that probably will come out in the next few days. And I think that's the big change. So if you look at Russia's exports is, pretty much energy plus some other commodities. And we can talk about the impact of those commodities on the supply chain. And I think that can be difficult. But just on the energy side, most of the energy exports is to Europe through, different pipelines, including, NS2, the newest pipeline, and to China. So if Europe decides that it's not going to be dependent on Russian exports or imports, rather, of energy, whether it's natural gas or oil, that really changes the way in which Russia has configured its energy complex, and therefore what impact it will have on the economy, I think, depends not so much on what Russia does at this point in time, but what Europe does with its energy policy.
That's a significant potential drop here, 20%. Does that essentially make Russia uninvestable for investors?
I think Russia was made uninvestable for investors by the sanctions already. So I think beyond that, in terms of foreign direct investment, etc., as you've already been talking about it, I think all of this is going to change. I think at the end of the day, the biggest risk now is a political risk that is being imposed on anyone who is investing in Russia. That risk is not, you can't hedge against that risk. You can hedge against, Fed rates going up, and you can hedge about inflation going up, ruble falling, but you really can't hedge against political risk. And I think that is going to be there for quite a period of time. So I think that, the impact on the Russian economy, not just in 2022, but in the medium term, is going to be very severe, not just, as I said, what happens to EU policy regarding oil imports and gas imports, but also on foreign direct investment going into Russia.
We have been looking at this whole situation through the prism of the West, right? What does it mean for European markets? What does it mean for US markets? Sure. You focus on not just Russia, of course, but emerging market economies more broadly. In a prior life, you were with the IMF. What's the ripple effect there that we need to be thinking about for emerging markets and emerging market economies?
This will sound very strange to you. That in a global risk of emerging markets are not going to do as badly. Typically, in a global risk of, the first thing you look for is how do you take your money out of emerging markets? Look at emerging market FX; it's doing pretty well given the circumstances, and the reasons are sort of three reasons behind it. One is that the financial connection of Russia to the rest of the world is limited. You have about $80-90 billion of BIS or European banks exposure to Russia, and you have some Russian exposure. You have about FX-related derivatives, probably about $100 billion. And in the grand scheme of things, these are not really large numbers. If you look at emerging markets, therefore, the contagion from Russia to emerging markets, therefore, is limited. In addition, and something that we get, it's sort of got lost in the last couple of months of the scourge of inflation taking over the entire world, and the Fed is going to raise rates, and therefore every emerging central bank will have to raise rates. That really isn't true. There is scourge of inflation. If you look at Latin America, if you look at Central Europe, inflation is actually very, very high, including in Russia even before the geopolitical tensions worsened. But if you look at the other part of emerging markets, look at entire Asia, look at South Africa, there hasn't been any pickup in inflation. And consequently, central banks over there have a much greater space to raise rates. They do not have to follow the Fed. They can calibrate their moves. So I think that emerging markets was already differentiated. I think the geopolitics actually differentiates it even more. If you do see commodity prices move up, and I'm not talking about just about oil, I'm talking about things like palladium, platinum, wheat, corn, etc., then there's a whole host of emerging market countries. South Africa, for one, huge producer of of these PGM, platinum group commodities, and the entire Latin American southern corn. All of them are going to benefit from it. And if that's the case, then they will have better fiscal positions. They will have stronger current account, which means that the central banks do not need to aggressively raise rates just because the Fed is raising rates. So I think there's a lot of differentiation in emerging markets. Sometimes we sort of don't look at that, but in this part of at this point in time, along with China and Japan, probably some of these emerging markets could become safe harbors. I never expected I would ever say this, but I'm saying it.
Well, incredibly helpful insights here. Really, we thank you for your time. Jahangir Aziz, JP Morgan, head of emerging market economics and commodities research. Stay safe. We'll talk to you soon. All right, coming up, there are signs of hope in Major League Baseball's lockout talks. Julie is back with those details next.
Estee Lauder has fired senior executive John Dempsey over an Instagram post that has since been taken down. Dempsey had posted a meme to his account that joked about COVID-19, contained a racial slur. The company announced his departure Monday, with a spokesperson for the company confirming Dempsey had agreed to retire. He did issue an apology last week, calling the post racist and saying he didn't read it fully before posting it. Major League Baseball is coming down to the wire as the ongoing lockout could soon affect opening day of the regular season. Monday, MLB and the Player Association made progress toward a new collective bargaining agreement during negotiations to stall the postponement of opening day. MLB said it would start canceling games if an agreement was not made by the end of February. Well, that passed. The deadline has now been extended to today at 5 p.m. This comes after 8 straight days of negotiations lasting up to 16 hours at a time. And more of Abbott's Similac baby formula is being recalled as the Centers for Disease Control widens its investigation into dangerous bacterial infections linked to the formula. In mid-February, the company recalled some lots of Similac, Alimentum, and Elecare powdered formulas. Now the FDA announced a child has died from a bacterial infection after drinking Similac PM 60/40 formula. The agency says the formula may have contributed to the child's death, and there have been 4 reports of illnesses caused by the same bacteria and was one caused by salmonella as well. All 5 of those infants were hospitalized and 2 died. The recalls include only powdered formulas with the first 2-digit lot codes of 22 through 37 and an expiration date of April 1st, 2022 or later. Saz?
Staying on healthcare, Pfizer's COVID-19 vaccine is much less effective in preventing infection in children ages 5 to 11 years than adolescents or adults, says a new study. Yahoo Finance senior healthcare reporter Anjali Kamani is here with the details. Anjali.
That's right, Brian. The study out of New York really confirming what the company had sort of indicated in December when it also notified us really that the vaccine for those under 5 years old was going to be delayed as they look to a 3rd dose. In a statement, the company has said that our updates earlier this year on pursuing a 3-dose schedule for the pediatric population were informed by the effectiveness data for 3 doses of the vaccine for people 16 years and older, and the early laboratory data observed with Delta and other variants of concern, including Omicron. So they're saying that they already had an indication looking at the older population by comparison that the dosage was not effective against infection. And that's a really important point to point out because it's infection, not severe disease. We also did see some reduced efficacy against hospitalization as we saw in the adult group. Right now, they are already working on those pediatric booster studies, including looking at a study for those from 6 months to 5 years, which we know about, as well as an additional dose for those from 5 to 12 years old and from 12 to 17 years old, and looking at the different dosages for that adolescent age group as well. And this is all really important to understand because it really brings to light, the struggle of finding that right dosage for younger individuals. We know that in large part, especially for the youngest cohort, the dosages are done by weight. And it seems like in their attempt to try and get this dosing right for safety, they may have not been able to find the right dosing for greater efficacy. Of course, we know that even within the adult population, we saw that reduced efficacy as we saw with the surging cases through that Omicron wave that we just got out of, as well as hospitalization and death. So it's important to point out that this is not unique to the age cohort. However, it is concerning. As we know, Pfizer is the only option right now for that age group. So that's the reason for the concern while we wait to hear back from these additional doses. And of course, right now we're looking at stagnating vaccinations across the country as we've come out of this wave. Simultaneously, the lifting of mask mandates and guidance from the CDC suggesting that 70% of the population of the U.S. is now in low or medium risk zones. And that includes over on the West Coast, where we saw California, Oregon, and Washington State announce removing masking in schools on March 12th. And so that joins New York, which also announced by March 7th they would do the same. And this is all sort of coalescing to be concerning. Pediatricians and other health experts are concerned about the impact of these 2 headlines together. So we'll have to wait and see how experts and officials handle this news. Back to you.
Anjali Kamani, thanks so much. Okay, coming up, Yahoo Finance tech editor Dan Halley hops on for a look at how social media is capturing the Russia-Ukraine crisis. We'll be right back. Welcome back to Yahoo Finance Live. I have some breaking news here in the oil markets. The International Energy Agency is releasing 60 million barrels from their oil reserves. And of course, that comes at a time when oil prices are on the rise here. Brent crude, you name it, as a result of the ongoing situation between Russia and Ukraine. But again, the IE releasing 60 million barrels from its oil reserves, perhaps to tamp down prices, not seeing prices come down after this announcement, but still oil prices likely to remain very much in focus. All right, switching gears here to tech. Yahoo Finance tech editor Dan Halley has been diving into how social media is capturing the unfolding crisis between Russia and Ukraine. Dan joins us now. Dan.
That's right, Brian. What we're seeing really is, again, as you put it, this kind of unfolding of the conflict in Ukraine, the invasion, take place across different pieces of social media, whether that's on TikTok, on Twitter, on Facebook, on Instagram. And we're really seeing it kind of impact the war itself to a degree. You obviously have President Zelensky over there on social media regularly trying to rally Ukrainians on the street, showing himself out there in public, giving defiant calls to stand up against the Russian aggression. You also have posts from Ukrainians in general posting that you would see in Russia, where you wouldn't see that coming from Russian media sources. So, Russian state media basically saying, the war is an act to protect Ukrainians. Well, now you're getting information in Russia from Ukraine dispelling that. And as a result, we're seeing more protests throughout Russia at the risk of them, those protesters being beaten and arrested. We also have images of Russian rockets being fired at civilian centers. We saw that image of the apartment building that was hit with a blast, or images of rockets that haven't exploded fully, embedded in streets, or in one particular instance, there was a missile embedded in someone's apartment building that hadn't exploded yet. And those have helped to push forward the kind of actions that we've seen over the weekend with the additional sanctions and the call to have Russia expelled from SWIFT. So it's really having an impact, not just on people, but also on the governments there. And it's important to point out, though, that this isn't the first conflict we've seen play out over social media. This is a Eurocentric conflict that we're seeing. And so it does lead to frustration for people who have been involved in other conflicts, like the ongoing issues in Yemen and Afghanistan, where they were on social media but didn't receive this kind of coverage. So there's frustration from people in those groups as well. And it's something that's definitely worth talking about. But it really is incredible to see how social media is kind of pushing this forward and having a direct impact, really, on this conflict.
Yeah, and on public opinion, indeed, of course, as well. Dan, there's also, of course, while this is playing out on social media, there's also an effort by the various platforms to restrict social media in various ways, including trying to get rid of misinformation, for example. You have a restriction of RT's various social media outlets, right? And so what are we hearing from the various companies as it's not an easy thing to do, as we've certainly seen in other situations?
Look, these are companies that otherwise would kind of accommodate Russia, especially when it comes to anything that's a state or a state set law, right? So we had Netflix; they were going to be asked to, or are being asked to, eventually carry state media, and they've said now that they will not do that. That includes some of the state media that's pushing Russian propaganda. YouTube has demonetized RT, and they're not allowing it to be seen in parts of Ukraine. We've seen Facebook, or Facebook's parent Meta, come forward and say that they're working against state actors who are pushing propaganda or otherwise trying to hack high-level Ukrainian officials and poses them to push things for Russia, basically saying that, here's an image of Ukrainian tanks surrendering, which is not accurate. So we're really seeing these companies kind of come forward. They're obviously going to be asked to do more. We saw the Ukrainian official ask Apple to stop supporting Russia by providing its phones there and the app store. So it'll be really interesting to see what else we get to see from these companies and how else they respond. But so far, they do seem to be stepping up to the plate to a degree in a way that we haven't seen previously before.
Yeah, finance tech editor Dan Halley, thanks so much. All right, coming up, James Smucker is out with better than expected earnings. CEO Mark Smucker joins us on the other side of the break. Stick around. Good day to get under a blanket. James Smucker beat analyst profit forecast for the most recent quarter, fueled by demand for Uncrustables snacks and fruit spreads. The company is the latest food giant to warn about nagging inflationary pressures. Joining us now is James Smucker, CEO Mark Smucker. Yahoo Finance's Brooke DePalma is here as well. Mark, always good to see you here. Stock is down in the early going here, and some of the early analyst coverage is focusing on inflation and the impact to margins. Is there any sign in the business that the inflation you're dealing with is nearing some form of peak?
Well, what we remain focused on is the momentum of our business. And clearly, we've had some fantastic results from a top line perspective, and we've done exceptionally well managing through this unique dynamic environment, whether it's supply chain or inflation. And we have been able to pass along inflation justified pricing to our customers, and we've been able to partner with them. So we've been able to recover on a dollar for dollar basis our cost increases while maintaining momentum, as you highlighted on Uncrustables, and essentially every single one of our businesses is up.
And Mark, I want to take a deeper look into that coffee portfolio. This quarter coffee sales increased 6%. Last quarter, we saw an increase of 8% for Cafe Bustelo and Dunkin'. How much longer do you think the company will ride the wave of increased at-home consumption?
Well, consumption, even though we're largely sort of coming out of the pandemic, the hybrid work environment is going to continue. We're going to continue to see people working from home for potentially for a long time because folks aren't going back to the office. So we do think at-home consumption will stay elevated. 70% of cups consumed are actually consumed at home. And with Dunkin' and Bustelo, those are the fastest growing brands in the category. So we have tremendous growth on both of those brands. And then K-Cups as well. K-Cups, we're outpaced the K-Cup segment. And that's all our brands, folders included. So very good performance on all brands in our coffee portfolio. And we view that will continue.
And now, Mark, sticking with that coffee topic, James Smucker has recently entered a strategic partnership with that pure play coffee and tea brand, JDEP. Now, this comes as your away from home consumption is also recovering. We saw 29% sales growth there, almost back to pre-pandemic levels. How do you see this innovation taking place? What can customers and investors expect, and where can they expect these products?
Well, Brooke, you're absolutely right. Our away from home business is doing fantastic. It's almost entirely recovered sales-wise from pre-pandemic. And the partnership with JDE is one that we've had for over a decade. What's changed is that we are now sourcing some of that coffee directly from JDE and now have access to their newest, latest, and greatest equipment. So think of large banquet halls, large conference centers in the largest hotel chains. That's where those products go. And as folks are doing more conferences, that business will continue to recover as well. So we're really pleased with the partnership with them.
Mark, the $150 million charge on the Rachel Ray pet food business, what's driving that?
Well, as we've talked over the last several quarters, we have done tremendous work reshaping our portfolio in terms of divesting a few brands and focusing our resources in the fastest growing parts of our business, whether that's coffee, Uncrustables, and so forth. And in pet specifically, it's pet snacks and cat food, where we most recently took the #1 position in dry cat food with Meow Mix. And so since we've shifted our focus to pet snacks and cat, we have slightly de-emphasized our dog portfolio, and we will continue to work on it and stabilize it, but our focus will remain on pet snacks and cat.
Fair enough. The team is coming off a presentation at CAGNY. That's the big annual food conference. And your presentation at Smucker got a lot of attention out there in the street for what you mentioned about potentially doing a transformative deal. What did you mean by those comments? And is there anything coming?
Well, M&A has always been part of our strategy. And I mean, that's over 20 years, that's been part of our strategy. That's how we become the company that we are today. So that hasn't changed. We continue to look at acquisition opportunities. The one refinement that we've been trying to convey is that if there's a large transformative M&A, potentially in a new category, we would consider that as long as it gives us a leadership position. And we would consider bolt-on acquisitions in our existing categories to sort of round out our portfolio. But what is new, and just a refinement really, is we won't go after small emerging brands in categories where we're not already playing. We're really focused on maintaining our leadership position in categories, and to the extent that our M&A efforts support that, that's the strategy.
All right, we'll leave it there for now. James Smucker, CEO Mark Smucker, always good to see you, and always good to see you as well. Yahoo Finance's Brooke DePalma. Talk to you later.
Thank you both for having me.
Appreciate it. All right, straight ahead, we'll go inside the boardroom with the former CEO of Metric Stream, who also sits on the boards of Verizon, Nordstrom, Roper Technologies, and Okta. Do stick around for that conversation. You will not want to miss it.
high conflict topics potentially at issue in boardrooms these days, including the present events in Russia and Ukraine, including rising inflation and interest rates, including a diversity and increasing push in that direction. To talk about all of this, we're joined by Shelley Archambault, former CEO of MetricStream and a board member for companies like Verizon, Nordstrom, Roper Technologies, and Okta. Very broad and diverse group of companies as well. Shelley, thank you so much for being here. I want to start with Russia and Ukraine. As we see so many different companies making the decision to try to divest, pause operations there, et cetera, what are the kind of conversations you're hearing here, and what goes into that kind of a decision for companies?
Well, first of all, thanks very much for having me. Happy to be here. With regards to the Ukraine crisis that's going on right now, first and foremost, companies are focused on safety of their employees, of their suppliers, right, customers, et cetera. And that was always the first step. So when the invasion actually happened, I heard from all of my companies in terms of the steps they were taking with regards to their employees as well as their suppliers to try to help do what they could to ensure safety. And then beyond the overall employees and the safety aspect, then it comes to, all right, what's the business implication? And even though Ukraine is a relatively small country rather, a lot of businesses are actually intertwined in many different ways. So looking at who your suppliers are, who's been impacted, and how that needs to be addressed with regards to how the company operates and runs their overall business. So there's lots of conversations going on right now to understand what the current impact is, but also to plan for the risks going forward.
Well, and I want to pick up on risk in particular, because that's your history, right? At MetricStream, that's what the company does. When you're dealing with a wartime situation, a very fast-moving situation, what is the question that companies need to be asking themselves when it comes to risk assessment?
It's understanding first their risk disruption. So what's happening today and how can it disrupt, or could it disrupt? So it's doing scenario planning about potential outcomes and what those implications could be. So when we look at this one, areas that are being focused on are impact of inflation, because we know what's happening with the volatility in the oil markets as a result of Russia obviously being a very large supplier of oil. But there's also a lot of concern about the overall farming and agriculture, because a lot of wheat products come out of both Russia as well as Ukraine, fertilizer and key fertilizer ingredients, key minerals, et cetera. So understanding the potential inflationary impacts to business is another area. Cybersecurity. Every company has raised their overall threat levels and are being very, very proactive with regards to strengthening and tightening up and being on very high alert with regards to cyber, in concern that there might be retaliation, right, that happens against the US companies from that perspective. So there are a number of areas as it relates to risk that companies are focused on right now to try to mitigate risks. And that includes what they might do with operations. You talked about it, shutting down operations or moving operations, whether it's a temporary move, which what most companies are doing, to determine what's the best way to indeed ensure that the operations that were happening, whether they were factories or IT outsourcing, which is a big industry for the Ukraine. So moving all those things to other places in a temporary fashion is definitely being considered.
And Shelley, in your view, how's corporate America doing with all of these various factors in risk mitigation, in cybersecurity spending and assessment right now?
I will tell you that the good news is there's been a lot of focus on risk in general across all companies especially in the last several years. So many of the things that are happening are not brand new potentials. All the companies I'm engaged with spend a lot of time on enterprise risk management and looking at what could possibly happen, where are big risks, et cetera, and having a game plan for what they would do if these things happen. So therefore, it's not that they're just starting right now to say, oh my goodness, this has happened, what do we do? But now that it has, it's looking at their overall business continuity plans and making sure they're implementing them properly, right? The cybersecurity plans they have in place, just making sure they are indeed rechecking, making them more robust, et cetera. So the good news is I do feel that in general, least the companies I'm engaged with and most that I'm involved with, have actually have very strong risk management processes in place. So right now, it's really just a matter of executing the mitigation plans.
And I think it's fair to say that one of the things that could potentially strengthen companies when it comes to risk assessment is getting a lot of different voices at the table to give input. And I'm speaking about diversity in particular in the boardroom. You're on a number of boards, as we talked about, and this is an area where we've been seeing some movement and some improvement. I'm curious, not just about being at the table, but being heard when you're at the table, what your experience has been. Is your voice, do you feel like your voice is valued in these situations?
I absolutely feel my voice is valued. And I will tell you, the good news is most companies believe, as we can see as results of the improvement that we've seen, especially in the last couple of years around diversity, that diversity does help. We've known it from studies for decades, but now it's actually coming to pass. And I think that's why we're seeing so much focus from shareholders on wanting to ensure that boards are diverse. Because absolutely, it's critical that you have different perspectives and different experiences at the table, especially during times of crisis, times of change, to make sure that you're not missing any blind spots.
And Shelley, finally, as you know, the Nasdaq is instituting a rule that is going to make diversity in the boardroom a requirement. Do you think that's a good idea? Do you think that that is a good way to get toward that goal?
Honestly, I think it all comes down to shareholders. I've always said that companies will actually start focusing on diversity when shareholders believe it's of value to them. And we're now at the stage where shareholders believe it's of value. State Street, Vanguard, BlackRock, for years, they've been writing letters to CEOs talking about the need for improved diversity in the boardroom, as well as in their companies and executive ranks in general. And now we see the different proxy advisors, Glass Lewis, ISS, et cetera, also focusing on this area. Last year, there was a record number of shareholder proposals all around diversity, and is diversity happening? So shareholders are speaking, and they're saying, listen, we see the data, we see the stats, we see the research, and we believe diversity matters and can improve the overall performance of companies. So now, yes, companies are responding because they are responsible to shareholders. So I think the fact that Nasdaq has a rule, the fact that Goldman Sachs, even a year before that, actually said they won't take companies public unless there's diversity on the board, I think these are just outputs because they are listening to what shareholders want. So companies are now stepping up, and we are seeing absolute improvement. I mean, last year, 47% of new directors came from unrepresented minority groups. That's a significant increase over past years.
Yeah, it just shows the power of that upswell that you're talking about in what shareholders want. Shelley, thank you so much for your perspective. Really interesting stuff here. Shelley Archambault is former CEO of MetricStream. She's on the board of Verizon, Nordstrom, Roper Technologies, and Okta. Thanks again, Shelley. Appreciate it.
Absolutely.
Before we take
Thanks
a break,
so much for having me.
thank you. Before we take it a break, just wanted to check quickly on what's going on with stocks. We are now seeing the lows of the session for the major averages. The Dow off by about 400 points, about 1.2%. We'll be right back. Well, among the numbers that we've been considering out from various companies, got to talk about HP as well. And you talked to HP, Mr. Brian Sozzi, about what's going on in a demand for personal computers right now.
Yeah, I caught up with HP CEO Enrique Lores after earnings. Julie, talking a little bit about the demand outlook for PCs. They had a good quarter in PCs, also commercial printers. But I asked Lores about the inflationary outlook and how much they've had to raise prices because of everything they're seeing. Take a listen.
Yeah, we overall are experiencing an inflationary environment. We're seeing cost increases both of components and logistics, and we have reflected them in our prices. And I would say this has had also a positive impact in our results this quarter.
And he added, Julie, that depending on what model computer or PC that you buy, prices could be up anywhere between 10 to 15% versus last year, as a company like HP tries to recoup some of the inflation it is in fact seeing, not unlike what we've been hearing from large food companies.
Yeah, definitely. And what's interesting is how successful companies have been at doing that. And as we've talked about, sort of amazing how little pushback companies have gotten. And that it's interesting to me, Saz, how broad the range is from food to PCs that we have not seen that pushback.
Hey, if you need a new PC, you're gonna go out and buy a PC. And the reality is, I have no idea what I paid for my last PC. Couldn't even tell you. So they could probably be charging $300 more. I wouldn't even be sure. But again, we'll have the full interview with Lores later on today.
Great stuff. Looking forward to that. In the meantime, just wanted to check on the markets again and what we are seeing. We continue to see a plunge in banking stocks in particular. I'm just glancing in percentage terms. Interestingly, some of the regional banks are getting hit today. The likes of KeyCorp, Signature Bank, Citizens Financial, Lincoln National, the insurance company. Kind of interesting here that we are seeing those kinds of moves, but the large cap banks, the JP Morgans and Citis of the world, are also trading sharply lower. We have seen energy stocks trade higher along with oil prices, even after we had the International Energy Agency say it was releasing, authorizing the release of 60 million barrels of oil. But it doesn't seem like that is slowing down the increase that we are seeing in oil prices today. WTI, $104 a barrel. So definitely a lot of concern about what those higher oil costs are going to mean, even as the look is that they benefit energy companies. That does it for Brian and I on this Tuesday morning. Coming up next, Brian Chung going to take you through the next 2 hours of trading and what has been quite a roller coaster session already. We'll be back tomorrow.
Welcome to Yahoo Finance Live, 11 a.m. hour here on the East Coast. I'm Brian Chung. My co-anchor Akiko Fujita has the day off. A lot going on this Tuesday, March 1st. If we take a look at markets, we've actually been seeing the losses accelerate throughout the trading session just so far in the morning, with the S&P 500 down 0.9%, the Dow down almost 500 points, that's about 1.3%, and the Nasdaq down about 0.6%. Of course, all of this off of the developments from Russia and Ukraine as markets continue to weigh the impact of geopolitical risks out of Eastern Europe. We will explore the ripple effects on equities and oil as oil surpasses $100 a barrel. A lot of focus on equities and also commodities markets on that front. And then also, President Joe Biden expected to deliver his State of the Union address tonight, inflation remaining the name of the game, with the worry that price increases won't let up with the Russia-Ukraine conflict. We'll have the Deputy Director of the White House's National Economic Council stop by to offer his thoughts. But of course, need to give you an update on all of the action out of Eastern Europe. Tensions continuing to rise between Russia and Ukraine as continued fighting amplifies calls for international help. Ukrainian President Volodymyr Zelensky doubling down on his call for the European Union to give Ukraine membership and begging the West to impose a no-fly zone on Russian aircraft, something that President Joe Biden has ruled out for the fear of direct engagement with Russian air forces. Economic sanctions, though, for now, remain the focus of Western efforts, with some reports suggesting that the European Union is advancing the list of Russian banks to be blocked from the global financial messaging system known as SWIFT. These are the 7 names reported by Bloomberg that are being discussed by the European Union for the ban. Note that 2 giant firms, Sberbank and Gazprom Bank, don't appear on that list. And keep in mind, the United States and other jurisdictions will have a say in which banks are ultimately blocked from the network. Now, on the ground, though, the fighting continues, with one of the latest attacks being a rocket strike in Ukraine's second largest city of Kharkiv, which killed 7 people and injured 24. The United Nations saying this morning at least 136 civilians, including 13 children, were killed in the first 5 days of the invasion. A massive refugee movement underway, with the UN saying about 500,000 people are on the move to Poland, to Hungary, to Moldova, and others. Many trapped in Ukraine are reportedly minorities from India, Somalia, and other countries looking for help. And in Russia, long lines at ATMs underscore concerns about an economic collapse as the Russian ruble remains weak against the US dollar. $1 getting about 99, call it 100 Russian rubles. The Moscow exchange remained closed on Tuesday. And in the United States, financial giants like BlackRock say they will suspend the creation of new shares in Russia-focused exchange-traded funds. A lot going on, so let's dive deeper first into the market action, at least stateside, with Barry Bannister, Stifel chief equity strategist. And Barry, we were just breaking down these headlines, and by the day, it seems like things are continuing to move. From your vantage point, how much volatility are we seeing in the U.S. markets, even though today is a down day? A market deceleration in the volatility that we had seen in some of the trading sessions last week. Do you feel like equity markets have kind of gotten over most of the bumps here, even though it seems like the escalation is just getting hotter over in Eastern Europe?
Just before the end of 2021, we wrote a report that said that the market then close to 4,800 would drop to 4,200. Probably in the first quarter, it did during the Ukraine issues. We wrote a report just yesterday with details saying that we think it'll get to 4,050. Currently, that's down 7% from this level, and probably by the end of March. I think the risk is very high. We have commodity disruptions from the Baltic Sea to Brazil. We're seeing a material negative inflation effect come to the U.S. standard of living, food and energy costs. If 104 doesn't do it, $140 a barrel would do it. But we're seeing a tremendous inflationary squeeze. And we've got this monetary anesthesia, really for the last 3 years, that's been trying to shield people from the realities. But to use the analogy of anesthesia, we have political doctors who can't hide their moralizing, jingoistic goals, but they're trying to cut off an economy that is like a $1.5 trillion financial system. That is their annual GDP in Russia. And it's having a negative effect on markets And we're seeing it in emerging market credit default swaps, high yield spreads, LIBOR, OIS, which is a scramble for dollars. This is like Lehman in some ways, Lehman Brothers failing, in the sense that it has ripple effects that we don't even know the likes of what it's going to do. So I think there's just way too much anesthesia from free money out there. And what'll happen is the reality will catch up to them and the prices will rise to take away a lot of that money.
Barry, you bring up the L word, Lehman, and I just kind of want to drill down on that because you mentioned that things are getting a little bit concerning when you take a look, for example, at, OIS spreads. I mean, they did get larger, but I have talked to people that said the blowout isn't bad enough to signal any sort of serious liquidity crunch here. And Lehman does seem like a little bit of a different story when you consider that was a U.S. institution. If a Russian bank blows up, it remains to be seen how systemic that would be. But I get your point about the overall caution. I guess my question to you is, if we do get back to 4,000 on the S&P 500, is it going to be from a Russian economic collapse or something else?
Well, there's a lot of cross currents going on. For example, China tightened up tremendously in 2021, tremendously. It was in line with all the major tightenings of the last 10 years. And the lagged effect of that, it takes 6 to 8 months, is that in the first half of 2022, they would slow down. And the stimulus they're doing now won't show up until the second half. So you could have that plus the what's called the bullwhip effect, less demand for goods after an unusual surge in goods driven by excessive policy stimulus on the fiscal side. Government wrote checks, people bought TVs, treadmills, you name it. And so a sudden fall off in demand, a sudden stop as you get into the second quarter. These things could happen and the market would see them 3 to 4 months in advance, which is why first quarter is so weak. I just don't think we should disregard some of the negatives. As far as a comparison, Russia defaulted back in 1998. Brazil had some trouble, this time not because of commodities. But there's a lot of disruption going on. And we just can't hide the fact that all this television moralizing is highly disruptive. It's a $1.5 trillion financial limb of the economy, and we're trying to amputate it off with monetary anesthesia. And just because people have cash piles doesn't mean that we're not immune to pressure on living standards and market disruption. So yeah, I'm watching essentially everything, and we have our screens wide open.
Yeah, I mean, the overall thesis, I mean, not to sugarcoat it from you, I mean, it sounds a little bit bearish here. So what do you do if you're trying to reposition your portfolio here? Do you go into defensives?
Yeah, we went into the year with, above average cash. We also said the major defensives, this within the S&P 500 index, just use that as an example. There are 11 sectors. 3 of them are outright defensive: utilities, consumer staples like food, beverage, tobacco, and healthcare, such as very cheap biotech, but it's gotten very cheap. It's very cheap now. But also healthcare equipment, supplies, and devices, medical devices. You got to go defensive when the market's down, or go to cash and wait for a better buying opportunity. And that's where we've been emphasizing.
All right, Barry Bannister, Stifel Chief Equity Strategist. Thanks so much for breaking that down for us. Looking forward to having you on again sometime soon. All right, coming up, or actually, let's move on to the other story. We are going to hear tonight from President Joe Biden in his State of the Union address, where he's expected to offer updates on Russia, Ukraine, and provide a roadmap for the ongoing challenge of inflation. For more on this, let's bring in Bharat Ramamurthy, National Economic Council Deputy Director. Bharat, it's great to have you on the show again. The Russia-Ukraine situation and inflation, it appears that these two things might be tied together. Can you give us any sort of preview on what we should expect to hear the president say on those two fronts tonight?
Sure. I think the president is going to provide an update on the latest in Russia and Ukraine, the actions that he and our allies have taken to address this crisis. But he also knows that issues about our economy and inflation are top of mind for the American public, and he's going to address that as well. I think the context on the economic side has to begin with the fact that since the president took office roughly a year ago, We have created more jobs than in any single year in the history of the United States. We've seen the biggest single year drop in the unemployment rate in the history of the United States. The unemployment rate is sitting at 4%, which is much lower, much faster than anybody expected a year ago. So there's a lot of good news in the economy. Just this morning, there was good news about the manufacturing sector in the United States. In the last several weeks, we've seen a number of companies, whether it's Intel or Texas Instruments, talking about announcing new investments in new production in the United States, in Ohio and Texas and Michigan. So there's a lot of good news in the economy. We understand that inflation is a problem, is a concern for a lot of families. It's something that the president has been focused on for several months now, and he will continue to remain focused on going forward.
Now, at the same time, the messaging that we've heard from the White House in the lead up to the sanctions on Russia was that, American consumers might start to feel the pain point, especially in energy and oil. How will the president kind of square that message as the sanctions continue to ratchet up here? It seems like most Americans kind of already understand what's happening in Russia, Ukraine, but there is an uncertainty by which they're wondering how much will prices go up at the pump when I try to fill up my car.
Well, to take a step back, the design of these sanctions was to inflict the maximum amount of damage to the Russian economy and to Russian oligarchs and to Putin, and to minimize the amount of damage to the American economy and American consumers. Of course, there are going to be some follow-on effects, but that was the basic design of those sanctions. And what we have seen so far is that the sanctions are having that kind of effect on the Russian economy based on the latest data that we've been seeing. The sanctions do not impose sanctions on Russian energy. That's in part to help American consumers, in part also because at the moment we feel like those would be counterproductive. But it's the case that we're going to have to monitor this situation very carefully going forward. And the president has made clear that one of his focuses here is to make sure that American consumers and American families aren't getting particularly hard hit by this. He's calling on American companies to step up and do their part. And one of the things he has said is that oil and gas companies should not take advantage of this moment to further raise prices on American consumers. We're all in this together.
Now, on that point, I mean, it's not just the oil and gas industry, but consolidation has been something that the White House has been talking about for a while within the context of wanting to break down any sort of anti-competitive behavior that may be driving prices higher. What types of industries are you seeing that in? And is the president going to kind of detail exactly how he goes about addressing what might be anti-competitive behavior that could be driving prices higher?
Sure. In fact, just yesterday, the administration announced a new initiative to go after anti-competitive conduct in the ocean shipping industry. So just to give you a little bit of context there, right now there are 3 global alliances in the ocean carrier industry, the people who transport goods between the US and Asia. And those 3 global alliances make up 95% of ship 95% of the goods between the US and Asia. And what we have seen is since the pandemic began, certain prices for transporting goods are up 1,000%, 10 times. And obviously for those price increases, they filter their way through, they hurt American businesses and they hurt American consumers. And so what the president is committed to doing is taking on that kind of conduct in this industry. Just yesterday, he announced that the Department of Justice would be joining up with the Federal Maritime Commission, which is the primary regulator here, to make sure that our laws are being robustly enforced. And he's calling on Congress to take action here. This is actually an area where we've seen significant bipartisan progress already in both the House and the Senate. So he hopes that we can deliver something to the president's desk shortly to address some of the competitive issues in this industry that are raising prices for American consumers and for American businesses.
Now, that's on the fiscal policy side of things, but it seems like some of the commentary that I've seen has said really the big tool that could be used here to make sure that aggregate inflation goes down is the Federal Reserve as they look to tighten policy rates in their next meeting in March. I mean, how is the Biden administration, I guess, thinking about not necessarily coordinating because, the Federal Reserve has independence, but figuring out what types of fiscal policies would be helpful but not too preventative in abruptly stopping the U.S. recovery as the Fed tries to pull back its pandemic-era easy money policies?
Well, look, as you said, the Federal Reserve is independent. We're not going to comment or suggest what the Fed should or shouldn't do on monetary policy. One thing I will say is that the president has nominated 5 people to serve on the Federal Reserve Board of Governors, including renominating Chair Powell, nominating current board member Lael Brainerd to serve as the vice chair of the Fed, and naming 3 additional folks to serve on the Board of Governors there. Many of these folks have already received bipartisan support from Congress in the past, and each of them would bring valuable perspective to the Board of Governors at a time when the Fed has a lot of complicated decisions before it. Those folks have not been confirmed yet because Republicans in the Senate Banking Committee refused to show up to vote for these folks. I want to be clear, this is not to say that they're going to show up and vote no. They refused to come to the meeting and therefore are depriving the committee of having a quorum so that they cannot advance these nominees. It's one of the most irresponsible things that I have seen in recent years from Republicans in Congress, and it is preventing us from putting folks on the board who have commanded respect across the political spectrum and getting them to work, analyzing the situation we're in and figuring out the best path forward for the Federal Reserve. I really hope that we're able to break this gridlock on the Republican side and move forward in a responsible way.
I mean, have you had any conversations with those on the Republican side? I mean, their holdup is apparently with Sarah Bloom Raskin, that pick for vice chair of supervision. They say they want to get more information about her views on climate change and her dealings with a fintech company. Are you optimistic that they can get a vote soon? Have you had those types of conversations?
I mean, look, you'll have to talk to them. Frankly, in my view, the objections and concerns that they have here don't hold a lot of water. We've gone through the normal process that we've gone through before. So Sarah Bloom Raskin herself has already been confirmed twice by the Senate with bipartisan support both times. She's attended a hearing. She's filled out the questions that they've asked of her. And again, if Republicans want to show up to that meeting and vote no, that is their right. I don't think that that's justified given the incredible experience that these folks have, but that's their right. But to not show up at all and therefore prevent any action on this, as I said, it's irresponsible. And it sets a very dangerous and bad precedent for how we're going to address and deal with nominees going forward.
All right, well, we'll see how that story unfolds. Bharat Ramamurthy, National Economic Council Deputy Director, thanks so much for stopping by this morning. And again, stay tuned for Yahoo Finance for live coverage of President Biden's first State of the Union address. That'll be happening tonight at 9 p.m. Eastern. You can catch it at finance.yahoo.com. But coming up on the other side of the break, Target is surging as the retailer caps off a record year of growth. Shares up 12% today. We'll hear from the company's CFO as concerns loom over the state of consumer spending amid rising inflation. That's next. Big names reporting earnings this morning, Target being one stock on the move after dropping its numbers on the tape before the bell. Yahoo Finance's Inez Ferre is here with us from the Nasdaq with more on Target and another retailer making moves as well. Inez.
Yeah, that's right, Brian. With Target's earnings per share coming in above what the street had been expecting. Take a look at the results you see there for the company's latest quarter. Gross profit beating expectations. Same-store sales up 8.9% year over year. The results were driven by traffic growth in the quarter, with more than 95% of sales in stores. Target CFO spoke to Brian Sozzi earlier today, saying what's powering the growth are Target's investments. Target plans to expand its e-commerce offerings. It plans to remodel, build new stores. Also, the CFO spoke about the consumer. Take a listen.
We see a consumer that's focused on this last phase of the pandemic that we're in, but also seeking a return to normalcy. We see a consumer that's feeling the impacts of inflation, but also has a pretty strong personal balance sheet. We see a consumer that's focused on price and value, but also willing to splurge in important events like Valentine's Day that was just really strong for us. And so, we found success by really listening to the consumer and making sure that we're finding ways within our multi-category model and within the ways we make it easy for guests to shop to put forward an offering that has guests continuing to choose Target, and they have.
And it really underscores the inflationary environment that we're in and the state of the consumer. Taking a look now at what's happening with Kohl's, because Kohl's shares are up right now, and that's after the company reported its quarterly results. A miss on the top and the bottom line, but its outlook coming in better than what the street had been expecting. The company's full year profit forecast coming in above expectations. Activewear sales were up 40% year over year. CEO Michelle Gass highlighted scaling key initiatives such as Sephora. Kohl's has been opening Sephora's shop-in-shops inside its stores. And the retailer, of course, has been under activist investor pressure from McCallum to either spin out its e-commerce business or put itself up for sale. Kohl's right now up almost 2%, Brian.
Yeah, that reminds me, Ajay, I think I have some Kohl's cash I got to spend, but I'm shifting gears. I want to move over to Zoom. Shares of Zoom are down about 4% today. What's behind the move?
Well, Zoom reported its quarterly results, beating on the top and the bottom line, but its sales outlook for the current quarter came in below what the street had been expecting. The stock is down, 75% from its all-time high back in 2020. And the declines that you're seeing really underscores investors really cautious around a name like Zoom, which did so well during the pandemic. It grew so much during the pandemic, and the company's just struggling to keep up with that massive growth. Zoom is adjusting its metrics for the way it's reporting some of its metrics to investors. Also, the company announcing a $1 billion stock buyback program. Brian?
Yahoo Finance's Inez Ferre. Thanks so much. Coming up on the other side of this break, WTI tops $100 a barrel, extending its gains to the highest since 2014. We'll break down how oil giants are responding to the escalating conflict in Ukraine. That's ahead. Oil on the move this morning as we continue to watch the headlines coming out of the invasion in Ukraine. When you take a look at crude oil up over $100, we're actually about $104 on WTI. Brent crude at about 105, call it 106 essentially. Obviously, a lot of developments with the IEA also chiming in. Now, let's bring in Philip Strebel, Blue Line Futures Chief Market Strategist, here with more. Philip, it's great to have you on the program this morning. We just saw some headlines across the IEA was saying there would be no oil shortfall due to the Ukraine crisis. Just wondering if you have any thoughts on exactly how the supply and demand dynamics are shaking themselves out right now.
Well, it still appears that supply is flowing out of Russia. It's not had any kind of impact whatsoever. I mean, them coming off of SWIFT, we have seen companies have to try and make other alternative measures. They do produce about 10 to 11% of the global oil. And, we're just going to have to continue to monitor the situation right now.
And what's interesting is that all of these kind of oil price dynamics, some have argued, have been kind of irrespective of the Russia-Ukraine crisis anyway, and that regardless of the geopolitical risk, that barrels of oil were going to get more expensive. I want to take a listen to Chevron CFO Pierre Breber, who spoke with our morning show about oil price increases. Take a listen.
Markets are always volatile. Undoubtedly, there's geopolitics that are raising the prices now. We want the war in Russia and Ukraine to end as soon as possible. But this was started well before the Russia-Ukraine crisis. We've seen demand recovering very strongly as the world economies open up, and supply is responding, but supply is lagging. So we're seeing an upcycle now, but we expect prices to moderate over time.
Well, just wondering if you can kind of unpack some of that commentary that we heard from Chevron this morning with regards to kind of what was already happening before the Russia-Ukraine crisis. And now, when you lap on that geopolitical risk, what do you expect to happen going forward?
That was 100% in the cards. The supply was not increasing. I mean, we've seen small bump ups in the U.S., but there's no CapEx spending. So it's too politicized at the moment. We can't expand our oil production any more than it is. And the demand is increasing. I talked to so many friends today that are in Chicago that, because they dropped the mask mandate, all of a sudden everyone's coming back to work, and that demand is going to outstrip supply. So the setup was there. This just pulled forward the returns. This is, this is unprecedented moves. The way they really get oil prices going crazy is if they do exactly what they did to Iran and they start putting on import tariffs on Russian oil, and you see other countries follow suit like Canada that are banning Russian oil imports. Canada doesn't import it. They're just stating the fact. And if you see others follow suit, that's where you're going to see WTI go up to 120, 130, 150.
120, 130, 150. Wow. I mean, tell us a little bit more about the kind of geopolitical intertwinedness of, I guess, the Eastern Europe and also the Asian region when you consider that. I mean, we had asked Chevron earlier this morning whether or not they were going to shut down their Kazakhstan pipeline given the connections out there. And basically what the CFO said was that, no, it's not directly in Russia. So, I mean, it seems like even though there's a lot of headlines around what's oil going to do, what's gas going to do, it seems like there's still been some, I guess, I don't know if you want to call it exclusions, but some wiggle room for the industry to continue running.
Look, there's a cancel culture that's surrounding Russia right now. It is what it is. That's just how it is. You're going to continue to see the demand globally outside of Russia is going to continue to increase. Unfortunately, their economy is going to be completely crippled. And if you look at even simple things like the jets that they have in there, the airlines and everything, okay, one, no one's flying there at the moment, and two, about 35% of Russia's fleet of jets are all leased. Other countries are not going to allow those leases to get renewed. So demand for oil within Russia is going to decline substantially, and also in Ukraine. It's how other countries respond. Do they start actually reassessing their energy independence and start implementing older methods again? It's how's the Green Energy Act gonna respond?
Do you see any type of permanence coming from some of the decoupling that we've been seeing when you talk about Shell exiting ventures with Gazprom, BP selling its stake in Rosneft, right? Does this suggest that the kind of intertwinedness of the global oil market is going to look very different even after, hopefully soon, this conflict is over?
110% it's going to look different because of the fact that they are they're pulling the plug on all these projects. That's why you're seeing, BP's down today. You're seeing companies like Occidental and Chevron, they've been rallying today. It's all about the exposure to an intertwinedness with Russia. They decouple it. What are the chargebacks that they have to pay? And then how are they going forward? I mean, it's kind of a rude awakening when you find out that 70% of, Germany's energy dependence comes from one country, and the country goes to war with another. What happens?
How do you think investors are responding to both of those companies' announcements?
Well, you saw a rotational shift. You saw people come out of companies like BP. It was down immediately, and they went into other companies like Occidental. And I think that the XLE is probably the better way to play. It'll get you a little bit more diversification. The futures are up like 9% right now, so I think it's a little bit crazy. The CME has launched 100 barrel, 500 barrel, and the 1,000 barrel contracts, so you can risk manage the current volatility in the market appropriately, but you've got to select the right contract size given the account.
All right, XLE, I mean, quick and dirty and easy, I guess. Philip Streibel, Blue Line Futures Chief Market Strategist, thanks so much for joining us this morning. Coming up on the other side of the break, turning a corner in the coronavirus pandemic, the developments as some West Coast states gear up to end school mask mandates later this month. We'll be right back. A new study finding that Pfizer's COVID-19 vaccine is less effective at preventing infection in children ages 5 to 11 than in adolescents and adults. According to New York State health officials, the vaccine is only 12% effective in that age group. Here with more on that is Yahoo Finance's Anjali Kemlani. Anj?
That's right, Brian. It's important to point out that those numbers are actually against Omicron, and that study comes just on the heels of that surge we saw past. So it's really important to note that all of this is not new. In fact, Pfizer did point out in December that they were looking at reduced efficacy on cases, on infections specifically. The vaccine does still provide some decent protection against severe cases and hospitalizations, and this mirrors what we saw in adult groups. In a statement, Pfizer today said our updates earlier this year on pursuing a 3-dose schedule for the pediatric population were informed by the effectiveness data for 3 doses of the vaccine for people 16 years and older, and the early laboratory data observed with Delta and other variants of concern, including Omicron. So right there you have it, that focus on the data that was coming out from the adult population, and we of course saw the impact that Omicron had. And this is that reduced efficacy. Specifically, just want to point out those numbers. The drop for adolescents 12 to 17 was from 66% to 51%, and then in the 5 to 11-year-olds, it's 68% to 12%. Now that significant drop is also because the dosage dropped in that age group. They're using that 10 microgram dose, and as you can see, that's exactly what the pediatric booster studies that Pfizer is currently conducting is looking at. They currently have 3 undergoing, which is the 3 microgram dose, an additional dose for those 6 months to under 5 years, which we saw was the reason why they delayed their emergency use authorization filing with the FDA. Meanwhile, they're also looking at for 5 to under 12-year-old, the 10 microgram dose, as well as looking at either an additional 10 microgram or an additional 30 microgram, which is the current dose for 12 to 17-year-olds. So as you can see, a lot going on in that space to try and understand how to really battle. And this is important to look at for future variants and what the impact could be if we run into another one, just like Omicron. Back to you.
Yeah, well, obviously that 5 to 11 age group, very important within the context of protection in schools. And on that point, we actually got some announcements from a number of West Coast states actually changing their mask mandates. And this coming also as an airline in the United Kingdom drops their face mask rule on flights. It's hard to imagine not wearing a mask on a plane, but give us the update on how the global picture is changing on mask wearing.
That's right. Actually, airlines, I'm just going to put an asterisk here. Airlines are some of the safest places because of the way that they've worked on their air ventilation, but we'll get to that in a second. On the masking, you're right. The reason for the concern over these vaccine numbers is because, number one, Pfizer remains the only vaccine available for younger age groups. So that is where the concern comes in. The timing of the study coincides with the CDC dropping its guidance for much of the U.S., and we've seen New York looking at dropping mask mandates for schools next week. And then the West Coast now joining that with Washington, California, and Oregon saying that they will look at March 12th to drop that. So really a lot of focus on sort of because numbers are decreasing, because we're on the lookout for what could potentially be another variant in the next several months. Right now, just an easing as you're seeing of masking. And to that point, Jet2, UK's third largest domestic airliner, dropping mask mandates for its hubs in the UK, in England, and in Northern Ireland, as well as on the flight itself. Now, it's really interesting because the airlines have been, under a lot of pressure since the beginning of the pandemic, really, to work on ventilation, of course, because they're just such close compartments to sit in for long periods of time. And so we've seen studies repeatedly done, and over the years, a lot of focus on that ventilation to help prevent other respiratory diseases. So while I wouldn't recommend necessarily doing it, there is some study to support the idea that it is among the safer places to unmask. But experts have been saying that even though there is a reduction in enforcement of these mask mandates, that it is still safer to mask anywhere. Back to you.
All right, Yahoo Finance's Anjali Kamalni. I do feel like, though, every time I get on a plane, I just end up getting sick. That's like before COVID, right? You always get a cold after you fly. But maybe that's just the stress of travel. But thanks again for breaking all of that down for us. Well, I want to take a quick look at markets right now because, again, things moving very quickly on this Tuesday morning with the Dow down over 500 points now, down 1.6%. The S&P 500 down 1.25%, and the Nasdaq now down over 1%. But on the other side of the break, we will take a look at Bitcoin, which on the other side of the coin is up now. We're close to about 43,500 on that cryptocurrency. We'll break down the latest price action on the other side of this break. We'll be right back. Bitcoin is surging as more investors are looking to put their money into something that's not fiat. Bitcoin currently at about 43,500. Remember, that's a far jump from where we were over just a week ago when we were at close to 37,500. And it appears more Russians are converting to crypto as well. According to data from Crypto Compare, Bitcoin trading denominated in the ruble skyrocketed after the invasion in Ukraine started on Thursday, jumping over 250% from the day before that. Joining us to discuss is CoinDesk Global Macro Editor Emily Parker. Emily, your thoughts on just the broad price movements over the last few days?
Yeah, so, with the obvious disclaimer that we never know what moves Bitcoin's price, there are a lot of conditions right now that are definitely ripe for crypto adoption. So if you look at Russia specifically, you have reports of long lines at ATMs as people are racing to withdraw cash. The ruble is basically collapsing. People are looking for a safe haven asset. Bitcoin is supposed to be a safe haven asset. That's generally, part of its philosophy is that it's a hedge against this kind of risk. So it would make a lot of sense. But that's not the only use case for cryptocurrency right now. It's also being used for donations worldwide. For example, Ukraine has asked for donations in cryptocurrency, and they're getting them. Something like at least $16 million US dollars have been sent to Ukraine via cryptocurrency, and a lot of that cryptocurrency has already left the wallets and is being deployed. So you also have the Russian opposition movement is also raising money in crypto. So there are a lot of use cases for crypto right now, which is a relatively fast and efficient way to move money across borders.
Yeah, as you point out, Emily, being used on both sides of the situation here. But I kind of want to ask about how some of the private companies are dealing with some of the political headlines here, because Ukrainian politicians have asked some of these exchanges to freeze Russian, Belarusian, in some cases, crypto accounts. And Binance being one example of a company that's essentially said, no, we're not going to do that. Do you expect these types of calls to ramp up? And kind of how are you viewing the response from some of these exchanges?
I do think that these these calls for this kind of thing will ramp up, because a very popular narrative in the media right now is the use of crypto for sanctions evasion. We don't know how effective crypto will be for that purpose, but yes, I do think we will see calls like that. I think, Binance, I think their position makes sense. As far as I understand it, Binance's position was, we are happy to comply with blocking sanctions accounts, but we're not going to just block the accounts of any Russian. Because, first and foremost, I think, Binance's argument is this really sort of violates the spirit of crypto. But second of all, there are so many ordinary Russians that are against this war and who, vehemently oppose this war. And, it would just be punishing a lot of ordinary people who really did not want this to happen at all.
Right, and that's kind of complicated, because if you don't do a ban wholesale, then you're trying to pick and choose whose accounts, and the whole point of these crypto accounts is to keep it anonymous. So I guess on that point, and this is going to be a bit of a tough question, I guess, because every country has their own regulations when it comes to AML or other types of supervision over this type of field. But do you think there's any viability that there really could be a framework for wanting to do this, even if some of these exchanges wanted to kind of do what the Ukrainians are asking?
Well, I think the larger question here is, how effective is cryptocurrency really in avoiding sanctions, right? And I don't think if we're talking about large scale sanctions evasion, I think one of the big myths about Bitcoin is that it's completely anonymous. That's actually not true. As we've seen with some of the big Bitcoin hacks, a lot of those criminals have been identified via law enforcement by looking at blockchain data. I mean, sort of the whole idea of the blockchain is that it's transparent and that Bitcoin transactions are recorded. So it takes time, it takes effort, it takes skill, but there are ways to, identify sanctioned accounts, right? Or sanctioned wallets. So, if somebody is trying to move a huge amount of money from one country to another, I don't think it's that easy to do that in a way that nobody's going to pick up on.
Right, and that's a good reminder, because we saw it just with here in New York with two money launderers who were involved in that big Bitfinex hack. They, law enforcement was able to trace it because I believe they stored their information and the keys on the cloud. So I guess maybe a note to those money laundering, don't do that. But Emily Parker, CoinDesk Global Macro Editor and CoinDesk TV anchor, thanks so much. Coming up, Russian teams are getting benched. The details as organizations like FIFA ban the country's national and club squads from international competition. And of course, we're still watching markets, again, getting some steeper losses, with the Dow down almost 700 points. That's about 2%. We'll have more market coverage on the other side of the break. I want to call your attention to some big market moves that are happening right now. It looks like the markets are steepening their losses in this morning session, with the Dow down almost 700 points. That's about 2% on the Dow. The S&P 500 down 1.5%, and the Nasdaq down 1.33%. Also keep an eye on crude oil, which is getting a massive rise in just this session this morning. It's up $10. WTI crude oil up $10 to $106 a barrel. Same story over at Brent crude, where a barrel of oil is up about $9 to $107. Obviously, all of this on the heels of the developments happening out of Russia, Ukraine. Again, we'll continue to watch what's going on in markets as we continue to go on throughout the show. But let's call some attention to the international sports community, at least for right now. A lot of officials and organizations moving to box Russia out of competition. And for more on that, let's bring in Yahoo Finance's Dave Briggs, who's been watching this story very closely. Dave, the latest to take action, FIFA, UEFA, they're apparently Xing Russia out of international competition. Now, for people that are watching this and wondering, why is sports important to Putin and Russia here? Walk us through the significance of what's been going on that front.
That's a great point, Brian, because a lot of people just think, why does sports really matter when we're talking about a war? Well, sports matter with Russia more than any country on the planet, with perhaps the notable exception of China and President Xi, their ally. And it also matters to Vladimir Putin more than any world leader on the planet, because if it's part of his machismo, masculine national identity. You don't see President Biden or Obama or Trump or Clinton in a judo uniform or skating on the ice, actually playing hockey with some of the best players on the planet. That's what you see Vladimir Putin do on a regular basis. Those are his two favorite sports. He has now been stripped in those two regards, in addition to FIFA, which I'll get to. The International Judo Federation, a sport he competes in, stripped the title as their honorary president. The International Hockey Federation banned Russia from both the World Championships and the Junior World Championships. This is everything to Russia. And Garry Kasparov, who's the Russian former world champion chess player, Brian, really put this in perspective, telling the Washington Post, sports bans could have a tremendous impact on the minds of the Russian people. He added that sports are an important part of Putin's campaign of gaining influence. You want proof of that? His approval rating went from 54% prior to the Sochi Olympics in 2014 to 90% afterwards. It is central to who he is and the way he leads. As for FIFA, this was really throwing up a yellow card, if you will, on Sunday, saying we'll allow Russia to continue to compete in the World Cup, but they can't host matches, they can't use their anthem or even their name. But then the IOC came out the next day and urged all sports bodies around the world to ban Russia and Belarus from competitions, and also Poland, the Czech Republic, and Sweden, the other three teams in Russia's World Cup pool, all said, no, we will not compete with Russia under any circumstances. The US and the UK said the same. That's when FIFA came out and issued the red card. A little too late, but they did make the right call, banning Russia from the World Cup, which starts in November in Qatar. Their match with Poland, March 24th, that for now is off. They are out of the World Cup. A great decision by FIFA and the IOC, but I think it's a make-up call for both organizations who have largely looked the other way with human rights abuses, selecting these authoritarian countries and human rights abusers for their venues, Brian.
David, you know, a really challenging question here. I'm glad you bring up the Olympic point, because we did see this, right? I mean, Russia, because of the doping scandal, not allowed to compete under their banner and under their flag. It was the Russia Olympic Committee, but they still allowed those athletes to compete. The thinking, I guess, is that you don't want to punish these players and these very talented athletes who didn't have anything to do with these political decisions to invade Ukraine. But at the same time, you have to punish the nation, I guess, at large to send the point to their political leaders. So how are you seeing these kind of broad international bodies handling that thin line there?
Well, I think they realize right now that we're just living in a different world than we were 6 months ago, maybe even 6 weeks ago. And I don't think this would have happened if we rewind the clock to the last Russian invasion. But now athletes and teams and the biggest stars in the sports are saying, no, we're not going to take this. They're going to social media, the way the biggest soccer star for Poland did, Robert Lewandowski, and he said, I'm sorry, it is not the fault of the fans nor the athletes, but I will not step foot on a field with Russians. So I think we're just living in a different world now. We should add the IOC made an exception in the case of the Paralympic athletes. That starts here in a couple of weeks, and they said it's too late at this point to disallow them to the Paralympic Games that are in Beijing. But the U.S. IOC, the U.S. Olympic Committee rather, just said no. We would like those Paralympic athletes from both Russia and Belarus kicked out of the Paralympic Games in Beijing. Some of those athletes have already arrived. So the IOC is clearly trying to have it both ways on that behalf. But I think if we move forward on this, the question is, what if Russia takes Ukraine? How long will these bans hold up? Will we normalize at some point they're holding Ukraine, a sovereign territory, and will these bans expire? Hopefully FIFA, the IOC, the International Hockey Federation, and others will stand up and say, well, as long as you hold Ukraine, you are banned from international competition. Hopefully we do not normalize what they've done, Brian.
An ongoing story. We'll definitely see how all that unfolds. Yahoo Finance's Dave Briggs, thanks so much. We want to bring you some new video this morning out of Kyiv, Ukraine. Thousands of residents crowding the local train station looking to flee as Russian forces continue to close in on Ukraine's capital city. Satellite images released earlier this morning showed a massive 40-mile-long convoy of Russian troops bearing down on Kyiv. More than 600,000 people have already fled Ukraine amid the crisis to neighboring countries, including Poland and Romania. Well, on the other side of this break, we're going to continue to take a look at the markets again as that sell-off continues to steepen. The Dow Jones Industrial Index down about 2%. That's almost 700 points again as crude oil rockets higher, up $10 a barrel to $106 per barrel. Again, S&P 500 down 1.6%. Nasdaq down 1.4%. We'll be right back. Welcome back to Yahoo Finance Live, just a minute after the noon hour here on the East Coast. I am Brian Chung. Akiko Fujita is off today. Another volatile day on Wall Street as investors continue to monitor the latest developments out of Ukraine. Again, markets accelerating their losses throughout the morning session as we cross into the PM, with the Dow now down 2%, the S&P 500 down 1.6%, the Nasdaq down 1.4%. The U.S. 10-year yield in a traditional risk-off behavior here really plummeting right now, 16 basis points of a move in a single day. Folks, you do not see this type of thing on a normal basis, down to 1.68%. We have not seen that level since mid-January. And also banks moving a lot. The XLF, one of those spider ETFs, the worst performing sector today and this week. It's been down 5.2% between Monday and Tuesday. And regional banks, as measured like things like the KRE, having their worst day since November. The XLF having its worst day since June 2020. A lot to walk you through in this show, though. In Hollywood, a clampdown on the Kremlin will explain how studios like Disney and Netflix are responding to the crisis in Kyiv. Plus, we've got a profile of Jay Powell, the Federal Reserve Chairman. Got a behind-the-scenes look at how the Fed chair averted an economic disaster and the challenges that the central bank faces with inflation and now the Russia-Ukraine crisis. Next. But first, a Russian convoy over 40 miles long approaching Ukraine's capital, and Secretary of State Antony Blinken calling out the Kremlin for killing civilians in Ukraine. Earlier today, he told the UN Human Rights Council that the Russian military is striking schools and hospitals. Let's zoom in on the impact of the economic sanctions and also take a look at the market implications as global stocks and bond yields move with Megan Horniman, Verdant's Capital Advisors Director of Portfolio Strategy. Megan, it's great to have you on the program this afternoon. Obviously, a lot of movement happening in markets right now. You know, the 10-year yield catching my eye. I mean, you do not see these 15, 16 basis points move on the long end here. What's going on here? Are markets starting to kind of grasp the gravity of what's going on in Eastern Europe?
I think it's just your traditional flight to safety. And today it looks like the markets are getting hit a bit harder, more a violent swing as the aggression with Ukraine does intensify. So I think what you're seeing is a flight to safety. And right now, unfortunately, the one place in the world where people are looking to go is into U.S. dollars, into U.S. treasuries.
So when it comes to just kind of the overall global picture, I mean, you know, a lot of people were saying over the last week or so in our conversations that, yeah, the Russia-Ukraine situation is a geopolitical risk, but that historically markets have just seen it as a speed bump, that the bigger story right now is the Federal Reserve. When you take a look at market action like today, do you hold to that theory, or do you feel that maybe it is indeed something that the geopolitical risk could be a bigger deal than markets were discounting?
I definitely understand that the geopolitical risk has intensified lately, and we have transformed from where there was just the overall fear of what the Federal Reserve was going to do. That's translated now into what's going on from a geopolitical sense. So right now, there's really some price discovery going on. People are trying to figure out from an earnings perspective what higher energy prices will mean. They're looking at the sanctions, trying to get a gauge of what that means for global growth. But at the end of the day, geopolitical risks, as you had mentioned, they do tend to be short-lived. The biggest impact right now is just that the very, very significant move higher we're seeing, not just in oil here, but in Brent as well overseas. This is the biggest concern from an economic standpoint. So while you can look at portfolios and kind of look past the short-term geopolitical risks, you do have to look at, is it threatening the economic fundamentals? So markets and investors are getting nervous that higher energy prices can impact economic growth here in the U.S. and abroad.
Now, when we talk about just kind of positioning then in this case, how are you thinking about the way to hedge against what is higher volatility across the board here?
Well, you know, having some dry powder, having some cash is always important as well. We knew that coming into this year that there would be volatility, not necessarily from as high as it is because of the geopolitical situation, but because of the Federal Reserve and the fact that we were maturing in the economic cycle and did expect an economic slowdown this year. So having dry powder is important. But in periods like this, when it's very, very challenging to kind of stomach those daily violent swings, as well as look at the, you know, very tragic humanitarian humanitarian crisis that's going on in Ukraine, it's important not to let emotion override your long-term objectives with your portfolios. Also, it's important to be well diversified. Coming into this year, no one wanted to touch bonds at all. And we don't necessarily like bonds for the long run either. But it does show you in periods like today and the past couple of weeks that bonds do serve as a purpose of a portfolio diversification. You need to be well diversified. Over the long run, if you have a well diversified portfolio, that should withstand over the long run as short-term periods of volatility driven by exogenous factors like what we're seeing from a geopolitical standpoint.
I mean, I guess on that point, if the thesis here is to kind of ride it through, what was interesting was that throughout a lot of 2021, the big story was, get into risk because that's the only place where you can find yield right now. Now, for people that maybe picked up, let's say, for example, emerging market funds looking for yield in the midst of 2021, is it still the case in the recommendation to kind of stay the course through all of this?
It's very important when it comes to those areas that are most affected to know what you own. So, holding an index fund, for example, that is in Russia or a part of the emerging world that's highly exposed to Russia, that's not going to give you the benefits of an active manager that can pick apart what companies can get through this. I wouldn't add anything right now from a perspective of overall asset allocation. Emerging markets do have a place in portfolios, but know what you own. That's the most important thing. At this time right now, we're still in that buy on dip mentality, but we're being very selective on where we're looking to do that. Areas in the U.S. market right now are a little bit more insulated from an overall, the global situation that we're dealing with right now. Small and mid cap areas, these areas should be a bit more isolated than some of your U.S. large cap areas as well. So just know what you own. I wouldn't necessarily add into the emerging markets. Be very defensive, be patient, look at each pullback and assess, has it changed the underlying economic fundamentals, and then make decisions from asset allocation.
Right. Know what you own. Megan Hornman, Verdant's Capital Advisors Director of Portfolio Strategy. Thanks so much for stopping by this afternoon. Well, let's shift focus over to the impact of the economic sanctions that have been imposed by the West with Christine McDaniel, Mercatus Center Senior Research Fellow, also a former Deputy Assistant Secretary at the Treasury Department. Christine, thanks so much for hopping on the show this afternoon. There have just been so many moving parts over the past few days with regards to what the West has done to Russia. And I guess the latest has been a focus on the SWIFT network, that financial messaging network that apparently the EU wants to ban 7 banks from. A lot of people were saying this might be the nuclear option here. What do you think is the impact of severing Russia from the international banking system?
Yeah, so I just was listening to Megan talk about how geopolitics, political events can be short-lived, and that's true. But investors don't forget the capital controls. And yesterday we saw Moscow put a hold on any foreigners taking assets out of Russia, and we'll see how long that lasts. But even after trying to look beyond de-escalation, which I know is hard to do right now, but at that time. Investors won't forget that. So, any exposure to Russia or exposure to actors that have exposure to Russia, and you can go out, several derivatives. That's going to be on everyone's minds in looking way out. And as you said, the EU is considering excluding 7 more Russian banks from SWIFT, sort of like the Gmail of global banking. So far, that it looks like they're going to be sparing the Russian gas giant Gazprom. We'll see how long that lasts. A lot of this is a question of, the more pain the West can endure, the more effective our sanctions will be. So that's a big question right now for the EU, the UK, the US, and others. But the fact that they're tightly coordinating. I mean, we've seen more happen on the EU transatlantic security front in the past few days than we've seen in the past 30 years. And with Germany just announcing that they're going to be increasing their military spending to over 2% of GDP. I mean, it hasn't been there since 1991. So It does look like a shift in geopolitics for the long term.
Yeah. Christine, I guess one question is that we've already seen the pain on the Russian economy when you take a look at their central bank ratcheting interest rates up from 9.5% to 20%. But do you feel like this is just the beginning? Because now there's people saying, well, the sanctions are going to be harsh enough where it could honestly put one of those massive lenders, be it a VTB or a Sberbank, completely underwater.
We'll see. I mean, there's so many moving parts right now. I think of the Russian economy, also just the everyday Russian people, right? And so, the ruble is in a free fall. They're experiencing increased interest rates, went from 9.5% to 20%, and then they're cut off. Many of them are cut off from the SWIFT banking system. So everyday Russians are, finding that they're not able to go online and buy things with their credit cards anymore, or they're not able to book airline tickets, with not only banking restrictions, but also airspace restrictions. It's going to be expensive to pay back any credit card debt they have. I mean, all those things, build on each other, and with the Russian economy in spiral downward, it's going to have an impact, on everyday Russians there. Then the question is for the oligarchs, how long will that list go? We're hearing reports that perhaps some of the elites are being offered safe havens if they were to completely, denounce their Russian ties. It's sort of like a last minute, lifeboat before. If those reports are true, then that is consistent with the thinking that they will go for the, for the 100% wall around Russia on the capital front, because they wouldn't throw these guys a lifeline unless they were willing to do that.
Now, I guess there's no questioning here that the West is trying to be as punitive as possible here, but there is kind of a limit, if you will, where there could be a financial stability concern. It seems like some people, we had Barry Bannister on the show earlier saying the L word, saying Lehman could be a moment if one of these Russian institutions goes under. I mean, do you see any sort of risk about if we do follow through on making the Russian economy collapse, that there could be spillover effects that could trigger the next global financial crisis?
Well, there's no doubt there will be spillover effects. The magnitude is a big question mark, right? I would imagine that people are rapidly reallocating their portfolios, as we speak, in anticipation of that possibility. There's so much uncertainty right now, but the big question marks do tend to favor that we'll be seeing, more sanctions, which means anyone exposed to Russia, out to the fourth derivative, if you will, could be in a real tight spot. And then, is there any big pillar that is so exposed that if that falls, is it going to take the whole system down? And I'm sure that is what the central banks around the world are discussing right now.
All right. Well, that was Christine McDaniel, Mercatus Center Senior Research Fellow. Thanks so much for breaking all of that down for us. Again, markets continuing their slide as the Dow actually touching a session low just a few moments ago. You can see the Dow now down still around 2%, almost 700 points, as the jitteriness does continue over those Russia-Ukraine headlines. But we'll continue to check markets. On the other side of this break, though, Jerome Powell getting some focus ahead of a big hearing tomorrow. But we're going to talk about Federal Reserve Chairman Jerome Powell's work on trying to get the economy back up to speed during the depths of the COVID pandemic. Nick Timros from the Wall Street Journal will stop by to talk about his new book, looking into his response to COVID and the challenges that lie ahead. We'll be right back. Well, again, taking a look at markets, red across the board with the Dow down 1.8%. That's over 600 points, with the S&P 500 down 1.5% and the Nasdaq down 1.33%. Again, big movement happening in the 10-year bond right now, down 13 basis points to 1.7%. So kind of risk-off behavior happening on Wall Street. We'll continue to watch all the developments as we get deeper into the afternoon session. But it seems so long ago that there was a time in 2020 where Fed action was described by Sunday evening emergency announcements. And now that we're entering the third year of COVID, hard to believe, it's worth a look back on the Fed's response and the man behind it all, that being Fed Chair Jay Powell. Nick Timrose is the Wall Street Journal's chief economics correspondent, and he's got a new book out called $1 Trillion Triage. It's how Jay Powell and the Fed battled a president and a pandemic and prevented economic disaster. Nick, it's not often the case that we have another Fed reporter on our network here, but a lot of really interesting details that you've got here in this book, which came out today. Jay Powell appears to, based off your reporting, have exited the pandemic in a very different man than he entered it. Give us a little bit more of kind of the evolution of his thinking on central bank policy during that time.
Sure, and thanks for having me, Brian. Yeah, I think one of the things people forget is that we nearly had a financial crisis in 2020. And I think one of the things the book walks through is that there's an assumption right now that anybody would have done what Powell did in March of 2020. And sure, there's some truth to that, but there's a view of how hard is it to fire up the money printer, make the money printer go burr. And if you look at what actually was going on inside the Fed, you'll see that there's an institutional timidity there, right? There are lawyers and economists who want to check every box, and Powell was really hurrying people along. The week of March 16th, which was just ground zero for the financial crisis, he's telling people it feels like we're swimming after a speedboat. We really need to get going faster here. And so there were a number of really controversial decisions that the Fed made, controversial at the time. I think looking back now, people sort of take it as a given. Well, of course, the Fed was going to do all this. Of course, the Fed had to do all this. But that's really not the case. And I think the book really explores how Powell played a key role. Remember, he's, of course, not a PhD economist. We're reminded of that by pundits all the time. But he has a background in corporate finance. He's a lawyer. He's a small p politician. He really honed his retail political skills in the first 2 years on the job when he was being attacked by Donald Trump. And all of those skills served the Fed quite well in March of 2020.
Nick, what's really interesting, you've got so many little tidbits of information in here, like, Jay Powell has a Tesla. He stubbed his toe apparently during the pandemic. But there are some really important details in here, too, that suggest that Jay Powell may have actually wanted to get more aggressive during some of those big emergency liquidity facilities that were opened up over the course of 2020, but was actually met with resistance from Steve Mnuchin, who was the U.S. Treasury Secretary at the time. Tell us about what your book kind of explores in terms of the relationship between the Fed and the Treasury during these emergency situations.
Well, Powell and Mnuchin had a very good relationship. Through all of the drama where Trump was attacking Powell, Mnuchin was, quietly providing him backup. So they had a close relationship. But it's true that as the Fed got into designing these programs, Fed officials generally were wanting to take more risk. They were wanting to provide more of a backstop, particularly in some of the things like the lending programs for cities and states, the municipal liquidity facility, or the Main Street lending program. And the Treasury was more resistant to taking losses. The Treasury was providing the equity capital there. So what's surprising, I think, is that for the first 3 years of Powell's term, Trump was constantly pushing the Fed to provide more stimulus to the economy. And then when you got into the pandemic, you saw a little bit of a reversal there where the Fed was the one saying, well, can't we be a little bit more aggressive here?
Yeah, and what's interesting here is, I guess, the way that the Fed was trying to grapple with the risk that they would be taking on by doing this lender of last resort role. How do you think the evolution of the Federal Reserve's, not to get into Bagehot's dictum here, but how do you think the Federal Reserve's role as a lender of last resort kind of evolved over the course of this crisis? People were already saying the Fed pushed the line with the term asset liquidity facility during the 2008 crisis, but they had a lot more this time around. How do you think that has changed what the Fed means to the global economy?
You're right. I mean, Powell took Ben Bernanke's playbook from 2008, and he added page after page after page after he ran through the playbook. And what's interesting about that moment in our political economy was that the Congress was perfectly willing and eager to have the Fed step in this fashion. That's surprising if you look back 10 years earlier, when the Fed was essentially reprimanded by Congress for bailing out the banks. Dodd-Frank placed new strictures on the Fed's ability to make those kinds of emergency loans. They needed the sign off of the Treasury Secretary. But here you had a situation where I think people realized the Fed was going to be the fast mover. You had Democrats who were probably more skeptical of Trump, maybe concerned that there were going to be political favors being done in any kind of emergency lending programs. And so they felt comfortable with Powell. I think the attacks of Trump on Powell, even though it led people to wonder, well, gee, is the Fed doing the president's bidding? It also gave Powell the chance to show that he wasn't, going to fall in line with the president. And that earned him on both sides of the aisle a lot of respect. I mean, fast forward to today, right? He hasn't been confirmed yet. We're waiting for his confirmation vote in the Senate to a second term. Inflation's very high. High inflation is not politically popular, and yet it looks likely that he's going to have a bipartisan confirmation vote, to the point that nobody's even talking about the fact that we're a month in now with no Senate confirmed chairman of the Federal Reserve.
Yeah, and as you mentioned, I mean, the story is still very much being written. I mean, look no further than the fact that Chairman Powell will be testifying for 2 back-to-back days beginning tomorrow at 10 a.m. during a time where inflation is high. That's something the president's going to have to touch on tonight in the State of the Union. But there's also this whole Russia-Ukraine conflict that could be feeding into inflation as well. I mean, what are you expecting to see from the Fed chairman tomorrow? And how do you think that kind of bleeds into the importance of the Fed's efforts really to tighten the spigot on that money printer this year?
It's a really terrible time for energy prices and commodity prices to be rising if you're the Fed. I think a lot of people in the markets are conditioned to think that the Fed is going to rush to the rescue every time that there's a geopolitical shock, because in 2016, whether it was the China swoon at the beginning of that year or Brexit in the middle of the year, the Fed kept putting off its plans to raise interest rates, but growth was running between 1% and 2%. We don't have that problem now. We don't have a problem of insufficient demand in the US economy. So it seems much less likely that the Fed is going to be able to get off of the plans here to raise interest rates. And when you do have a negative supply shock, like what we're probably going to see in the energy market right now, the textbooks say the Fed shouldn't react to that. Central banks shouldn't react to a one-off increase in the price level. But inflation's 7%, heading up to 8%. Consumers are beginning to think more about inflation. You're seeing companies raise wages multiple times a year. There's a real concern about a self-sustaining inflationary cycle, and the Fed cannot ignore that right now. So it's going to make Powell's testimony tomorrow and the next few months of Fed policy really, really interesting to watch.
Yeah, an important point you bring up there. If there's one thing we've learned from the Powell-led Fed, it's not that they're not going to tie themselves to the pole of an FRB US DSGE model or anything like that. But Nick Timmeros, again, the Wall Street Journal chief economics correspondent and the author of $1 Trillion Triage, again, that you can get that today. It's good to see you, and I'll see you in that next Zoom room or WebEx room on March 16th. Thanks, Nick. Coming up on the other side of the break, we will continue to take a look at markets as the Dow, again, down about 660 points, with the S&P 500 down 1.5% and the Nasdaq down 1.33%. A lot of market action, jitteriness in response to the Russia-Ukraine developments. But we'll talk about cyber attack concerns as U.S. officials warn companies to remain vigilant against Russian hackers. We'll have the details as a new global hacking collective appears to be getting involved. We'll be right back. want to bring you some new images out of Kyiv, Ukraine, again, as the Russia-Ukraine crisis continues to boil over. At least 5 people have been killed after Russian forces struck a television tower. This breaking just recently. The attack has reportedly disrupted broadcasts and cut off access to some Ukrainian TV channels. The Russian Defense Ministry previously said Moscow's forces would hit technological infrastructure in Kyiv to, quote, suppress information attacks on Russia, end quote. And it appears, at least for right now, that they are following through on some of that. So we'll keep an eye on all those developments again as tensions boil over in Eastern Europe. But we want to turn our attention now on the other hand of this conflict, which, of course, is the cyber aspect of all of this. A cyber attacks in focus as some groups like the global group Anonymous commit to, quote, a cyber war against Russia. Let's bring in Klon Kitchen, American Enterprise Institute senior fellow, who is also an expert on national security. Klon, it's great to have you on the program this afternoon. You know, it's just things are changing by the day, but it cannot be discounted the fact that this is not a war that's just going to be fought on the ground, but on the internet as well.
Yeah, that's absolutely right. And Brian, one of the interesting things is that we frankly expected even more activity online than we've seen thus far. And a lot of us are trying to figure out why that is. We're not sure if the Russians just overestimated their capabilities and so chose not to take cyber actions, or if some of those efforts were attempted but then rolled back. But one of the things, as you mentioned, the Anonymous Hacker Collective, one of the things that typifies the current environment is that it's very crowded. So you have state actors, both in Russia and Ukraine, including the United States and its allies. You have private companies like Microsoft and Facebook who are doing active threat monitoring and taking mitigating actions. And then you have hacking groups like Anonymous. So it is a dynamic and crowded space right now.
Now, again, it's not like the Russia-Ukraine invasion has really been the beginning of a cyber war between Russia and the rest of the world. I mean, we have seen attacks well before this. So based off of what we are used to seeing from Russian hackers as far as the playbook goes, I mean, where is the biggest risk? Is it among these large multinational corporates that Russia might have an interest in taking down? Or is it individual users and people's credit card accounts and maybe, you know, opening up ransomware by accident through an email?
Yeah, so the challenge is they can do all of it, and they can largely do all of that at the same time. That's one of the challenges with cyber. What I would anticipate seeing right now, I'll maybe divide it in a couple categories. One, in Ukraine, I think the likelihood of what we'll call tactical cyber operations aimed at suppressing Ukraine's ability to use the internet and other digital capabilities is likely to, I think that's going to increase and be real significant going forward. In addition, Russia has a tendency to use non-state hacking groups like the Revil or DarkSide ransomware groups as a way of just causing general havoc. Now, right now, these groups seem to be a little bit on a leash, and I think Putin is trying to manage the situation. He doesn't want to accidentally escalate this thing outside of Ukraine any further than he already has. But at whatever point he decides that he wants to reintroduce that friction into the system, it's available to him, and they can do a lot of damage, both to individual users and to corporate targets.
Can you explain a little bit deeper about just exactly how state sanctioned some of these groups are? I mean, you know, is it the form of an agency that's actually government run with a bunch of people and hackers that are doing this, or is it kind of informal relationships between the Russian government and some of these independent hackers to carry out this work?
So it's all of the above. A lot of individual hackers and even the groups themselves operate and even move along a spectrum of collaboration with the government. So take some of these ransomware syndicates. They will typically operate quite independent of the government, but with the government's unstated allowance. And, you know, Moscow sees their activities as one, just introducing friction into the system that they find politically advantageous. And then two, as kind of the cost of having those capabilities on call if and when the government ever needs them. And then occasionally they do. They call them, and when the government wants a veneer of deniability, they'll employ groups like that and have them go after specific targets. And then other times, as happened recently in the run-up to the invasion of Ukraine, a number of these ransomware hackers will be arrested and then subsequently employed by government services for their specific skill sets. So Russia has maximal freedom of movement in terms of how it leverages these capabilities, and has historically shown themselves to be very capable at doing this.
Now, obviously, the big focus is still on Ukraine, but let's say, for example, the Russians were to go after some large U.S. government website, for example. What types of capabilities does the United States have in countering that?
Well, in terms of countering, cybersecurity is an offensive game. It's impossible to defend against all of the risks, and the scale and the speed are all in the attacker's favor. So, in terms of what we can do, we do what's called active threat mitigation and active defense. That's where we proactively infiltrate our enemies' networks so that we can see them coming before they actually launch an attack. But those types of efforts are typically trained on the more sensitive systems. If we're just talking about government websites, public-facing websites, those aren't as big a priority. That being said, we have the ability to interrupt and shut down the technical infrastructure that a lot of these organizations use to attack us. But again, this is always a little bit of a cat and mouse game, because as quickly as you knock it down, they can typically set it back up. And so that's why you don't want to generally resolve yourself only to a defensive posture. If and when push comes to shove, the United States and its allies are going to go offensive, and that will be a much more expansive, aggressive posture than just trying to protect some websites.
All right, Klon Kitchen, American Enterprise Institute Senior Fellow. Thanks so much for stopping by Yahoo Finance this afternoon. All right, and the Dow is extending losses in another volatile day on Wall Street. Stocks are down 1.9% on the Dow Jones, at least over 600 points, with the S&P 500 down about 1.5%, Nasdaq down 1.33%. This coming as the XLF, again, that spider ETF covering specifically the big financial stocks, having its worst single day since June 2020. Again, this would cover some of the big bank stocks, and that's down about 3.75% just so far in this session. We'll continue to watch all of the market action as we get deeper into this trading session. But coming up on the other side of the break, Hollywood clamps down on Russia. We'll explain how companies like Disney and Warner Brothers are responding to the crisis in Ukraine next. Well, corporations are piling onto Russia as Disney and Warner Brothers now among the names targeting the country. They say they're going to pause their film releases in the country. For more on this, let's bring in Yahoo Finance's Alexandra Canal, who's been following the story. And, we were talking with Dave earlier about the importance of soft power with sports, and it looks like on the entertainment side, movies now in vogue as well. Tell us more.
Definitely, Brian. We're now seeing top media companies responding to the ongoing crisis in Ukraine. We have statements from Disney, Sony Pictures Entertainment, Warner Media, all confirming that they have paused theatrical releases in Russia, citing the invasion. And this comes as some pretty high-profile films are set to make their debuts over the next few days and weeks. For example, Disney's upcoming Pixar film, Turning Red, will not be available in Russia, despite a previous release date of March 10th. Disney is saying in a statement to Yahoo Finance, quote, "We will make future business decisions based on the evolving situation." Now, Disney was the first major studio to pause releases in the country, but Warner Brothers quickly followed suit just a few hours later, announcing that the Batman's release date will also be on pause. In addition, we heard from Sony, who will be pausing the upcoming release of Morbius, adding in a statement, quote, "Our thoughts and prayers are with all of those that have been impacted and hope this crisis will be resolved quickly." Now, if we take a look at the Russia theatrical market and the impact that it could have on Hollywood, it is certainly not as big as China or some of those other Asian markets when we're talking about the international box office. But all of that being said, it's still pretty significant. Last year, for example, Russia accounted for over $600 million in ticket sales, making up about 2.8% of the worldwide box office figure, which totaled $21.4 billion, according to Comscore data. In addition to that, Russia is a territory that ranks in the top 10 countries by year. It was ranked number 6 worldwide in 2021, 7th in 2020, and 9th in the pre-pandemic year of 2019. So we're seeing an upward trend there. So when you're talking about pausing films, delaying theatrical releases, especially coming off of the pandemic, it's always a financial risk of some sort. So this is a very bold move from these studios. They are choosing to stand in solidarity with Ukraine, and it's certainly sending a very strong message.
Certainly, Alexandra. And, I want to ask about Netflix here, because they're apparently refusing to comply with Russian rules that require them to carry some state-run channels on their service. If they don't do that, this is going to have some serious implications, won't it?
Yeah, this is very interesting. According to a new Russian broadcast law that was set to go into effect today, any media platform that reaches more than 100,000 subscribers in the country will be required to include as many as 20 free-to-air Russian state TV channels. Now, Netflix, which would fit that subscriber requirement, is refusing to comply with this law, saying in a statement, quote, "Given the current situation, we have no plans to add these channels to our service." Now, one of those channels in question is Channel 1, which reportedly has strong ties to the Kremlin. Another is SPAS, SPAS, which is operated by the Russian Orthodox Church. So a lot of these Russian state-run media outlets, which have been pushing the Putin agenda, spreading disinformation, those are the ones that are really in question here. Now, right now, despite Netflix not complying with this rule, it is still expected to continue to operate in the country. It's unclear at this time how it will plan to skirt past and avoid this new legislation and regulation, especially if the country decides to enforce it. But it is worth noting that Netflix's presence in Russia is still relatively new, launching in the country just over 1 year ago. Estimates place Russia's Netflix subscriber count at less than 1 million, but it's definitely still a region where Netflix wants to expand its footprint and continue that growth overseas. So this is just another example of how various U.S. businesses are making these quick decisions to limit operations in Russia. And I'm sure there are going to be more moves and developments with this, especially as the crisis in Ukraine continues to escalate.
Yeah, fascinating story. And I guess at least for right now, for the Netflix story, the ball back in Russia's court. But Yahoo Finance's Alexandra Canal, thanks so much for breaking all that down for us. Well, again, want to take a look at markets right now, kind of drifting from the session lows that we had seen closer to the beginning of this hour, but still red across the board, with the Dow Jones down almost 600 points. That's 1.75%. The S&P 500 down 1.33%, and the Nasdaq down 1.2%. We'll break down all the market action on the other side of this break. Welcome back to Yahoo Finance. Again, all attention still fixated on the equities markets as we do see red across the board with some financial stocks seeing 5 going on 6% declines in intraday trading. Let's head over to Yahoo Finance's Jared Blickery, who's got the breakdown of all of the market action again as the losses from this morning really spill over. Jared?
Yes, they are, Brian. And let's take a look at the S&P 500. You can see everything in the red now, down more than 1%. Russell 2000 down the most, down nearly 1.9%. Here is a year-to-date view of the S&P 500. I've been showing this chart since the beginning of February, and we got another sell-off right where markets would have expected it at the very lowest ideal point. So this is just saying the short sellers, the bears, are still firmly in control of this market. Now, we haven't broken down below Friday's low meaningfully just yet, but we do have this low to contend with, and if we keep reacting negatively to those price headlines, or excuse me, to those headlines, price is probably going to take another leg lower. Nevertheless, a lot of people on Wall Street, analyst notes, kind of debating, is it time to buy the dip? Is it the all clear? And I'm getting conflicting reports on both sides there. So not any kind of consensus emerging on Wall Street. Energy, the only sector in the green, up 0.6%. WTI holding firmly over $100 per barrel, and Brent, I believe, hit 105, 106. It's just incredible, the price moves. To the downside, financials taking it on the chin here the most, down 3.5%. That's a really big move for this group, the biggest move, I believe, to the downside in months, if not a year. Materials also flagging down more than 2%, and industrials and tech behind. Those round out the underperformers. Now, I want to take a look at the VIX, the fear index, because there is an elevated amount of fear in the market. Once again, we see it steadily marching higher here. All these sell-offs, or I guess you wouldn't call it a sell-off, but all these downdrafts here being met at that support line. Also want to take a look at what's happening in the bond market, and that really informs what's happening with the financials and the hits that those stocks are taking. These are just some huge moves we're looking at right here in terms of the 5-year. That's down to 1.58%. Haven't seen this level since late January. 10-year T-note, pretty similar story, and actually the lowest since we've seen in probably this year or close to the beginning of January. 30-year, that is down 6 basis points, so the yield curve flattening once again. Now, here's the U.S. dollar index. This is surging, possibly based on a potentially more hawkish Fed. Kind of difficult to read all these price movements and interpret exactly what they mean in terms of all these dynamics we have going on, not only the Fed, but also Ukraine and earnings. Thank goodness some of those are rolling off as well. I want to take a look at the Nasdaq 100 heat map. We see a lot of red, just a little bit of dark red, so it's not a disaster just yet. You can see the mega caps, which theoretically should benefit from a flight into them due to those lowering of yields, really not taking much of an advantage here. Nvidia down 3.5%, chip stocks flagging a little bit, and not a whole lot of green except for that energy space that we've been looking at.
Yeah, one interpretation that lower bond yields means that maybe markets are doubting the ability of the Federal Reserve to raise interest rates, which would have otherwise been good for the banks. Yahoo Finance's Jared Blickery. Thanks so much. Coming up, goodbye to your pay raise and maybe hello to some more vacation time. We'll reveal the way that companies are getting a bit creative in keeping their employees. That's just ahead. High turnover rates and rising inflation have companies looking to work perks as incentives to keep employees put instead of salary boosts. Joining us to discuss more is Yahoo Finance's Danny Romero. And, this is a very interesting trend that kind of speaks to the overall power that workers have in this labor market, Danny. But at the same time, if you get some free pretzels at work, is that really going to make up for being paid $10,000 less?
I wouldn't say that quite yet, but like you said, high inflation and high turnover, many companies are looking to offer these perks, such as more vacation days, as well as work from home options as a way to limit hiking up those salaries, because once those salaries go up, they rarely go down. So some employers, have actually, invested in increasing wages as well as benefits, but other employers are really resisting that salary hike. Let's just take a look at a survey by Gartner, which shows that just over a third of all organizations said they plan to adjust compensation to account for inflation, with 13% saying they plan to do so for all employees. Now, corporate spending has accelerated within the last year, but those adjustments haven't been keeping up with the pace of inflation and those rising costs of living. For those who have been in the same role for over a year, their wage has increased to 5.9% compared to 7% inflation. Companies are hoping those extra vacation days will boost their reputation and keep those workers on board. Companies are benchmarking their employee salaries to their competitors. Also, some surveys even show that employees are they prefer more flexible work hours than pay. For example, at Elf Cosmetics, they increased salaries by a low single-digit percentage, which would that reflects higher costs of living. And an economist at the Pearson Institute for International Economics, he said that companies over time will likely have to raise those salaries to go along with these high costs of living, but it's still unclear when those will happen and at what time. But also another thing to consider is that boosting salaries is really expensive for companies, so companies will have to take into consideration the risk of employee turnover. Brian?
Yeah, absolutely, Danny. I mean, the question here is whether or not keeping an employee with higher pay is also going to negate what is also rising costs, even if you do have some of those work perks, which are getting more expensive. Yahoo Finance's Danny Romero, thanks so much for breaking all that down for us. Well, again, taking a quick look at markets before we say goodbye at the end of this 12 p.m. hour here on the East Coast. When you take a look at the Dow, now down 1.75%, with the S&P 500 down 1.3% and the Nasdaq down 1%. Again, crude oil massively rising, up about $8.50 to $104 a barrel. The 10-year bond, massive movement in a single day, down 12 basis points to 172 basis points. But again, that does it for me in the 11 to 1 hours. Alexis Christoforous and Karina Mitchell have you for the next two. We'll see you tomorrow.
spoken to her.
Okay. Hi, Jean. Welcome to A Time for Change. I'm Anjali Kimlani here with Alexis Christoforous. We kick off Women's History Month by taking stock the Yahoo Finance way with money. Though we've made strides, women continue to lag far behind men when it comes to pay. Pew Research showed in 2020 that women continue to earn 84% of what men earn on average, and it would take an additional 42 days of working to earn what men earn in 1 year.
But speaking of pay, we've got a roundup of some very high earners, Black women, who have shattered the glass ceiling by doing things their own way. In honor of Women's History Month, here's a look at some of the richest self-made Black women in the world, and they're changing the business landscape. We begin with media mogul Oprah Winfrey, who has a net worth of about $2.6 billion. Her empire includes TV network OWN, Oprah Magazine, and a multi-year deal with Apple TV+. Also, artist and entrepreneur Rihanna's net worth is reportedly more than $1.7 billion. Her business venture, Fenty Beauty, valued at $2.8 billion, and she's got a 50% ownership, while her lingerie line is worth an estimated $270 million. Now, not a household name yet, but BET Network co-founder Sheila Johnson has a net worth close to $750 million. Johnson launched the network back in 1979 and sold off her shares when Viacom bought BET in 2001. She used that money to invest in property like Palm Harbor, Florida, which hosts the annual PGA Tour. Beyonce, well, she's got a net worth of more than $500 million, with a majority of her fortune earned from album sales, also touring, and of course, her clothing company, Ivy Park. And tennis star Serena Williams checks in with a net worth of $225 million, with earnings from her VC firm, Serena Ventures, a clothing line, and a stake in the NFL's Miami Dolphins, not to mention, of course, the millions she earned in tennis prize money. A very, very impressive lineup. Coming up, a trailblazer who's trying to reduce single-use plastic. We're back with more of a Time for Change right after this. Welcome back to A Time for Change. On this first day of Women's History Month, our focus is on female change makers, women who are pushing boundaries in business and beyond. Our first guest is the CEO and co-founder of Blueland. Now, that's a company aimed at reducing single-use plastic by offering cleaning products and hand soap that come in tablet form and use refillable glass bottles and metal containers.
It sounds simple enough, but the idea was actually revolutionary, and getting the business off the ground took incredible determination. Sarah Paigiu is Blueland co-founder and CEO. Sarah, thank you so much for joining us today. Pleasure to have you on.
Thank you so much for having me on.
I want to begin with just starting off with why. Why cleaning products to reduce plastic, and which was harder, the science of making tablets or the art of raising money?
It was all actually quite difficult. But I mean, to start with your first question, in terms of the why, cleaning products and why packaging, when I realized just how massive the plastic pollution problem was and what a contributor it also is to climate change, I looked into plastic production and realized that about 40% of plastic production actually goes towards packaging, which is such a shame because packaging is essentially used once and then discarded. And so from that point in time, I was very focused on how I could figure out a way to create products that could use less packaging and see if there was a way to eliminate plastic packaging, and ended up starting with cleaning products because, one day I was looking at the cleaning sprays that we use at home and I looked at it and I was like, that looks like it's mostly water. And when I researched it further, that ended up being the case, that about 90% of what makes up a cleaning spray, or a typical multi-surface cleaner or glass and mirror cleaner, is water. And so, my first thought was like, wow, why don't we eliminate that water and create a dry tablet that could be packaged in paper instead of plastic? And so that when people need more cleaning spray, instead of buying a new plastic bottle each time filled with water, they could just reuse a bottle they have at home, drop in a tablet, and add their own water from home as well.
Well, Sarah, I want to ask you the second part of Anjali's question again, and that is about raising money, because we know that something like 84% of venture fund money goes to companies founded by men only. You recently closed a $20 million Series B funding round. Tell us how you're beating the odds.
Yeah, it certainly has not been easy. And I think, a lot of people look at the Blue Land store and it's like, wow, you were able to raise this capital. It seems like you were able to raise this capital quite quickly. And what a lot of people don't realize is that, one, I've been a serial entrepreneur for over a decade. I've launched 4 businesses prior to Blue Land. I've raised venture capital in the past. So it really has been, over 10 years of building out that network with venture capital investors, with angel investors, that has, their confidence in me was not built overnight. It was years of getting to know each other, as well as years of creating a proven track record. Additionally, when you look at the Blue Land story, as much as we've been live on the market for just 2.5 years, what they don't see is my co-founder and I have been working on Blue Land for almost 5 years. To your question of what was harder, raising the money or creating the product, honestly, both were incredibly difficult. But on the product side of the world, it took us over 2 years to bring these revolutionary formats to market. What we were trying to do had simply never been done before. Blue Land is the first company to launch cleaning tablets, to truly create cleaning tablets across a range of categories, from hand soap to cleaning sprays to laundry, et cetera. And that certainly was also a quite long and difficult journey.
Certainly the behind the scenes is something we know takes a long time, right? I want to talk to you though about your position. Not only are you a female founder, but you're also Asian. And I just wonder, can you share if there's been, any incidents that you've experienced either when raising funding or just generally trying to market your company, considering the recent uptick we've seen in hate crimes against Asians?
Yeah, unfortunately, I have seen my background come into play. It's interesting because Blue Land, certainly was born out of my identities as a woman, as an environmentalist, but, founding of Blue Land had nothing to do with my being an Asian American woman. That said, I would say in the past 1.5 years, my Asianness has become inextricably tied to the identity of the company. It's interesting because I think even before, hashtag Stop Asian Hate and a lot of the more recent media coverage around what's happening, we started to see it on the business side quite early. When the pandemic first landed here in the US in 2020, and our president there at the time was talking a lot about referring to the virus as like the China virus or Kung flu. We then saw a lot of this anti-Asian sentiment manifested in a lot of the customer inquiries that we were getting into our inboxes, comments that we were getting on social media. With our brand Blue Land, as still a smaller brand, I myself as the founder am out there a lot, sharing our story, sharing our founding story, and very much so a face of the brand. And I think over the past 1.5 years, it has been hard to really see a lot of the backlash to who I am and my background. You know, we've received almost 2,000 comments referring to, you know, our products or, you know, myself being, you know, called a chink, which was just quite hurtful and hard to see. But we've also had a lot of backlash from consumers who really criticize us for, you know, some of our bottles, for example, are manufactured in China. And we've gotten a lot of commentary on, you know, oh, figured that it's made in China, I'm not going to purchase with your brand. And the irony of that being, you know, you get that email and it says sent from my iPhone. And, you know, iPhones are also manufactured in China, as are many brands like Patagonia, Dove, and Apple that are known for their quality, their safety, and certainly their ethics. But I think what's made it different for us is that, you know, we have a founder, myself, that is an Asian American.
You know, Sarah, obviously this is an emotional topic for you. I know that for a little while you even you were toying with the idea of not being the face of your brand. How are you, I mean, we only have about 35 seconds left, but how are you handling some of this criticism and hate coming your way?
Yeah, I think, you know, ultimately Blue Land is about not just from an environmental perspective, trying to make a change and build the future that we want to see, but in so many other ways as well. And so, you know, we really have been using the Blue Land platform to also take a stand on issues like this. You know, we've made multiple statements on Stop Asian Hate. We've supported organizations that are doing good work to combat, you know, the rise in Asian hate that we've seen. And I think, you know, we want to continue to stay true to our values and really leverage the fact that we do have a platform and we also have so many customers and community members who are very supportive of these values that we espouse. So, you know, while it may be easier to sort of like take a step back, to be a bit more quiet, you know, we're actually, you know, fully leaning in and sort of more than ever are feeling excited about really trying to make a change in the world in so many respects.
Absolutely. Well, we hope that you continue to have the strength to fight that. Sarah Paigiu, Blue Land co-founder and CEO, thank you so much for being here. Coming up, a working mom of another kind, the most decorated Black athlete ever in the Winter Olympics, what it took to get there, and what's next. Welcome back to A Time for Change. She's the most decorated Black athlete ever in the Winter Olympics. Alana Myers-Taylor has won 5 Olympic medals in bobsledding, but it's what she's done off the track that may leave the biggest legacy. Speaking out about racism in bobsledding, fighting for better support for women and people of color in all sports, and advocating for her adorable 2-year-old son Nico, who was born prematurely and diagnosed with Down syndrome.
All right, that's a lot to get to, but we're going to try to do it all. Alana, thanks so much for joining us here on A Time for Change. Good to see you.
Good to see you all too. Thanks for having me.
I want to start with what you did at these Olympic Games in Beijing, making history. This really gives you a unique platform now, Alana. What do you hope to do with that platform?
Oh, wow. Yeah, the Beijing Games were pretty crazy. Right now, I really want to encourage more people to get out in winter sport, more people of all races, not just Black. Setting this historic accomplishment was pretty cool, but I want to show the world that winter sport is for everyone.
Absolutely. Racism is something we've seen addressed in bobsledding, like in Hollywood and Cool Runnings, but more to reality, it persists today despite the achievements of other races and groups and countries. Tell us why you think this is so.
Yeah, in bobsled, winter sport has tended to be what we call as white as the snow. It's very one-dimensional, and people still have some backwards ideas about who winter sport is actually for. So in my case, they're sled builders. Bobsleds are very technological things. They don't look like it, but everybody in the world has access to certain bobsleds, except some bobsled manufacturers won't even sell to people based off of the color of their skin. So we're still fighting racism within sport landscape. And I think that's just a microcosm of the greater world. If sport can get things right, it has hope for the greater world. And we're still working within winter sport to get it right.
Now, I want to switch gears for a minute because you are a mom, first and foremost, very dedicated to your son, Nico. It's my understanding that you actually brought him to the games so that you could continue to breastfeed. Talk to me a little bit about how being a parent has sort of changed you as an athlete, and how are you working to make elite competition, I guess, more mom friendly?
Yeah, so the IOC has a rule that if you're breastfeeding, you can travel and continue to care for your kids while you're at the Olympics. So even within the pandemic, we were able to take my son Nico with us, which was a huge blessing. And we just thought that it was right for us as a family to continue breastfeeding as long as possible. But the biggest thing for me is I just want women to have the option to be able to continue competing and have a family. And more so, I want them to be able to make those choices, whether they want a family or not. Right now, historically in sport, women are told if you want to start a family, you have to retire. Well, hopefully by me getting out there and other female athletes, Allison Felix, Alicia Montano, a slew of other athletes getting out there and continuing to compete, we can show that women can still be successful, athletic, and be mothers as well.
I love the videos we're seeing here of you with Nico. We know he was born prematurely during the pandemic. He'd been diagnosed with Down syndrome. What work are you doing, maybe with the Paralympics and folks to I guess better serve people with special needs?
So during the Olympics, I was actually named the opening ceremony flag bearer. I wasn't able to walk because I was diagnosed with COVID. But during that time, I actually auctioned off my opening ceremony jacket to support the National Down Syndrome Society. And since then, one of my partners, Bridgestone, has actually agreed to match that donation and double it. So we're raising quite a bit of money right now for the National Down Syndrome Society and continuing to do as much work as I can in the area to just raise awareness first and then hopefully progress on some other goals afterwards.
You said, I want to talk about also, from another perspective, not just a mom, but of course, as a woman, we know that in many parts of the world, women face, bigger obstacles in getting into sports, in getting, in particular, into the Olympics and finding that support. I wonder, what do you have to say about the fact that it takes just so much more energy, so much more passion, and so much more work and training to get into the Olympics? And where does the change really need to come from to help ease that?
Yeah, I think the change has to start from the top. We have to get people who are in charge of sporting organization realizing what valuable assets women bring to sport. I mean, if you look at some of the performances of this past games, you'll see that some of the most incredible performances were actually from women. Some of the things, the women's monobob event was the most watched television event of the Olympics. So female athletes can draw an audience. There's money to be had in female sports. And I think it's first up to the larger governing bodies to understand that. And second, to encourage that sporting level all the way down. And from an athlete perspective, we know that women who participate in sports are more likely to end up in the C-level, in the C-suite. So we want to encourage women from all ages to continue to participate and to get into sports.
You talk about money being made. I know that the medals at the Olympics can sometimes be business opportunities for the athletes who have won them. What are you doing, if anything, to sort of monetize what happened for you at these Winter Games? And I'd have to imagine companies are approaching you for endorsements. Can you share any news with us?
Yeah, so fortunately, I've had a couple companies that I'm working with now, Salesforce, Bridgestone, Comcast. They've been my partners for a while, but we're continuing to expand that because as athletes, we, as U.S. athletes, we receive no government funding. So our only way of making a living is through a little bit of prize money, and bobsled has next to no prize money. It's very minor. It's usually just to pay for bobsled expenses. And then the other way is through sponsorships and through deals and different endorsements. So the other thing that I do, I go on speaking engagements and work with different companies just to try and continue to progress in my career and continue to fund my career.
Last question to you. I know you are 37. That's a youngin' in regular life, not so much so for athletes. Are we going to see you at the 2026 Games in Italy?
I'll definitely be there in one capacity. Whether it'll be as an athlete, I'm not quite sure yet. I'm just going to take it year by year right now and see where it goes. I still love the sport of bobsled. I still love driving my sled. And I've always said, as long as I love it, I can keep competing. So we'll see what happens. No decisions made yet.
All right. We love seeing you do it, though. 5-time Olympic medalist and Nico's one and only mom, Alana Myers-Taylor. Thanks so much for being with us. And we want to be sure that you tune into Yahoo Finance 1 week from today, March 8th. It's International Women's Day. And for 8 straight hours of live coverage, all of our guests are going to be women. That's going to do it for our show. For myself and Anjali Kamlani, thanks so much for being with us. But don't go anywhere. A lot of news going on today. We're going to bring you the latest on Russia's war with Ukraine and the market's aggressive reaction, including oil rallying to a 10-year high. We're back right after this.
The market sell-off intensifies as Ukraine heads towards a more punishing phase of war. That as a 40-mile Russian military convoy closes on Kyiv. The West increasing sanctions and a growing list of corporations cut ties with Moscow. And as President Biden gets ready to deliver his State of the Union, is Russian energy next on the chopping block as the IEA agrees to release 60 million barrels of oil from its stockpiles. Crypto has been trading like a risk asset rather than a hedge, but not lately. Since the crisis in Ukraine, Bitcoin has skyrocketed. Is it a way to skirt financial sanctions being slapped on Russia, Putin, and its oligarchs? And as tensions escalate to a boiling point, what is being done to protect our government and business infrastructure from being taken out by potential cybersecurity threats? Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christoforous. Alexis, it is an ugly day in the equity space. A flight to bonds, commodities, and oil popping. The ISM read is up, all as President Biden gets set to deliver his State of the Union to us tonight. It's going to be interesting.
Yeah, all eyes are going to be on that. You can bet investors are going to be reacting to that State of the Union in the futures market. But in the here and now, we have got the major stock indexes now at their worst levels of the day as Russia steps up its war against Ukraine. That war now in its sixth day. The Dow Jones Industrial Average tumbling 759 points. The S&P 500 down about 82. And the Nasdaq, which, by the way, was positive earlier today, giving back all of those gains and then some, now down 230 points, or a loss there of nearly 2%. In the bond market, as to be expected on a day like this, yields are tumbling as investors flock to the relative safety of treasuries. Remember when the 10-year yield, Karina, was at like 2% not too long ago? It is now at 1.71%. We have the yield on the 30-year dipping to 2.11%. But I think the real story of the day is oil, now touching an 8-year high. Earlier, it had briefly touched a 10-year high. The U.S. and its allies have agreed on the release of about 60 million barrels of oil from their strategic emergency stockpiles. They're looking to send a strong message here to the oil markets that there will be no shortfall in supplies as a result of Russia's war with Ukraine. WTI crude now nearing $105 a barrel. And what we've seen for the past couple of weeks, we were talking about it recently, was cryptocurrencies were moving in tandem, sort of in lockstep with stocks. Not the case today, as you can see. Investors piling into cryptos as those Western sanctions against Russia make the use case for a decentralized channel for finance. Some analysts now saying that $50,000 is the next resistance level for Bitcoin. By the way, ECB President Christine Lagarde calling for regulation to prevent Russians from evading sanctions by using crypto. Want to check in with Yahoo Finance's Ines Ferre now, live for us at the Nasdaq for a look at some of the big movers there. Quite the whipsawed session for the Nasdaq, Ines.
That's right, Alexis. And you mentioned the 10-year Treasury yield falling. Well, that's not boding well for financials. In fact, take a look at our sector action right now on our Wi-Fi interactive board. All 11 sectors of the S&P 500 being in the red. But the one that is losing the most right now is XLF Financials, having its worst day since June of 2020. In fact, I'm going to pull up the bank stocks right now so you can see kind of the red across the screen, the deep red across the screen on these bank names that are under pressure today. I want to mention commodities because you mentioned oil. It's worth hitting again to see where this price action is. With WTI, take a look at this. Touching earlier, $105 a barrel. You've got WTI up more than 9.5% right now. You've got Brent crude up above $106 a barrel, up more than 8.5%. This is despite the IEA, the International Energy Agency, announcing the release of 60 million barrels from emergency reserves. So what this is telling us is that markets, traders do see some type of disruption perhaps in oil coming from Russia. That's why you're seeing oil prices higher, part of the reason. Taking a look also at the rest of commodities. We're looking at gold up more than 2%. We've got silver up more than 5% right now. Copper futures are up. Palladium up more than 2%. And I just want to mention some agricultural futures as well. Corn up more than 5%. Ukraine is a big corn producer, exports to China as well. Also taking a look at wheat futures, up more than 5%. Ukraine and Russia, both big wheat producers. And in fact, earlier I just spoke with an agricultural commodities trader. He was telling me, look, so much of this has to do with the ongoing Russian invasion in Ukraine. He said, but this is also about inflationary pressures that we're seeing and money flowing into commodities, into exposure into tangible goods, something that we had seen before even this Russian invasion. So this is only adding to these future prices. Alexis,
okay,
Karina?
thank you. Okay, thank you so much, Arnez Beret, for that report. There is a lot going on in the markets. Let's bring in our next guest, Brian Jacobson, Senior Investment Strategist from Allspring Global Investments. Brian, thanks so much for joining us today. What's that saying? The curse is we live in interesting times. It's definitely interesting times in the markets right now. So much to talk about. I think I want to start with, the news that the IEA will release those 60 million barrels, half of it coming from the U.S. That's equivalent to about 6 days of Russian output. So how significant is that? Your thoughts? And then I'm also interested what you think will happen. OPEC is meeting right now. Do you think that they turn on the taps?
Yeah, it'll be interesting to see what exactly happens. The U.S. or the IEA's announcement, I don't think took a lot of people by surprise. I know that it's been floated by a lot of people about whether or not there would be this release from the strategic reserve. And the problem with these strategic reserves is it's a finite amount that's in the grounds or in the pipelines and the such. And as you pointed out, it really won't make up for if there's any fall off of supply coming out of Russia. I mean, maybe it can offset about 6 days worth of production, but that's not really a lot. What could really help is if OPEC stepped up and decided that they'll increase output. They're scheduled to meet tomorrow. The technical report that they released today indicated that they might not want to. And so I think that might be more what the market is reacting to, is the technical report showed that as far as the amount of oversupply that they kind of model is suggesting that that's getting a little bit, the market is still kind of out of balance, too much supply relative to demand, despite the fact that we see these really high prices. And so going into the meeting for tomorrow, it doesn't look like they're going to open the spigots, but I think that could actually be the surprise, is that from a political perspective, they could really win some massive brownie points here with the West and the rest of the civilized world if they decided to try to stick it to Russia by actually allowing that oil to flow. Now, the only one who can really do that probably is Saudi Arabia, who is a U.S. ally.
Yeah, it'll be very interesting to see what comes out of that meeting. We hear more about it tomorrow. I want to just get your reaction to, how the markets are pricing this crisis at the moment, because historically these geopolitical risks are looked at as being short-lived. Is that the sense here, or do you think that there is now this shift based on all the aggression that we're seeing from Russia, that this could turn into something that is much bigger and could be protracted?
Yeah, looking at the futures market, which I like to look at as far as kind of an indicator about what people might be pricing in. Say, for example, the oil market, you look at the current price is really high, so the spot price. But when you look out as far as along the curve, so kind of going out in time, prices are a lot lower. So it seems to me that if you look at the oil market and the wheat market, those are probably the bellwethers in this market as far as the sentiment around what's going to happen as far as the duration of this. It still looks like it could be fairly short-lived. Now, the problem is, does short-lived mean a matter of days, weeks, or months? Our expectation is that this could draw out for a while, for at least a month. And that has, I think, a lot of investors just kind of deciding, should I sell? Do I buy on the dips? Or do I just kind of ride this out? We're tending to do a little of both, which is ride it out with a core portfolio that's well diversified, but then don't be afraid to trade around the edges to try to take advantage of days in which there's optimism that things will resolve. You see assets rally, but then to also be willing to buy on the dips when things look their darkest.
So then it sounds like you are risk on at the moment. So I'm wondering, where do your allocations go? What are you looking at, particularly energy and commodities, and then big tech as well?
Yeah, so on those two specific ones, we're actually thinking that this is an environment where we want to try to fade the rallies in commodities, an expectation that we're going to get a bit of a pullback over the longer term, but then actually allocate more towards those big cash cows in technology. We think that that's actually an area that we want to add more to the portfolio. They were the high flyers of last year, but they did show a lot of resilience as far as their profit margins in the face of high inflation. So we actually view technology as being a fairly decent longer term play from a valuation perspective.
All right, we will leave it there. Thank you so much, Brian Jacobson, Senior Investment Strategist from Allsprings Global Investment. Thanks for your time today. And we want to step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. And you can check it out today at yahoofinance.com/plus. Alexis, what else is coming up?
Oh, we've got a lot coming up, Karina. Ukraine now facing a more brutal form of war with Russia. We've got an update next. Welcome back, everybody. Russia has stepped up its assault on Ukraine, now targeting civilian areas in the capital of Kyiv to demoralize the Ukrainian resistance. A United Nations agency reports more than 100 civilian deaths, but said the actual number of casualties could be much higher. Joining me now is Robert Person, Associate Professor of International Relations at the U.S. Military Academy at West Point. Professor, thanks so much for being with us. We know that President Putin would have us believe that his motivation for invading Ukraine is that the country was taking steps to become a member of NATO. I know you wrote an article recently for the Journal of Democracy debunking that theory. What do you believe is moving Putin? What is he truly afraid of?
I think first and foremost, Putin is afraid of his own people. I think his number one objective is and always has been to retain his hold on power. I think he's also threatened by democracy in the countries that surround him, because those countries like Ukraine that have managed to develop a vibrant, thriving democracy in Russia's shadow, set an example for his own countrymen, and an example that threatens him. And so I think we have seen his position harden and grow ever more extreme as those countries have attempted to break away and set their own course in democratic Western European politics.
Ceasefire negotiations are expected to resume in the coming days. I don't even know if Ukraine NATO membership is on the table anymore, but if Ukraine were to tell Putin that is off the table, we absolutely will not try to join NATO, would that be enough to have him pull out?
I think it's hard to predict right now, certainly what Putin is thinking and what he is planning. I should mention that these are all my personal views. They don't represent official policy of the government. But my sense is that really from day one and going much farther back, Putin's objective in Ukraine has been regime change. Again, he cannot tolerate the idea of Ukraine leaving Russia's orbit and orienting itself towards the West. And so I think his objective has been to go in, attempt to encircle Kiev, as we are seeing that drive right now, and ultimately force the Zelensky government out of power through violent means if necessary. So at this point, I'm not sure that this conflict can necessarily be resolved by taking NATO membership off the table or Ukraine's cooperation with the United States off the table. I think Putin ultimately wants much, much more than that, and we'll see how far he's willing to go to get it.
Ukraine's President Zelensky applied for Ukraine to be part of the European Union. You know, the last time the EU welcomed a new member was Croatia, right? That was back in 2013, and it took them about a decade of negotiations. Is that even realistic? Might the EU actually fast track Ukraine?
I'm not sure it's realistic in the short term. Again, it's a very lengthy process. It's a very technical process to bring the national laws and regulations and standards of an aspirant member in line with EU requirements. Now, that's a process that has begun with Ukraine signing an association agreement with the European Union, which happened under President Petro Poroshenko a few years back. So they have been moving in that direction, but it really would be an extraordinary and unprecedented move for the European Union to sort of waive that process or accelerate it to bring Ukraine into the bloc right now.
Mm-hmm. Professor, there were reports that the EU would supply $500 million of arms, including some fighter jets, to Ukraine. There was a report today, a reporter from Politico, who's on the ground there, said that Europe will now not transfer fighter planes to Ukraine. Why do you think the about face, and what are the implications there?
I think, we do have to be concerned about some escalation risk. Obviously, the West, NATO, our European partners are putting extraordinary pressure on Russia right now through a variety of means, economically and through the direct military support of the Ukrainian military, to include weapons sales. I suspect that there may be a sense, and here this is just me sort of drawing some inferences and speculating, but I suspect that there may be a sense that a move of providing much more significant weaponry like fighter jets could be taken as an escalatory move that might risk dragging a NATO ally more directly into the conflict than we really want to contemplate right now.
Like Poland, I know, which was actually thinking about giving some of those arms and is a NATO member. President Biden yesterday, when asked by a reporter, said that Americans should not fear Russia's invasion of Ukraine developing into a global nuclear war, despite the fact that Moscow is putting its nuclear forces on high alert after those harsh U.S. sanctions. What are your thoughts on that? I'm sure we'll hear more from the president tonight during a State of the Union.
Yeah, and certainly the president will have, I think, some important updates and perspectives to share with the country and with the world tonight. So we'll keep our eyes on that. I mean, I think, fundamentally, Putin, he is a risk taker, but he is, in my assessment, still a rational actor. He is obviously gambling. I think that gambling has largely failed in Ukraine right now, but he's been extraordinarily consistent in his pursuit of his political goals in Ukraine over the last really nearly decade plus. And so I think that these threats that we're hearing, certainly are part of an escalatory pattern. He hopes that Ukraine supporters internationally will be afraid and will back down. But I think ultimately he understands that direct military conflict between Russia and between the NATO alliance it would unleash devastation that we can hardly imagine. And so, I do believe in the very powerful deterrent effect of that threat and the deterrent effect of a united NATO alliance.
Well, one thing we have learned, I think, is that never underestimate, Vladimir Putin. Robert Person, U.S. Military Academy Associate Professor of International Relations. Thanks so much for your insights today. Want to get you all another check of the markets with a live picture of the big board right now because the sell-off has been aggressive all day. The Dow Jones Industrial Average now down more than 700 points. Nasdaq off more than 2%. And oil sprinting higher now at an 8-year high. Karina?
Okay, and despite that sell-off, crypto going the opposite direction. It's been a big winner in the Russia conflict so far. What's behind that rise? We'll take a look at that next. Welcome back. Well, the crypto market continues to surge as Bitcoin tops 43,000. With more, let's bring in our Yahoo Finance's David Hollerith. David, so this is a big about-face. Crypto moving away from its lockstep with risk assets as the Ukraine crisis escalates. Why is that?
Yeah, it's never easy to tell, especially in the short term, just sort of what we've seen over the last day and the weekend. And obviously, a quick differentiator between crypto and the stock market is that crypto trades over the weekend. So, sometimes you'll see cryptocurrencies do something that the stock market might do. It might be a leading indicator. But just to go back a little bit, so since September of last year, there's been an increasing correlation between cryptocurrencies, especially Bitcoin, and risk on assets like stocks. Now, so we've seen that, and it's kind of the understanding has been that macroeconomic forces, especially the Federal Reserve, has sort of made a lot of investors sort of act the same. There's more stock investors who own cryptocurrencies and vice versa. Now, what we saw yesterday is still tough to call because it's in the short term, but it's a break in the correlation. And if you can see from the chart, it's just at the very end, there's a dip. And that tick downward is the break in correlation between the S&P 500 and Bitcoin. And so what many analysts are paying attention to is whether or not that's going to continue over the next couple of days. Now, an obvious contributor that people are pointing to right now is the Ukrainian and Russian crisis, which on both sides of the conflict, there have been reports anecdotally and also in terms of exchange volume from data from exchange volume in those countries, that cryptocurrency is sort of seeing higher trading action. So while we can't prove out what's happening right now, the break in correlation signals something that could be potentially much bigger for crypto assets.
So, David, what are analysts thinking will happen if this trend continues? I saw one analyst saying that $50,000 could be the new support level for Bitcoin.
Yeah, price targets, I think, are a tough one to call in this case because it doesn't necessarily what's being looked at. The correlation doesn't necessarily dictate demand. I mean, now given the current direction, that could be something someone would assume. But the point here is that the break in correlation means that the performance of crypto assets will no longer necessarily be dictated by the same rules that are sort of defining the stock market. So that's kind of interesting in the sense that cryptocurrencies, most investors who own them sort of think of them as a diversification tool or something like that. So we haven't seen that since so many institutions have sort of bought into the asset class. And that's what you want to see in general when people are considering it as a diversification strategy. So in terms of the long-term outlook, this could be a pretty good thing for people who are positive on cryptocurrencies.
Okay, David Hollerith, thank you so much, and we'll see you back here in the next hour with a special crypto panel. Alexis?
That's right. I was just going to say, David's going to be hosting that panel. They're going to also be talking about pending regulation that could be coming to the crypto markets. Much more on market reaction to the war in Ukraine right after this. Welcome back to Yahoo Finance Live, everyone. It is 2 p.m. here on the East Coast. I'm Alexis Christoforous along with Karina Mitchell. Stocks are sliding, bond yields are slipping, and oil jumping to an 8-year high as Russia's war with Ukraine continues to whipsaw the markets. The Dow slightly off its worst level of the session, believe it or not, still down 711 points. The S&P down 76, and the Nasdaq giving back another 200 plus points. As you can imagine, as investors exit equities, they are piling into the Treasury market. We are seeing yields moving in opposite direction to prices for bonds as they do. The yield on the 10-year now at 1.69%, with the yield on the 30-year at 2.09%. Want to check in with Jared Blickery for a look at what's trending today. And Jared, financials having the worst day in about 2 years amid this crash we're seeing over in bond yields. And at least one firm today, I know Morgan Stanley, saying now's a good time to get into financials.
Yeah, it depends on who you turn to on Wall Street. I'm seeing a lot of differing opinions about exactly what to do and how to handle these markets. Not surprisingly, there are so many unknowns. I was reading a Goldman Sachs note earlier today, and they had some interesting views on what's going to happen with bond yields. I'll get to that in a second. The carnage you're seeing here in these bank stocks, with JP Morgan down 5%, Wells Fargo down nearly 6%, largely due to the volatility in yields. Today, yields are crashing to the downside, as you were talking about, Alexis. And I just want to show the 5-year T-note yield. It is down 19 basis points. I got to check. I don't remember the last time it was down that much, but that is certainly what we would consider crash levels. And then you take a look at the 10-year T-note yield. That is down 15 basis points, a little bit less. And the 30-year, that is down, looks like 9 basis points. So overall, the yield curve actually expanding, steepening, but that's only because the shorter term yields are crashing faster than the longer term yields. And we can also see this playing out in the volatility markets. Here's the VIX. This is equities. We can see marching back up to these highs that we've seen. This spike high over here, which was rejected, that was concurrent with that big sell-off we saw in late January that kind of scared everybody out of the markets. Well, guess what? We are just inching, if not surging, higher to those prior levels. So let me just take it back to the financial sector. As you said, usually don't see these big of moves in a lot of these stocks. Here's JP Morgan. It was only, I believe, the third quarter, early fourth quarter last year that we were looking at record highs in this stock. And what a reversal of fortunes. I believe this was it right here in the transition to the third and fourth quarters. So really seeing a lot of carnage in the markets. But today it is focused on those financials.
Yeah, financials really getting beaten up today. On the flip side, Target jumping by the most since 2019 after saying it can keep the growth going.
That's right. And a number of things working for Target this quarter. First of all, fourth quarter adjusted EPS, that was a beat. Full year earnings guidance, that was a beat. And finally, their margin concerns. There was a lot of concern over that over the last year or 2 years, for that matter. Those are dwindling as well. Also want to note that they announced a $5 billion investment in their stores. They're going to build 30 more stores in 2022. And that is going to continue, that $5 billion investment over the next few years. So let me pull up a stock chart here. You see Target up 10%. This is a stock that petered out in mid to late last year, along with a lot of other names. And if you take a look at the 3-year chart here, still pretty impressive price action. This was Yahoo Finance's Company of the Year in 2019. We saw a little bit of a drop off here, but not the biggest one into the pandemic. And then we saw that incredible rise along with other retail stocks. So let me just give you some analyst commentary. This one comes from Baird. They are rating the stock and outperform with a price target of $275. You can see the current price, $220, and they are saying encouraging results with the fourth quarter EPS topping the Street View and your guidance. It is comfortably above Street expectations, and while the fourth quarters, their comparable growth, it trailed his and the Street's estimate. Store traffic was strong, rising 8.1%, and particularly noteworthy. The analysts also pleased to see gross margin pressure moderate from third quarter earnings, and saying it was the EBIT margin forecast of at least 8% that is arguably better than feared. So taking a look at Target, nice to see a bit of green in the retail space here today.
And we're also seeing green in the cryptocurrency space today, something we haven't seen in a while because we know that cryptos were working in lockstep with equities. Now it seems like investors getting a little more comfortable using that digital asset as a hedge. And I know that Bitcoin marching toward that 45,000 level. That's a key level for the crypto.
That's right. I'm looking forward to this panel with David Hollerith and Jen Schonberger in just a few minutes. I just want to trace out what's happened over the last few days. Here's a 12-day look at Bitcoin. And let me put some candlesticks because a very important chart formation is emerging here. Actually, let me get a year-to-date view, and I think we can see it a little bit better. Yes, the makings of a W bottom. Here's the W, and we can see we are marching right back to the neckline. That neckline is 45,000, and that is a key level to hit there. If you take a slightly longer term view. This is a 6-month view. Here are record highs just short of 70,000. Pretty steep downward trend right here. So we're not out of the woods just yet if you're a Bitcoin holder, but nevertheless have to get past that 45,000 level. Even then, we're not in the clear necessarily. Have to consider whether this is simply a short covering rally, guys.
All right, thanks so much, Jared Blickery. Lots to cover there. Want to stick with the markets now and bring in Dave Harden, CIO at Summit Global Investments. Dave, what do you make of this market action? You know, I feel like I'm asking every guest every day whether or not this market's about to capitulate. Any belief that perhaps we're near the end of the selling?
I don't think so. I think that we haven't quite seen that flush that maybe is needed to really call it a bottom. And this the Russia-Ukraine situation obviously intensifies those concerns. So I think it makes it harder for the Fed to know what to do. You've seen that 50 basis point really go away, and now 25 maybe. So I think there's a lot of Fed speak. It's very active, definitely increasing the chance for a possible mistake from a Fed policy perspective. So I don't think we're quite there. Definitely a lot of volatility still ahead.
You say a quarter point, perhaps maybe from the Fed. Do you think that the Federal Reserve holds off on raising interest rates until there is, some clarity coming out of Ukraine?
Well, I think that was very interesting on the eve and throughout the day of the first invasion last Thursday. We had so much Fed speak about taking some of that off the table. I think in some respects, I call it the Fed put or what have you. There's a little bit of nervousness about letting the market just do its thing and fall. So I'm not sure if the Fed's really willing to see the market fall. And so if this gets worse, if it seems to drag out longer, the reality is that conventional wisdom is to ignore things of this nature. They're very short term. The average downfall, even going back to Pearl Harbor, is only Pearl Harbor is about 4%. So the reality is that we typically ignore these. But with the Fed, with everything that's going on, inflation is still red hot. The reality is we have to give this more significant downside risk possibility. So I do see more volatility and fluctuation, and a lot more chance that the Fed doesn't do as people expect. And that uncertainty is a problem.
Another big problem for the Fed as well is the soaring price of oil, which we know is inherently inflationary. We now have WTI near an 8-year high at about $104 a barrel, and some are saying it could go even higher. What do you do with the energy space right now? Do you expose yourself to a little bit more of it? Do you take some money off the table?
I think you do have some more exposure there. Even with the release of reserves today, it really didn't even touch the price. Those reserves are about 4 days worth of reserves. So I think oil still has some room to grow. Oil's kind of your defensive right now. We're overweight energy. I think you need to be diversified in the space and be careful where these energy reserves are at. So exposure to Eastern Europe and exposure to kind of that area, you want to be very cognizant of. But energy in general and exposure to oil, I think, is a very good play. So to me, I don't think it's the time to cut your loss, take your gains, so to speak. I think it's time to let those run a little bit longer until the market settles down some more.
And what's your exposure, Dave, to high-tech growth stocks? They were getting beaten up prior to the Ukraine war, and down now, the Nasdaq down another 2% today. Do you see prospects being good for this sector, at least in the short term? And do you stay there, or again, do you take some money off the table?
I think most money's already been probably taken off the table if you look at their returns. I mean, we're underweight there by a good amount, maybe 7% to the S&P. And the reality is that you have to be very selective with exposure in that space. So some of the cloud names have been very much beaten up, way oversold. So Adobe's a good name that we own. So you have to be very selective in that space, where you're going, what you're buying, and where their exposure is. So there's definitely some value there to be had. I think growth is not dead, but you just have to look for growth at a reasonable price, if you will, the old saying, or growth that has high profit margins, very high cash flow. So we want that on the balance sheets. And so look for those type of companies. I gave you one like Adobe.
Yeah, I like that. Folks, our listeners always like when guests give specifics. So tell me how else one might sort of fortify their portfolio at the moment, perhaps play defense.
Well, I think, like I said, you have to, I think, favor value, particularly energy over growth. I think defense is the new offense right here. So there's some picks and staples and discretionary like Target today. I mean, it's no wonder they've done well. Their earnings have grown. They said the outlook was wonderful. But getting into energy specific, look at Chevron. The PE is about 13 on Chevron. It has a higher yield, about 4%. Gas prices seem to be continuing to go up. And from an ESG perspective, the recent announcement to acquire the renewable energy group, REG, hey, it continues to move into this low carbon business. It speaks to Chevron's energy transition strategy. I think that's a really good play. If you're going over into the healthcare, I think McKesson's a great deal. Its PE is only 11, so you're getting good value with McKesson. Ticker that is on MCK. Beta there is low beta, 0.83, but the earnings are very solid. Bottom line, double-digit growth here, top line outperformance as well. And, so as long as there's somebody else developing drugs, they're distributing it. And I think that's a really good play. If you come out of that and you want to play a little bit into NATO and Germany, making money and spending on defense, I think Lockheed Martin's your play. It has a lower PE around 16. The beta's less than the S&P at around 0.9, has a decent yield about 2.5. And I just think this increased military spending is not stopping today. No matter what happens over there in Eastern Europe and how quickly it ends, I think, there's a lot of talk about this is a longer term play and worries about the Cold War, et cetera. So I think that's a great thing. And something to avoid is, let's face it, I think Zoom is out. So, this is a high PE still, 32 PE. It does have a lower beta. That might tempt some people, but the reality is that's a volatility trap. I think that's something you want to stay away from. I think they've announced already their earnings are declining, lower than expectations. And so this is, with all the numbers from COVID and everything else, I think the Zoom play is over.
Yeah, it was a pandemic darling, though, that's for sure. Dave Harden, CIO of Summit Global Investments. Thanks so much for your insights today. Karina, back over to you.
You have some great perspective and specifics there as well. Thank you so much. Okay, coming up, U.S. officials have warned about the threat of cyber attacks as Russian retaliation. How prepared are we? More on that ahead. As the war in Ukraine escalates, what entities are doing there to prepare for the possibility of cyber warfare? Here to discuss, let's bring in Jay Chowdhury, the CEO and founder of Zscaler. Sir, it's become a frontline issue, if you will. Ukraine already targeted. How prepared is your company to deal with cyber warfare?
Well, I started this company in 2008 with single focus. The new world of cloud and mobility requires a different kind of security than the old world. So we got our employees engaged with our customers around the globe. I talked to lots of CIOs and CISOs in the past 2 weeks, especially in the past 1 week, that engagement has picked up. Our customers are concerned, and they should be. And we are helping them to make sure they remain safe in today's dangerous environment.
Okay, sir, and tell me if you could, when are cyber attacks an act of war, and what could those attacks look like here at home?
Well, it is kind of interesting. If you look at traditional war, you see these missiles and guns coming. Cyber war, you don't even know sometimes when it started, because it all starts with reconnaissance. Underground activity starts picking up. They start sending these what I call botnets to infect your PCs. They become like spies, like sleeper cell. They're collecting information. And these things can be triggered on when they want, because of the presence they have on company computers, to shut down, for example, your critical infrastructure, supply chain disruptions. We have seen that in the recent past. And this kind of situations makes it more and more dangerous. So our job as Zscaler is to make sure we protect our customers. The first thing we do to do so is what I call minimize the attack surface. If we hide their applications and systems behind the Zscaler cloud, the bad guys can't find them. If they can't find them, they can't attack them. This is the opposite of traditional security the world has been doing for 30 years. The traditional security was castle and moat. So they could target you, they could attack you, they could establish beachhead. So the new architecture, what's being called as zero trust, is needed. Luckily, Biden administration has been pushing for zero trust architecture. We believe as the world moves to zero trust, it will become safer.
I'm curious if you see in your business, because you're so close to these companies that you're trying to protect, is there one industry or sector that's sort of doing it better than the rest at protecting their infrastructure and their information?
Yeah, so there are certain areas where you have to do it. I have seen financial services companies do a better job than others. But in this today's world, everyone is doing online business, whether you're in pharmaceutical or you are in even manufacturing, supply chain, retail, healthcare. All of them need security. So our customers are across all verticals. We got over 6,000 enterprises globally. This includes 35% of Fortune 500 companies, just under 30% of global 2,000 companies. So everyone is vulnerable, everyone needs security. And our team is focused on making sure we keep on innovating. It's a game with bad guys. You need to stay ahead of it, but the right architecture matters. And then you go from there.
Do you think our government is ahead of it? Are they prepared to deal with these potential attacks? And, some of our grids, for example, the energy grid is so old and archaic. Are there particular sectors that are more vulnerable to attack?
So some of the sectors like energy, they hit everyone. So that's why bad guys try to go after those sectors sometimes. You saw Colonial Pipeline attack was an indication of it. It's unfortunate that some of the critical infrastructure is so old, so far behind, sitting behind old firewall technology. They are being accessed by VPNs. They are in a dangerous shape. Fortunately, the administration is stepping up. There was a new notice that came from Biden administration recently, which said, you must submit us a zero trust architecture plan in the next, I think it was about 2 months, that within 2 years, you must change over to zero trust architecture. from old firewall and VPN-based architecture. So are we safe? We have a lot more work to do to get there. And we are working with federal governments. We're working with many state and local bodies. Over 100 federal agencies are Zscaler customers, but a lot more needs to be done.
All right, we will leave it there. Thank you so much for bringing us up to speed. Jay Chowdhury, CEO and founder of Zscaler. Alexis.
All right, the White House now encouraging U.S. drillers to produce more crude as oil prices hit an 8-year high. We're going to talk about it right after the break. Stocks continuing to be hurt today as Russia ups the war in Ukraine. We have got the Dow Jones Industrial Average now down nearly 700 points, the S&P 500 down 64, the Nasdaq off nearly 200. And as bad as this looks, all three major indexes are actually off their lows of the session. All of the sectors in the S&P 500 are in the red, with financials leading the way down. A big reason there, we are having a crash in bond yields because investors are pouring money into bonds. That's pushing the price of bonds higher, but yields work inversely. So we're seeing those yields fall. Here we have the 5-year yield at 1.53%, the 2-year, which was at 2%, or the 10-year rather, which was at 2% just a short time ago, now at 1.70%, and the yield on the 30-year at 2.10%. I want to also talk about the oil market. Lots of action there today. Crude oil rocketing to an 8-year high as investors grow increasingly worried that the war in Ukraine will squeeze oil supplies. Bob Iacchino is co-founder and chief market strategist at Path Trading Partners. He's also co-portfolio manager at the stock think tank. Bob, always good to see you. Do you think that what we're seeing here in the oil market is a little overdone, and may things have peaked, at least in the short term?
Well, I almost feel like those are two questions. I do think things are overdone a little bit, but they can get a lot more overdone before they're finished. We've already seen a pullback of somewhere in the range of 3 to 4% from the highs. We were up over 11% on the highs at 106.78 on WTI today. We've pulled back quite a bit. I have us up right now about 7.4% at about 102.83. So we've pulled back. The issue with it is that when you have a market that is as heavily used by hedgers and speculators, any little news event could drive us to that next level higher. There's been shops such as Goldman Sachs that think that the full effect of a Ukraine-Russia conflict is not quite priced into the energy markets yet. Having said that, if that's not priced in, what's priced in, and are we going to get to what the full negative effect of those prices can be? I would say we're not. We've never seen this much of a concerted effort from Europe, at least not in my lifetime, against a certain opponent. So I suspect that the energy part of the conflict could become a weapon that's used by Vladimir Putin. But I also think that these types of moves are always overdone. It's just a matter of where that overdone line comes in. And really, none of us know where that is. We're out of all our long positions in crude oil, got out on the spike through 99. But I'm not shorting crude oil here, but I'm looking for a spot to potentially put some short trades on.
The White House has received a lot of pushback in recent days for not tapping into what a lot of people see as at least a partial solution to higher oil prices, and that is U.S. shale. And I know that the administration is now quietly talking to U.S. oil producers about drilling more. Would those two things help the situation in a meaningful way?
Well, it might be a little too late to do that. One of the myths about shale oil is that they just turn the spigots on. That's the kind of thing we heard back when prices were dropping into the 20s and 30s, $20 and $30 range, that if prices went up, shale would just turn the spigots back on. It doesn't work like a faucet. There's quite a bit that goes into drilling in shale in terms of acquiring sand for the drilling, hiring people, getting the permits, CapEx into new well exploration. So it's not that simple that the president could just call and say, by the way, we think it's okay now. That's not a criticism of the administration at all. They've taken a different path with this. But another way to look at it is that shale has learned their lesson, that the quicker that they produce, the quicker those barrels of oil become unprofitable. And they can affect it. The problem is we can go all the way back to George Bush. There has not been an energy independence strategy that I'm aware of throughout administrations. It's the kind of thing that Congress, I believe, should get involved in. It's something we're seeing the effects of now. So should they be pushing for U.S. companies to drill more? They should. There's also the factor that OPEC actually overproduced for the first time since September of last year in February. Now, they're saying they're not going to produce more, but they've been underproducing versus their own quota. So just the fact that they produced a little bit more, if we can get the shock out of the market, you're likely to see WTI at least come back down into the low 90s range.
You know, we saw that the White House and its allies agreed to put more oil on the market to tap those emergency stockpiles by about 60 million barrels a day. I thought that might help things. Do you think maybe investor psyche here is what do they know that we don't know? Maybe it's worse than we thought. And speaking of OPEC, do you think they might step up and actually make some changes tomorrow to make a difference here?
The OPEC question first, I do think they might step up from a statement perspective. They're likely not going to change the decision they already made, but they're likely to address their own decision by saying we can change this intra-meeting given the circumstances with Russia and the Ukraine. Now, in terms of the release from the IEA Council, that's an interesting thing that happens in markets all the time, especially when there's hedging and speculating going on in those markets. We used to see it with the Japanese yen when the Bank of Japan would get involved. We saw it with the U.S. Federal Reserve in the 90s when they did a surprise mid-meeting rate hike. They tend to give the market the idea that they know more than the market knows. And oftentimes in the short term, the opposite happened. We actually saw crude oil pulling back in price. And then when that SPR and IEA announcement of a release came out, prices shot to new highs for the day. That was that effect I'm talking about. Traders and especially hedgers tend to think, wow, they're doing something that they don't often do. In the case of the IEA, it's only been done 3 other times in their history. Traders will start to think, well, what else do they know? Is this going to get a lot worse than we think? And they'll tend to get out of short positions and potentially even put on long positions. And that's what I think we saw here. So it might help in the medium term, but in the short term, it rarely does.
All right, Bob Iacchino of Path Trading Partners. Thanks for being with us. Karina?
Good to see you.
Okay, and coming up, a check of the energy complex and how crude settled as OPEC Plus meets to discuss output. Plus, how does Wall Street map out the potential risks to the markets? All that ahead.
Thirty seconds, Mr. Timmer. Stand by.
Welcome back. Well, U.S. oil prices are surging today, up as much as 10% before retreating slightly. All that as Russia's assault on Ukraine intensifies, and as the IEA agrees to release 60 million barrels of oil from its stockpiles to alleviate tight supply, and as OPEC Plus meets to discuss output. Here with more on how crude oil settled, let's bring in our Yahoo Finance's Jared Blickery. Jared, that IEA release not really halting, supply concerns too much today.
No, in fact, you take the comments, excellent comments of Bob Iacchino just now. The opposite occurred. So when that announcement came out, it was somewhere in the 10 to 11 a.m. Eastern time frame. There was no reaction to the downside. It simply continued the upward trajectory. Market participants saying, yeah, what else don't we know? And in fact, if they have to do this at this late stage, what else could be going on in the market? I don't remember a time when there was really more going on in energy. And as you said, OPEC Plus meets tomorrow. They are scheduled, as they have been for over a year now, to raise production by about 400,000 barrels per day. It's been on autopilot so far, but given the recent dynamics, there might be a call to increase production even more. Of course, we got that 60 million barrel release announcement from the IEA. And as Bob was pointing out, that's only happened 3 other times in history. I want to show a 3-month chart of oil, and you can see this huge spike here. Haven't seen a spike up like that since the very volatile days of the early pandemic. And that was when crude oil hit negative 40. And the days after that, it was just jumping by 25, 50% per day. We're not going to see anything like that, hopefully, in the near term. But I do want to point out, and let me put a 20-year chart here. We're going to have to go back to the highs of 2007 and also 2011, 2012 to see where the next resistance level is. That's coming in at about $115 per barrel. And guess what? That's only about $9 or $10 per barrel higher than the highest price today. So we are right up against that. You push through these barriers right here, these potential resistance points, then it's another short trip to $150 per barrel. And that was the all-time high, just short of that we reached in 2007. So really playing out in the energy markets here. Also want to take a quick look at energy stocks because they are leading the way higher today, or they had been leading the way higher. Kind of a mixed board here. Again, some of the foreign majors not doing as well. You see Shell, Total, BP, they are mired in the red. They have more Russian exposure than the U.S. companies. Chevron, for its investor day, we had the CFO on earlier today. That stock is up about 3%. ExxonMobil in the green for about 0.7%. And kind of a mixed board elsewhere. I will also say that Occidental Petroleum up 8%, but a huge, huge day in the energy market, guys.
A huge day indeed. And how high can it go? That's the question. All right, we'll leave it there. Jared Blickery, thank you so much. We want to turn now to the broader markets and bring in our next guest, Urian Timmer, Fidelity Investments Director of Global Macro. And Urian, you know, if you ask 10 analysts where equities, energies, commodities are headed, you will get a dozen different answers. So how much is Wall Street really struggling to chart these black swan risks and then find portfolio stability?
It's a great question. And by definition, you know, black swans are very, very hard, if not impossible, to quantify. You know, what is the risk or what is the probability of this outcome or that outcome? You know, these are low probability events with very, you know, large, obviously, impacts. And I think most investors can really do here is to be in a well-diversified portfolio. And it's interesting, you know, until today, I was really scratching my head over the lack of a response from the bond market to, you know, to all of the headlines that we've, of course, been seeing over the past week or two. You know, stock market did kind of predictably, you know, went down on the news. Gold went up. Bitcoin at first went down. Now it's up. The dollar went up. Oil went up, of course, commodities in general, all fairly kind of understandable moves. But the bond market last week didn't budge at all and basically was essentially saying that the Fed is going to do what it was going to do, regardless of the headlines that we're seeing. That really changed today, where the bond market, all of a sudden, yields are plummeting. You know, the 10-year yield's down to 170. It was at 2% 2 weeks ago. It was at 1.9% just on Friday. And the market has now unpriced some of the Fed's expected rate hikes. March is back to 1/4 point, and the year of 2022 is down to less than 5 hikes from 6.5. So, you know, that if we think about a diversified portfolio, you've got stocks, you got bonds, you got some inflation hedges, whether it's tips or commodities, you got some gold, maybe some crypto. The 40 side, that bond side, really wasn't kicking in, but now today it has. So I think it's, you know, it's just a sign that when things are uncertain, risk premiums tend to go up, and we're seeing obviously that happen in the stock market. The PE is falling. It's down about 20-25% from the peak set last year. So a significant derating that was already underway because of the Fed cycle, but is now being kind of escalated because of these geopolitics that are happening now.
And then, Urian, what are some of the key technicals that you're looking at this particular point to see where markets go from here?
So we're always looking for signs that the trend is getting exhausted, right? So you look at the leadership, and we see this during every correction or bear market. I mean, so far the market is down 15% as of last week's intraday low. It's down about, you know, probably 12 or 13% on a closing basis. But we saw this, for instance, in a financial crisis or even during the pandemic, that the stocks that people like to hide in, they hold up, and then towards towards the end when the margin calls come, even those go. And so when we look at the leadership, into last week's trading low on Thursday, and who knows, maybe that was the low, we don't know. The meme stocks, the non-profitable tech companies, the retail darlings, those kind of bottomed first and then had a very strong reversal. And on that low, we saw a number of technical divergences. So when you look at breadth, the number of stocks making new 4-week lows or 13-week lows, or the number of stocks with very oversold momentum, those all made a higher low last week Thursday than their previous low, which was on January 24. So maybe it's just short-term noise because obviously the headlines are dominating. But to me, that was already a glimmer of hope, if you will, that maybe the leaders that were forcing the market lower were already kind of being exhausted. And so we'll see if it holds.
Okay, I want to try and get one last question in really quickly, only about 30 seconds, and it ties back to these black swan risks. And then, we heard the IEA is going to release 60 million barrels. How do you try to calculate what happens if energy sanctions actually do get slapped on Russia? What can you glean from the price of oil now, factoring 40-year high inflation? What impact does that have on markets and the American consumer?
The ultimate impact is that energy prices will obviously stay high. Bond yields are now following. You take one minus the other, and you get more negative real rates. And that's, I think, one of the main developments today is that real rates were negative. They were getting less negative because the Fed was tightening or is about to tighten, and that is the whole point of tightening a cycle. And now they're getting more negative, and that would be kind of the main implication for the commodity markets, for the stock market, for real estate, for bonds. And so to me, the real rate kind of linkage is what's going to drive a lot of asset class returns going forward.
Okay, a lot of things to watch. Thanks for your time today. Jurrien Timmer, Fidelity Investments Director of Global Macro. Alexis, over to you.
Investors turning to cryptocurrencies as a hedge in these volatile times. Coming up, a panel of crypto experts weighs in on the outlook for the digital asset. Investors continuing to pile into cryptocurrencies as Western sanctions against Russia make the use case for a decentralized channel for finance, which means regulation is probably in the offing. Yahoo Finance's David Hollerith and Jen Schonberger. Here now with some special guests to break down the outlook for what some traders are calling digital gold. David?
So Danelle, I sort of wanted to point the first question to you. So given the geopolitical circumstances that are currently bearing down on the markets, there's been some interesting reports about cryptocurrency use in light of the Russian-Ukrainian conflict. In addition to that, there are major levels of inflation in currencies across the world. So I wanted to ask, in light of all these events, has your perspective on cryptocurrency regulation in the U.S. or more broadly shifted at all?
No, I don't think my perspective has shifted. First of all, thank you for having me here. I think the need that we have for us to collaborate with regulators all over the world is still there. I think that when regulators already have the opportunity and the ability to regulate at the activity level, and most of this is already in laws and regulations that exist globally. So financial institutions and money service businesses already are regulated in all of these regions. And so it's just, there might be some gaps that we have to work through, but my view on the value and the benefits of blockchain and crypto stand, and how we can actually bring a lot of value. We're already seeing that in this awful conflict that's happening in the Ukraine with the invasion by Russia, where we see that cryptocurrency is being leveraged to be able to do a tremendous amount of good for the local, the humanitarian aid there, as well as with the government of Ukraine. So I think it's a real positive, and I think we're working towards a better resolution with respect to the public to private partnerships and working together to make some needed regulation appropriately leveled for the industry.
And thanks so much to you, Danelle Dixon from Stellar Development, for joining us, and also to you, Paul Fiore, CEO of Next Edge Crypto, for joining us. Paul, I want to come to you because there is so much market turbulence now amidst this geopolitical landscape, meaning that we need crypto regulations more than ever. So I'm curious, where do you see the biggest gaps right now in regulation, and what risks does that expose?
Sure. Thank you for having me. Yeah, the risks are an uneven playing field between banks and non-banks, and to stifle innovation. So for a regulator, they have a hammer, and the first thing they need to know is the nail. Is the product a security, a commodity, money transmitting business, a payment network? And then from there, they have to figure out which regulation infrastructure to put. But what happens if it's a crypto product that kind of crosses the boundary and touches several different product maps? So the goal for the banking industry is to have the regulators work with them to enable them to compete.
Yeah, and Danelle, to follow up on that point, I often hear that people working in the space, contrary to sometimes what is said, at this point, they welcome better, clearer regulation. And at the same point, that's what a lot of U.S. investors are waiting for, particularly financial advisors, before they think about allocating portfolios to the asset class. So given all of this, I was sort of interested, do you think that is there any one regulatory issue in the US that you've been following that is sort of the most concerning thing, or thing that needs to be solved before the industry can move forward?
Well, I think there's been a lot of focus on the SEC and the SEC's view of stablecoins as well as cryptocurrencies generally. I think that there's the Howey test, which the SEC employs, which, by the way, was about orange orchards. So we clearly know that oranges aren't securities, but there's this question around where do cryptocurrencies fall? And certainly there are thousands of cryptocurrencies out there, so none of them fit neatly into any bucket. But I think if we focus on what the Howey test focuses on, which is what that activity is and how to regulate that activity, that would bring a ton of clarity, because Howey exists, and this is the test everyone goes back to, but how that applies with respect to cryptocurrency is something that, we're watching to see what the SEC is doing. And I think lots of folks are watching there. But I think that, right now in the United States in particular, there's so much more momentum with respect to this conversation that we're having with regulators. And so this is something that I think is really important that we continue, because it's where the cryptocurrencies and blockchain are here. They bring a tremendous amount of value. It solves a lot of really significant problems here, but also in other parts of the world. And so we really need to make it work for everyone. And so that's, I think, the goal. And I think we're seeing a lot of momentum on the regulator and policymaker side, working with us to be able to help to solve some of these issues.
President Biden is set to issue an executive order on regulating cryptocurrencies that would direct agencies across the government to study cryptocurrencies and come up with a strategy or a proposal to regulate them. Among the items, as I've reported, that this order will issue is ordering the Departments of Treasury, State, Justice, and Homeland Security to develop a report on the future of money and payment systems, and then direct the SEC, CFTC, Fed, and others to weigh in on market protection measures. Danelle, to you first, your reaction to this and what you hope to see in that executive order.
Yeah, I have a really positive reaction to this because I really want to see these agencies working together, which is not something that we're seeing right now. Again, if we focus on the activity and what's actually happening, these agencies cover a lot of this, even with respect to cryptocurrencies. So again, there might be gaps. Let's use stablecoins, for example. There's a gap as to how a stablecoin fits and what it should be defined as, and we're seeing lots of momentum. In fact, it's the topic in DC a lot right now about how to create regulations around stablecoins that makes it work. So I love the idea of these agencies really digging in on this and then figuring out how they can work together. What I don't want to see, because I think it's the worst thing that could happen, is a specific agency set up just for cryptocurrency and blockchain. We don't need another regulatory body. We need the bodies that exist. They're already regulating this space to focus on that activity and to make sure that they're covering their space with respect to it and to be really clear about where their tracks are. So that, I think, generally, I like this idea. I just want it to be used for more education, more momentum, and we're here and we want to actually be available to talk about these issues.
Paul, to you, your expectations for this executive order and reaction, and what are you hearing from regulators that you talk to about regulating crypto?
Yeah, so I am in Washington, D.C., happened to be today, met with some groups of credit unions, executives, and the members of the NCUA. Executive Chairman Kyle Hopton, in fact, is for the NCUA setting up a new division called the Office of Innovation and Access with the goal to collaborate, work with financial institutions, realizing that they're behind today, but they don't have customer acquisition cost. Credit unions have members, banks have customers that are already at the financial institution, don't need KYC. So the regulator, I feel, is looking to become a partner with the financial institutions to keep them competitive.
Danelle, to your point, to your last point you made about, whether or not it should be one regulatory body or, several. I was sort of curious about the classification in terms of assets from the Sellers Foundation's perspective. How do you view crypto assets in particular? There are securities, commodities. Do they fit into one? Do you think there needs to be a new framework?
Yeah, I don't actually think there needs to be a new framework. I think that there are thousands of cryptocurrencies, as I said, and so they don't fit nicely into any bucket. And I think, again, it's what you're doing with that asset. The Lumen, for example, which is the native currency on Stellar, it's really used for spam and DDoS. It's really used for that utility piece. There are other tokens that are out there that have been used to really create and to fund products and to be able to deliver value to their users. I think it's determining what the activity of the asset is. But remember, and this is what's complicated with respect to Howie right now, is that, as I mentioned about the orange orchards, it doesn't need to be that the underlying cryptocurrency is a security. It's how you use that asset to be able to do something, whether you're creating an investment contract. And there is the issue where we need to actually have more clarity from the SEC. And I really feel like we need to really dig in on that a bit more. We're seeing a lot of really great framework discussions around stablecoins, and we just need to understand, again, how we can be applicable here. And we have the test, but how that test applies in all these different scenarios is important.
Paul, you talk to credit unions, you advise them, as well as the banking sector on crypto. You help educate them. Are you seeing crypto become more connected to the traditional banking sector? And if so, do levying bank-like regulations make sense to you, as the Biden administration has suggested in certain cases, or do we need a whole new set of rules for digital assets?
So for the first question, absolutely. Financial institutions are fast followers. So once there's a new product and money is leaving financial institutions to go into these alternate sectors, you could sure there's going to be action. So there's a number of large banks and a number of groups of credit unions that are starting to roll out basic exchange services similar to what you would find at an eToro, Robinhood, Venmo, or even Coinbase. So those products are coming. And I agree with Danielle. I don't think we need new regulators. I think we need more clarity on the regulations that exist, specifically in the world of credit unions. In December of 2021, the NCUA issued a letter that essentially said there's already existing authority for financial institutions to deliver products that serve their members, and the crypto exchange products fall into that category.
Paul, Danelle, thanks so much to both of you for your insights. Hope to see you soon. Karina, I'll toss it back to you.
Okay, thank you so much. And our thanks again to the panel, Paul Fiore from Next Edge Crypto and Danelle Dixon from Stellar Development, along with Yahoo Finance's Jennifer Schonberger and David Hollerith. And before we will take a quick break, but on the other side of it, we'll get you a check of the markets amid today's sell-off. More on that ahead. And welcome back to Yahoo Finance. Well, before we go, a quick check of the benchmarks as Ukraine gets ready to enter a 7th day of intensifying conflict. That is, we finally hear from China saying it's concerned about the number of civilian casualties. All three major benchmarks now off session lows, dialing back from the big sell-off. The Dow down by 653 points. Nevertheless, the S&P is down by 71 points, and the Nasdaq giving up 216 points there. Let's head over to the bond market, where we see a remarkable reversal of fortunes. Investors flocking into bonds as a safe haven, wondering what central bank policy will be. And as Russia continues its aggression, you see the 10-year there at 1.70 and the 30-year at 2.09. That will do it for myself and Alexis Christoforous. Thanks so much for being with us today. Stay with Yahoo Finance Live, as after the break, our colleagues take it away and count you down to the closing bell and beyond.
Stocks are sliding and oil prices are soaring as investors monitor the latest fallout from Russia's war in Ukraine and the sanctions that have ensued from the West. Earnings are rolling in after market close with AMC, Salesforce, and Nordstrom each set to report results while geopolitics dominate headlines. We'll speak with Ian Bremmer, Eurasia Group founder and president, for analysis on the crisis in Ukraine. Plus, President Joe Biden delivers his State of the Union address tonight when he's expected to remark on rising prices for consumers and the latest on the global conflict. Representative Kevin Brady of Texas will join us in a bit for a preview and for his take on the U.S. response with sanctions. Plus, a decoupling is underway between Bitcoin and U.S. stocks. As sanctions send the Russian ruble tumbling, investors have been piling into cryptocurrencies. We'll break down the crypto price action amid geopolitical uncertainty with Decrypt investigative journalist Scott Cipollina in a bit. We have an hour to go in today's session. This is Yahoo Finance Live. I'm Emily McCormick here with Brad Smith and Rochelle Akufo.
That's right, Emily. As you mentioned, their stocks extending their losses in another volatile day as investors weigh the fallout from the Ukraine-Russia crisis. Well, let's get the lay of the land with our very own Jared Blickery on the Wi-Fi Interactive. Jared?
Yes, well, I'm looking at our global map here of the indices, another picture with a lot of red, especially centered in the West here. You can see the Dow off the worst, 1.75%. The S&P 500 and Nasdaq each off about 1.5%. This is the S&P's intraday price action. You can see we're not far off the session lows right here. And I just want to show our year-to-date candlestick chart so I can show how we are selling off once again from what we identified as potential resistance at 4,400. This has happened several times. The first was here. Second was this breakdown here. This was at the beginning of the conflict, sold off again here. And now, after reaching that spike low, selling off again. But we'll have to see if these levels hold, if we go down and test this or break it one more time, or able to cause a short covering rally, which doesn't really begin until we hit about the 4,500 level. So getting a little bit ahead of ourselves. Let's take a look at the sector action where we see energy, the only, well, now it's real estate. Energy is the biggest outperformer here. It's up 1%. Crude oil, WTI hit 106, 107 and change. Just some interesting and very exceptional moves in the energy market. And I also want to take a look at some of our sentiment leaders here. Not a lot in the green to the downside. Regional banks really taking it the most here. That's down 4.5%. That's based on the yield curve, which is crashing right now. Also gambling and chip stocks not faring very well either. In the chip realm, NVIDIA off over 3.5%. AMD off more than 7%. And you can see a lot of dark red on your board here. I want to get to the bond market because that's where a lot of the action has been centered here today. By the way, this is the VIX. You can see it's at 34, but the 5-year T-note yield crashing the most in years, down 16 basis points. Simply incredible moves here that are weighing on the market.
Yeah, significant indeed. Yahoo Finance's own Jared Blickery breaking all that down for us. Thanks so much, Jared. We'll check back in later on. Let's dive further in depth on today's market activity. Joining us now, we've got Gene Todd, who's the Fiduciary Trust International Executive Vice President and Head of Regional Markets. Gene, good to have you here with us today. We've already heard kind of across the pond, ECB council members making public statements today in opposition of stepping away from pandemic stimulus amid the international conflict. Do you believe that this will have any influence on the FOMC and their decision?
Yeah, well, I first of all, thanks for having me here, Brad. It's good to be with you today. Yeah, I think we're going to hear from Powell and a little remarks from the Fed tomorrow. And, everybody's been talking about how many rate increases are we going to get? Is it going to be 8? Is it going to be 7? We're going to get rate increases. We need rate increases. But I don't think it's going to be anywhere near 8. I think people have to just slow down a little bit, see where this Ukraine-Russia situation goes, watch the data. Inflation is sky high, obviously. People are very nervous. You see what's going on in the markets. You've got a flight to safety. So I think you're going to hear kind of a little bit of a subdued statement from the from Powell and the Fed.
And part of your strategy right now has been around global diversification. I'm wondering, into what markets would you be looking for opportunity in a heightened sanction environment like we've seen?
Well, I think, first of all, investors should calm down a little bit. I know it doesn't feel good. This is very unsettling. a little bit of uncharted water as it relates to what's going on in the Ukraine right now. But we've seen these sorts of geopolitical shocks before. And in every situation, it's very unsettling, but the markets recover. So we're advising clients not to make any drastic moves to their overall allocation right now. I'll tell you, we actually have been overweight in cash, and we've been overweight in cash because our view was going into 2022, we were going to have a pivot from 2021, where you had high returns and low volatility, to an environment where you have lower returns and much higher volatility. Now, we didn't see a correction coming, but corrections are normal. Geopolitical issues and disturbances are normal. And I think we're going to ride through this. So no sudden changes in the asset allocation right now. If you've got some cash, there are some bargains out there. Financials would be one. Real estate, hard assets, because we do see inflation being high for a while. Consumer discretionary. There's a lot of cash out there by individual consumers. M2 is up 40% in 2 years. And so there's a lot of cash that investors have. And we think consumer discretionary is poised to do well over the months to come.
And Jean, when we take a look at the Treasury market, we are seeing the benchmark 10-year yield down about 12 basis points to just over 1.7%. What do you think the bond market and the Treasury market in particular is telling us right now about where things may be heading?
So the economy is slowing. And what's interesting is if you saw the print from the Atlanta GDP Now Fed, it just came out about an hour ago. They're forecasting Q1 GDP to be flat. So there is no doubt that at least in the short term, GDP is coming down, earnings are going to come down. We just got off of a very strong Q4 earnings number, and then we're going to see a slowdown. Now, most of that is Omicron, and we think things will pick back up. But I think that is what the Treasury markets are telling us. That is what the flattening of the yield curve is telling us, is that the economy is slowing down.
And of course, when we take a look at the equity market performance today, over the past several months, really, stocks had already been in a downward trend even before the Russian invasion and the weakness was there. What do you think that suggests about how the markets moves from here will really depend on the outcome of the geopolitical side versus some of these fundamental drivers?
I think it always comes down to fundamentals in the long run. In the short run, of course, these geopolitical issues are going to cause this extreme volatility, but this shall too pass. And the focus is going to be on inflation. The focus is going to be on growth. It's going to be, once again, on the economy. And based on what the data is, and our hope is that the economy does start to pick up in Q2. Our hope is that inflation starts to come down as these supply chain issues work themselves out, probably later in the summer, maybe heading into the fall. And we actually think the equity markets can be up from here at the end of the year.
And speaking of inflation, obviously, one of those factors that's really leading to this 40-year high in inflation rates, you have things like the expensive COVID relief packages, as you mentioned, supply chain bottlenecks, and then labor shortages, et cetera, which can bring the inflation rate down independent of what the Fed does. So are you surprised that we're still hearing murmurs about a possible recession? And how do you see the Ukraine-Russia conflict perhaps weighing in on how aggressive the Fed might be?
Yeah, I think let's go back to what happened in the fourth quarter of 2018 when we had a Chairman Powell. Remember, he was nominated and confirmed as Fed chair in early 2018. And in the fourth quarter, we saw 4 rate hikes, and it shocked the market. And the markets were crushed. Stock markets were hammered. And so I think he's going to be very reserved. He's going to be very data dependent. And he doesn't want to make the same mistake that was made in Q4 of 2018. So it doesn't feel good. We're going to want some clarity, but this is a Fed that has proven to be very data dependent. They're not prone to make rash decisions. And so it's our hope that the data does start to improve. These supply chain bottlenecks that we've been talking about will work themselves out, and inflation will slowly come down, but we're all going to have to be a little bit patient.
And in terms of patience, then, you've said that the buy the dips mantra is compromised, but that doesn't mean Tina, there is no alternative, is dead. So given what you've seen historically happen with these corrections and the recoveries, then, what opportunities do you see for long-term investors?
Yeah, because in 2021, it was bet on everything and everything was up. And so that just doesn't play out this year. But it doesn't mean that there's not values out in the market. It doesn't mean that there's not opportunities. And so, yes, there's still Tina. There is no alternative. So I think we're just going to have to be a lot more focused on where the opportunities lie. And also, we have to be very focused on what's going on in the environment. So if we've got a situation in an economy where it's going to be a little bit inflationary, but growth slows down and then picks back up, there's opportunities, as I mentioned, in consumer discretionary. There's opportunities in financial. There's opportunities in real assets. And so investors just need to be very focused, to be very disciplined. And there's opportunities out there as we get through this current geopolitical issue.
We do thank you for all your insights today. Jean Todd there, Fiduciary Trust International EVP and Head of Regional Markets. Thank you for your time this afternoon. All right, stay with us here on Yahoo Finance Live. A look at the impact of sanctions and the fallout from the Ukraine-Russia crisis. Welcome back to Yahoo Finance Live. As we check on markets, we're going to take a focus on what's been happening with oil. So let's start with what we've seen with WTI crude oil futures. We saw those surging 9.5%, topping $106 a barrel at one point. And now we're seeing that that's still in the $104 a barrel range. Brent crude also was up, and that was topping $107 earlier. That also dialed back to about $105. Now, these highs come despite members of the International Energy Agency agreeing to release 60 million barrels of oil from their reserves to calm fears about supply disruptions. So let's also see what's happening with RBOB. That is also up for the day. That is up about 0.17. That is up 0.17. That's about 5.95%.
Well, by now, sanctions may have come up even in your social conversations amid the Russian invasion of Ukraine, which prompted sanctions from North American and EU nations. But you may still wonder how these sanctions actually work. Joining us now is Kevin Wolf, Aiken Gum partner and former Assistant Secretary of Commerce for Export Administration. Kevin, good to have you here with us today. First and foremost, by definition, sanction, a penalty for violating a rule or law. But what's the next step in enforcement?
Under both export control and sanctions rules, there are civil and criminal penalties, monetary penalties for violating or criminal penalties for willful violations. And then also companies can be either subject of additional sanctions where they're cut off from trade from the US, or on the export control side, added to a list of prescribed persons that would prohibit exports to those companies as part of a punishment.
And so with regard to what we've seen thus far, we've already had banks, JP Morgan, saying that Russia could enter into a recession or is about to enter into a recession as a result of sanctions that have been imposed. When you think about the impacts that sanctions have on a country like Russia, what are your expectations and what would you expect that net impact to be?
Sure. So in the area that I'm an expert in, which is the other half of the sanctions topic called export controls, which govern the movement of commodities, software, and technology from the US and from outside the US, I think the impact will be quite significant with respect to the key sectors that the Russian economy needs to function properly. And the US and Pacific allies and the EU allies have put together a package of new controls on semiconductors and computer items and sensors and lasers and avionics and maritime equipment and aerospace equipment that are all the types of equipment, commercial and dual use, that those sectors of the Russian economy need to thrive. So given that they don't have as much significant indigenous production in those areas, being cut off from supplies of key parts and components and production technology and software will have eventually, both in the short term, but certainly over the long term, a significant impact on the ability of those sectors to function properly in Russia.
So I guess further to the exports then, how does a sanction-imposed environment then also impact companies who have a history of exporting to Russia?
So companies that export to Russia are all scrambling, both in the US and outside the United States, to read the new law, which is really quite novel and quite complex and quite broad in its scope, in order to ensure compliance. There are some types of items that can be granted a license, such as if for safety of flight reasons or maritime safety or for humanitarian reasons. And then there are some types of items that don't require a license at all if they are the types of things that are used by ordinary people, consumer or commercial communications devices, for example, cell phones and laptops. And so what companies that export to Russia have to do is go through these complex rules and decide what's needed to comply. And to the extent a license is required, shut down shipments until a license is granted. And to the extent that an end user is involved, such as a military end user that's been identified in the regulations, stop all transactions generally.
And so in your experience, what are the considerations in determining the proportionate extent of a sanction, knowing that not only can it in fact impact the company or the country that the sanctions are levied towards, but also impacts some of the very companies in other nations who rely on those exports as well?
So the sanction is completely novel. There's never been the export control package that the US and the allies have done. Something like it has never been done before. One, it's completely multilateral. The US and the EU and the Pacific allies and Canada are all coming together with common licensing policies and common lists of items and common actions that are focused, A, squarely on Russia. So the collateral consequences outside of Russia should not be that significant. And B, focused on the types of items that ordinary consumers do not purchase, either by lists of items or by categories and descriptions of items. So it's a very clever sanctions and export control package in that it has maximum impact on the key sectors of the Russian economy where they need outside input to function and thrive and develop and advance, but without having, like other sanctions and export control embargoes have had in the past, dramatic collateral impacts on third countries or on most exporters.
And so with the kind of novel status that you've already pegged this with, from your perspective, are there still more sanctions, more severe, that could be levied that are not already in play?
Sure. On the export control space, there's always room for revision and tweaking. I think what we're going to see is that as the Europeans and the others start coming out with their sanctions package, if there are subtle differences between what they're doing, they'll go to the most strict version that any particular country comes up with. So there may be some more nuances in some types of items that were thought to have been for consumer commercial applications, but upon reflection are far more relevant for industrial applications in one of those sectors. So to the extent that there's tightening or tweaking, I think it'll be focused in that direction, but I don't see any indication that there's a policy objective to go after or impose controls on things that are important for humanitarian or consumer communications or consumer consumption.
Kevin Wolf, Aiken Gump partner and former Assistant Secretary of Commerce for Export Administration. Thanks so much for joining us here today with the breakdown and the insights as well.
And coming up, Bitcoin prices are roaring back and rising for a second consecutive day. We'll explain how the Russia-Ukraine crisis has been driving cryptocurrency prices with Scott Cipollina, Decrypt investigative journalist, on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. The cryptocurrency market cap globally is sitting at about $1.93 trillion. That's a rise of about 5% over the last day, according to CoinMarketCap. Now, taking a look at some of the major cryptocurrencies here on your screen, we've got Bitcoin. That's higher on the day by about 5%, sitting higher by about $2,229 there, sitting just above or just below $44,000 as of right now. Ether or Ethereum, that's a hot topic of debate. depending upon the conversations you're having. Right now, it's sitting at about $2,957. That's up on the day, as well as increases across the board for Litecoin, Solana, and Dogecoin. All of those higher by about 2% for Litecoin, for Dogecoin by about 3.6%, and for Solana by about 0.5% right now.
Well, as Brad highlighted, Bitcoin prices are soaring for a second straight session, with prices briefly breaking back above the $44,000 level intraday. To break down the latest price action in Bitcoin and the other major cryptocurrencies, and how this has been driven, at least in part, by what we're seeing occur between Russia and Ukraine, we're welcoming in Scott Cipollina, Decrypt investigative journalist. Scott, it's great having you on. What are you seeing as the biggest factors that are driving this recovery rally that we're seeing in the major cryptocurrencies today?
Yeah, thanks for having me. Well, I mean, I suppose I just start off by saying that really the crypto market sort of nosedived in lockstep with the rest of the world's financial markets. At, the news of the invasion, 200 billion had been wiped out from the crypto market cap following Russia's invasion. That happened within the first 24 hours of the invasion actually occurring. Now Bitcoin is, as you've just shown on your price list there, back above 40,000. But really, we saw a surge and a rebound and a recovery. About a day after the invasion began, we saw Bitcoin fall to a low of about under 35,000. And within the next 24 to 48 hours, Bitcoin had actually recovered to a price of about 38,000. And now we've seen that it's broken that sort of ever psychologically important bracket, should you say, of 40K. And other cryptocurrencies are also firmly in the green, as you've just mentioned, reiterating here that Ethereum is up 13% on the week, and other cryptocurrencies as well, like XRP, are up double digits this week too. So it's been a tumultuous week for sure, as it has been for the rest of the world's economy. But it does seem as though the crypto markets are recovering.
And Scott, earlier this year, we saw the correlation between Bitcoin and technology stocks especially reach a record high. Yet now that correlation is breaking down. Of course, Bitcoin is moving higher. The Nasdaq is moving lower during today's session. Over the long term, is Bitcoin going to behave more like a safe haven asset or more like a risk asset?
It's hard to say. I think that, that what we always like to say at Decrypt is whenever somebody says that they know exactly what's going to happen with cryptocurrency prices, we like to say that they don't necessarily know exactly what's going to happen because it's fundamentally speculative. And we've seen over the last week, of course, we've seen a lot of conversation to be had about the role of cryptocurrencies in the Russia-Ukraine conflict. There's been about $20 million worth of cryptocurrencies that have been donated to the Ukrainian government. The Ukrainian government has actually been tweeting out Bitcoin and Ethereum addresses to receive some donations. But then, of course, there's also a lot of justified concern, I would say, about the way that cryptocurrencies can help Russia evade sanctions. We've seen widespread sanctions applied against the Russian government and Russian interests over the last week, of course. So it would depend. I think that a lot of the conversation regarding price will inevitably be tied to the way that the crypto industry has been perceived and will be perceived with regard to the ongoing conflict.
And you were just mentioning, and you've also written about for Decrypt, about how cryptocurrencies could be used to undermine sanctions, such as what we're seeing begin to play out with Russia. Does this create a greater incentive for the U.S. to want to try and crack down and regulate cryptocurrencies more fervently? And is that something investors should be worried about?
I would be surprised if it did not act as that sort of a motivation, definitely. And just to briefly categorize what we're discussing here with regard to the role that cryptocurrencies can play with regard to evading sanctions. A recent study came out that found about 75% of all ransomware revenue in 2021 went to sources that were affiliated with Russia in some way. Actually spoke with a former FBI agent who told me that cryptocurrencies are now the, and I quote, primary factor in the ransomware industry. And the reason for that is just because the nuts and bolts of the crypto industry with regard to the speed of payments and the volume of transactions that we see. So there's definitely a lot of concern on that regard. I mean, we've also seen how far this can go previously. A UN report that was published a few months back found that North Korea's nuclear ballistics program had actually been part financed by cryptocurrencies. But then, of course, there are also, you mentioned what the US's response will be to this. It's already in play. In October last year, the US Treasury published a report, and it found that it said that cryptocurrencies provided malign actors with financial streams of income that can help them evade sanctions. And just today, I actually wrote a story about some additional sanctions that are going to be put forward by the United States, building on an existing executive order from this administration to target, and I quote, deceptive or structured sanctions or dealings to circumvent any US sanctions, including those through the use of digital currencies. So this is certainly something that the US is not blind or ignorant to, and I would say that the same would go for the rest of the world.
Well, and all this said, at least for now, crypto exchanges, including Binance and Coinbase, have said they will not implement a blanket ban of all Russian addresses, as Ukraine's vice prime minister has called for, saying that they would instead only continue complying with blocking accounts of sanctioned individuals or entities. What do you think was potentially behind this decision, and what do you think was being considered by some of these platforms in making this announcement?
Sure. Well, I mean, these announcements have come hot off the heels of Ukraine's Vice Prime Minister, so Mikhailo Fedorov, who called on all major cryptocurrency exchanges to ban Russian users. And Binance, Kraken, Coinbase have all said that there are no legal grounds to do so, and they have all reiterated that they will comply with sanctions as and when that they are put into place. And I think that what's interesting here has been there's a discussion within the wider crypto industry about what the role of cryptocurrencies are for, and many folks believe that they are, in terms of emancipating financial access for individuals. That's something that sanctions are a little bit anathema to people in the crypto industry. So I think that there's that, and that there's a deeper ideological discussion to have there. But there's also just the fact that these exchanges have pointed out there is no, as of right now, legal grounds to actually ban these users coming out of Russia. Now that in the coming days and weeks might change. The Ministry of Digital Transformation in Ukraine is reportedly preparing legal demands to put forward to these exchanges. And as I said already, the US Treasury's Office of Foreign Assets Control, which is the sanctioning authority in the United States, is preparing to build on that pre-existing executive order from the Biden administration in order to more closely target transactions that are deceptive or structured that use digital currencies in order to circumvent US sanctions. So this is obviously a fluid situation. It's still developing. And as and when some of these sanctions might hit the crypto industry, we might have to see a change in decision-making with regard to different exchanges.
Scott Cipollina is Decrypt investigative journalist, and we thank you so much for your time and for helping us make sense of the price action and the developments today in the cryptocurrency space.
All right, up next, what to track on this volatile day for markets? That's on the other side of this break with our very own Jared Blickery. Stay with us.
Oh, hello. Hey there. Sorry, I got...
Welcome back to Yahoo Finance Live. It is Tuesday, March 1st, and we're about 25 minutes until the closing bell, and we are seeing the sell-off accelerating on Wall Street, all three major averages in sharply negative territory. But for more on the market action and a deeper dive into what we're seeing with today's price action, let's head over to Yahoo Finance's Jared Blickery, standing by on the Interactive. Jared.
That's right. We got to begin with the bond market. Didn't have a lot of time to get into it with the last market hit about 30 minutes ago. So I just want to follow up on this. This is the 5-year T-note yield, and it is trading 17 basis points to the downside. Absolutely huge move, especially when you factor in where it was only 2 sessions ago. This was Friday, still in the upper range of its trading range over the last few months. As you can see here, very much breaking down. And we know that when we see huge moves in the bond market, a lot of time it spills over into equities. Almost doesn't matter sometimes which direction it's going, as long as you see that huge movement. Here's a 10-year T-note yield down to the lowest price since the beginning of the year. You'd have to go back to early January to see that. And Goldman Sachs was weighing in on the move today. I'm writing about it at yahoofinance.com, basically saying that the move is overdone. A lot of market participants trying to figure out, have we reached peak Fed hawkishness? Well, the pendulum might have swung in the opposite direction. The market might be discounting too much the fact that the Fed is going to be dovish. In fact, I was looking at the odds of a rate hike in March, and so far, 50 basis points, 0% now, 25 basis points, almost 100%. And guess what? The Fed standing pat, doing absolutely nothing. Non-zero. I think it's 0.2%, but just goes to show you how far that pendulum has swung as well, because it was only a couple weeks ago that it surged to 3 possible rate hikes. That's 75 basis points for a split second there. Let's move on to, let's see, the general markets here. I was looking at the sector action. Of course, we have to focus on energy. Energy, the only sector in the green today, and that's off the back of some of these movements that we're seeing in the futures markets. Simply incredible, as you can see on your screen here.
And Jared, I want to talk currencies now. What are we seeing with the stronger US dollar?
Yeah, it's not just the dollar, it's the ruble. And in fact, let me go to our currency map here. And this is going to take 1 second, but I think it's going to be worth it just to show what the price moves have been as denominated in the US dollar. So unfortunately, that's not working, but we can see these on a chart basis. Here is the euro. Now, the euro has been making some pretty big moves. We know that Europe has more exposure to the Ukrainian-Russian conflict than the U.S. does. And in fact, the euro has been weakening. So euro, when it moves down, that means it's weakening versus the U.S. dollar. And that is what has been happening here. But you take a look at what's been happening, for instance, with the Russian ruble. Now, the U.S. dollar is up. This is kind of the backwards of the cross currency we were just looking at. If this moves higher, that means that the U.S. dollar is strengthening and the ruble is weakening. But 39% over 5 days, we haven't seen anything like that since perhaps the Turkish crisis of their currency. However, the Russian central bank doing the right thing and increasing their interest rates to deal with the problem. Nevertheless, a surging U.S. dollar has been a headwind, not only for a lot of multinationals, not only for emerging markets, but also for crypto assets. So pretty interesting to think about that as well.
Okay, so you said the magic word here, and so I got to chime in, Jared. Crypto. Yes. What have we seen there as there's been this flight towards cryptocurrencies as of right now? We were taking a look at Bitcoin as well just a few moments ago.
That's right. And David Hollerith of Yahoo Finance has been writing and talking about the correlation, the increasing correlation of Bitcoin with risk assets, specifically U.S. stocks. Now, we got this huge liftoff yesterday, Monday, from lows around 37,500, as you can see on the screen there, continuing the move today. But if you put a 3-month price chart on, and I'm going to put some candlesticks on so we can see the exact price action. You can see we're kind of tracing out a W bottom right here, but we have not been able to breach the neckline. So classic technical analysis holds that once you breach this neckline, you have a chance to get to a measured move. You take this low, you take that high, you add it here. And so we're looking at something like 55,000. And in fact, that's a pretty important price level going back several months. So we'll have to see what comes of this nascent crypto rally. But I was talking to one of my favorite crypto analysts. He thinks that this could be an important low, but he's just a little bit concerned that it's gone too far, too fast over the last 2 days, maybe short covering. So again, it's going to have to rally above 45,000 in order to see that next price level. And who knows what the headlines or correlations are going to bring.
All right, we'll continue to watch those key levels. Thanks so much for charting those for us, Jared. Appreciate it. Yahoo Finance's own Jared Blickery with the breakdown there. We've got just about 20 minutes left till the end of today's trading activity, everyone, and much more to come during today's show, including our sanctions that include the WTO, on the table amid the Russian invasion of Ukraine. Representative Kevin Brady joins us ahead of President Biden's State of the Union address tonight with what the Texas Republican believes the next step should be among a coalition of countries in order to hold Russia accountable. That's next.
Welcome back to Yahoo Finance Live. Well, we've been talking a lot about the moves in U.S. stocks today, but there's also been a lot of action in the bond market as well. Now, we're seeing the Treasury yield curve flattening during today's session, that 10-year yield down really quite sharply, about 13 basis points and hovering at just about 1.71%. We are seeing some of those shorter duration bonds really, their bond yields really selling off as well. And earlier today, we did have Jean Todd, who is Fiduciary Trust in International EVP and Head of Regional Markets, really describing to us about how this flattening yield curve really a signal here that investors are starting to price in the prospects of slowing economic growth here in the U.S. But taking a look as well at the volatility that we're seeing play out across markets with the CBOE Volatility Index, or VIX, that is also spiking now to the highest level that we've seen since February 24th, the day that Russia first gave signs of that invasion in Ukraine. Peaking today, the VIX peaking at just over 35, now trading just about the 34 level. So coming off those highs, but again, still highly elevated as we continue to watch the conflict play out between Russia and Ukraine.
All right, well, let's take a look at the U.S. response to Russia's invasion in Ukraine, as well as the potential fallout and how that might impact President Biden's State of the Union speech tonight. Joining me now is Representative Kevin Brady for Texas 8th District and lead Republican on the House Ways and Means Committee. Thank you for joining us today. Now, starting with the Russia-Ukraine conflict, you've said that Russia's aggression in Ukraine makes a mockery of the rule of law, including the rules-based trading system, and our response must be strong and effective. What is Congress doing to put pressure with sanctions or by other means on Putin, as well as you see these attacks still continuing?
Yeah, thank you very much. So there's no question economic sanctions won't stop those bullets or those missiles. So lethal aid is the first and foremost way we can help Ukraine. They've made that very clear. But as far as economic sanctions, the world has changed over the last few days. And I think every country in the West, because of Ukraine's bravery here, is now engaging, I think, in a far more effective manner. Certainly with Russia's aggression here, countries like America ought to be evaluating Russia's role in the World Trade Organization, which by its very nature is a rules-based trading system. This is, and we ought to be, I've noticed more momentum over the last 2 days about an import ban of some design on Russian products. I don't know how that moves forward, but I know there is more of a bipartisan interest in that here in Congress, and the two really ought to be considered sort of together because they have that same impact. You probably know this as well. WTO can't just suspend a member. It's a consensus-based organization. This will take multiple countries taking action to repeal the most favored nation status on Russia, which, as you know, would increase tariffs on those Russian products.
So then obviously with so many countries needing to be involved with this holistic approach, then you've said it's important to be economically strong as we are militarily strong when it comes to confronting President Putin. How should the president go about striking that balance then, especially given where inflation already was before the conflict and how U.S. consumers are struggling with the prices right now?
Yeah, so we know, inflation really jump-started after the passage of the president's $2 trillion COVID stimulus in March. I think he denied it and dismissed it for far too long, as did the Federal Reserve. And right now, for Americans, as the president takes the stage tonight, he ought to recognize more than half of Americans believe the economy in America is in a recession or depression. And 2/3 believe that prices will outpace their paychecks for the next 2 to 3 years. So I think it's crucial that the president acknowledge his mistakes on the economy and take concrete actions. And in my view, one, it's all about the workers right now. And so all the emergency COVID programs that discourage the jobless from returning to work need to end. The president needs to drop the tax hikes on American businesses that would drive inflation higher and make us economically vulnerable to China, Russia, and other foreign countries. He also needs to end the Build Back Better provisions, because some of them, in fact, drive up childcare costs and other issues that would actually discourage Americans from returning to work. There are a couple other recommendations I have as well dealing with trade, but clearly I think the president needs to reverse course in a major way. If he's serious about our recovery being as strong as it can, and if he's serious about ending the worker shortage and driving inflation down.
Now, as you mentioned trade, in your comments today, you said that Biden should focus on an aggressive trade agenda and open new markets. Which trade partners should the U.S. be exploring or expanding into?
Yeah, so clearly we need more workers for the economy. We need more customers, and we know where they're at. They're outside of America. Right now, President Biden's trade agenda is basically a trade moratorium on new free trade agreements, exactly the time we should be leading on trade. Certainly, China's predatory and very aggressive trade agenda, as well as our competitors like Japan and Europe and others, they're on the field reaching trade agreements that advantage their farmers, their manufacturers, their workers over American ones. So I think there's bipartisan support quickly for an agreement with the UK. I think there is bipartisan support for engaging in the Asia Pacific, including a second, more comprehensive agreement with Japan. Certainly, there's been bipartisan support for an agreement with Europe, as well as looking at new regions like Kenya, Africa, other areas that we think could be door openers to better engagement in the developing world.
Now, I want to turn to obviously the global economic fallout as we see markets sort of swinging wildly depending on what they think is going to be happening next with the conflict. Now, Moody's Analytics chief economist tells Forbes that he expects the global economic fallout to be modest, but that if oil prices stay above $100 a barrel for a while, which obviously we did see those levels today, he said that US consumers could be seeing costs of about $80 billion more at the pump. So what can be done for consumers at the pump right now?
So I think it's important to avoid gimmicks like a temporary suspension of the gas tax. One, it doesn't address the underlying issues, which is we're not producing enough American-made oil, and the president's really had a pretty aggressive attack on American-made energy, from pipelines to refineries to production themselves. So I think the president, frankly, has created much of this. The answer is to reverse those policies. We did have high gas prices at times during the Trump administration, but our economic growth was so strong because the policies were in place to produce more affordable energy here in the U.S. I think we need to return those types of policies.
And just quickly, a post-ABC poll showed that 6 out of 10 Americans are feeling inflation has caused financial hardship in their households, even more so for those making under $50,000 a year. In a midterm election year especially, what can be done then? What are some of the economic policies that could give a boost to the economy right now?
Well, I think, again, since the president drove this inflation, he takes responsibility or bears responsibility for solving it. And clearly, the first thing he can do is not make it worse. The Build Back Better plan will make it worse. The higher taxes will drive more inflation. More government spending in the trillions will fuel more inflation as well. And again, he's got a number of proposals that would actually discourage Americans from returning to work. Those need to end. They need to be taken off the table. It's all about the workers right now, and the focus ought to be reconnecting them to work.
We do thank you for your time and your insights. Representative Kevin Brady there for Texas 8th District and lead Republican on the House Ways and Means Committee. Thank you for your time today.
Just minutes left in today's trading session. We've got the key levels to watch going into the close after this quick break.
Welcome back to Yahoo Finance Live. We're just about 5 minutes away from the closing bell, so let's take it over to Jared Blickery on the Interactive.
That's right, and we're seeing the acceleration of losses into the close. The Dow now down nearly 2%. You can see just a little bit of a rise here, but nevertheless, all the other indices looking the same way. And the Dow set for its worst day, not only of 2021 or 2022, but also since November of last year. And we got some breaking news on Apple I want to share with you. And of course, is regarding Russia. They are pausing all their product sales in Russia, and we saw the price bleed a little bit lower, not a spike lower on that news. But also their online store in Russia shows their products as unavailable. And then in a separate move, they're going to remove the RT News, that's formerly Russia Today, and also Sputnik from stores outside of Russia. They're disabling traffic and live incidents in their Apple mats in the Ukraine, likely due to security concerns there. So once again, Apple says it has stopped all exports into Russia sales channels. And you can see the stock heading lower into the close here. The mega caps not under the most pressure today. They should have gotten a little bit of a reprieve from the falling, or should I say crashing yields. But you take a look at some of the chip stocks. That's where we've seen a lot of the action centered today. We see Nvidia down 4%, AMD off 8%, and a lot of these down similarly. Also taking a look at some of the ARC components as a sentiment indicator, not seeing a lot of green here. And then finally, we want to check out the travel sector, and that is seeing some steep losses as well. Royal Caribbean down 9%, guys.
Jared Blickery, thank you so much for that, and we'll check back in with you in a bit. And coming up after this short break, we'll take you to the closing bell and beyond and break down those earnings results from AMC, Salesforce, and Nordstrom live for you. Stick with us.
Welcome back to Yahoo Finance Live, everyone. Just seconds away from the end of today's closing bell, the first trading session that we're concluding here in March of 2022. We are, yes, indeed, March 1st, 2022 here. We've made it to March at this point. Dow Jones Industrial Average right now is sitting down by about 600 points. That's lower by about 1.7, 1.8% going into the close. The S&P 500, you're also seeing that lower by about 65 points, 1.5% in the red. The Nasdaq Composite, that is down right now by about 213 points going into the end of today's trading activity, down by a little more than 1.5%. 1.5% as we've continued to track that for you throughout today's show. Brad Smith here, of course, with Emily McCormick and Rochelle Akufo. And as we get to the closing bell, we've got some earnings that are going to be coming forth after the end of today's trading session. We're going to be watching for ticker symbols AMC, CRM, and JWN. Of course, AMC, Salesforce, and Nordstrom. We're going to be keeping close eyes on all of those major averages. The closing bell has officially rung here on the day. We've struck 4 p.m. And so as we're seeing things right now, it looks like we're going to end the day in the red, Emily.
Absolutely, Brad. And let's bring in our market panel now to make a little bit more sense of the trading action. We saw, of course, a lot of red across the screen, across the S&P 500, Dow, and the Nasdaq. But here to break this down for us is Ahmed Riesco, Insignio, Chief Investment Officer, as well as Ed Al-Husseini, Columbia Threadneedle Senior Analyst. Ed, I'll turn this first question over to you. What do you make of today's moves, and is this potentially an overreaction to the downside across U.S. equities?
Yeah, not yet. I think broadly, there's a bid for liquidity, and we see that in rates markets as well. A significant rally in rates in Europe and the U.S. Really a bid for safe haven assets and the corresponding move out of equities and out of credit risk. So far, I don't think it's really an overreaction. I think it reflects the fact that the Fed is stepping back into an environment where the Russia and Ukraine situation has injected a tremendous amount of uncertainty.
And Ahmed, when we take a look at the price action that played out in energy commodities, crude oil prices, of course, spiking above $100 a barrel on WTI. Earlier today, the IEA agreed to release 60 million barrels of oil from various countries' strategic petroleum reserves, including from the U.S. Why do you think that that's not being met with a bearish response from energy commodity prices?
Yeah, the problem is that would not be enough to offset a potential supply shock coming from Russia, which is really what the market is grappling with right now. To me, the key question that all investors have to ask themselves is are Russian exports going to stop, right? And if the answer to that is yes, then we need to de-risk further. If the answer is no, then this could be potentially near a bottom here in the short term.
And Ed, I want to bring you in here on Europe. We know that Europe will be most impacted, bear most of the brunt from what happens in Russia, Ukraine. But what are you watching with the European Central Bank's response to this?
Yeah, well, so far what we've seen is that the European Central Bank has definitely sort of pushed back even further in the dovish camp due to the conditions there on the ground in Europe. I think it's the correct response given the uncertainty and the tightening conditions that has happened as a result of this. But again, ultimately, this is going to be a political decision in Russia and in Europe. And really, it all has to do about the Russian exports. Europe could not withstand a cut in Russian exports of oil and gas without suffering a deep and severe recession.
And Ahmed, when you add into that then prolonged high oil prices, which are supposed to start eating into global growth if they continue this way, and that in turn could affect earnings, how is that informing how you're advising clients right now and any opportunities that you see?
Sure. Well, what we've done is that we've slightly lowered our growth forecasts globally. We've lowered them a bit more in Europe. But really, what we're advising clients is a de-risk out of European equities right now, even though we think that is a sort of an attractive long-term play. We think the uncertainties right now are just too high, especially for more conservative investors. And really to focus parts of their portfolios either with hedges, like geopolitical hedges, such as commodities, which have been working rather admirably well, and also rotating to those sectors of the economy, or sorry, I should say of the market that will perform well in a rising rate environment. Because I do think that once we get past this patch, that sort of story of rising rates will resume, and those sectors will start to outperform once again.
And Ed, what's your playbook for right now? Investors just want to know how they can stomach some of the volatility that we've seen over this past week, even taking into account what we saw at the tail end of last week with a move higher. But again, this broader question of have we seen a bottom actually solidly put in, and the uncertainty of that very question itself, leading a lot of investors to try and figure out where their rotationary strategy should be.
Yeah, I think it's an environment where duration, particularly exposure to rates in Europe and to an extent here in the U.S. has been quite attractive. So being neutral to slightly overweight in the rate space to give those portfolios cushion against the uncertainty, and cushion for an environment in which the Fed and the European Central Bank might be delaying their tightening cycles, I think is a really good place to be. At the same time, I'll note in the credit universe, in emerging markets, in investment grade credit and high yield credit, there are a lot of high quality names that have been dislocated by this that present a quite attractive entry opportunity right now.
Okay, and so similarly along those lines, Ahmed, to you, with regard to what we heard from the ECB today, we can't necessarily perhaps call this an entire bottom, because that would be perhaps dismissive to the fact that this move lower was started by the risk of the Fed, and we still don't know what the Fed will do in concert and if they will lean more of the ECB's direction. Do you think that is the likelihood that the Fed, the FOMC, will also kind of signal that, hey, stimulus and some of what we've put into place and being as dovish as we have been and as accommodative as we have been, that needs to remain in place while the international conflict hasn't sorted itself out?
Yeah, I think that investors that have been used to or gotten used to the Fed and other central banks coming in at the last second and rescuing them are going to be in for a bit of surprise this time, because the nature of the economy right now and what's happening out there is very different to what we've seen over the last 10, 15 years. That Fed put is a lot less likely to be there. In fact, the risks are that we go into an inflationary shock. So the Fed is not going to be able to pull back too much from its hawkish stance.
Ed, we've been hearing from a number of strategists now pointing out that in the past, markets have eventually and usually quickly recovered from geopolitical conflicts and events. But is there reason to believe that this time may be different and contribute to longer lasting volatility and potentially a deeper drawdown in markets?
Really hard to say. Really hard to say. This is in some ways a distinct environment in which we have high inflation. We have central banks that are on the cusp of withdrawing support, with fiscal policy that's slowing in the U.S. and in Europe, and we've had this new injection of uncertainty and higher oil prices. Every environment like this, I think, is quite distinct, and it's just too early to tell.
And Ahmed, as we look at some of the people trying to find safe havens in all this, at one point we saw a lot of cryptocurrencies tracking with stocks, but then even though we're seeing the markets down today, we're still seeing cryptocurrencies on the rise. Any idea in terms of safe havens that you're looking at where you see opportunities right now?
Now, look, I'll tell you one safe haven that we've actually been investing in for quite a while and is acting quite well are Chinese sovereign bonds in renminbi. One sort of offshoot from a sort of longer term consequence of what's happening is that the renminbi is going to be increasing its share as a reserve currency around the world. Russia, for example, is going to have to be moving some of its central bank reserves into renminbi. And I think that that's going to be positive for the currency. So I think strength in that currency will continue. At the same time, China is actually in an easing cycle right now, which is totally decoupled from what's going on in the rest of the world. That means that Chinese sovereign bonds, quasi-sovereign bonds, are going to continue to act as very attractive safe haven assets with an attractive carry versus treasury and bonds.
And so just as a follow-up to that, Ahmed, because when we think about China's role as of right now and their pact with Russia at this point in time, when we think about where the U.S., as we were discussing with Kevin Brady, Representative Brady of Texas, just a few minutes ago, looking for other international partners, is a time like this one that would accelerate the opportunity for those international partnership and other customers around the world, or is it one that would be a deterrent for a long-term partnership?
Look, as far as the Russo-Chinese, let's say, warming of relations that has occurred recently, it's a very transactional one. These two sort of geopolitical regions have been historical adversaries. So there are ruptures there that the United States, if it deploys foreign policy in a deft manner, might be able to exploit. So it might be a short-lived one, but for the foreseeable future, that relationship should strengthen.
All right, we'll have to leave it there for now. Ahmed Riesco is Insignio Chief Investment Officer, and Ed Al-Husseini is Columbia Threadneedle Senior Analyst. We thank you both so much for your time and insights this afternoon. Well, earnings results are continuing to roll in this afternoon, and Yahoo Finance's own Inez Ferre is standing by with the numbers from Nordstrom's. Inez?
And Emily, the retailer posting earnings per share for its latest quarter of $1. That was a big beat because the street was expecting 99 cents a share. Revenue came in at $4.4 billion. The street was expecting $4.36 billion. Eric Nordstrom, Chief Executive Officer of Nordstrom, said, "Our team continues to work with urgency to accelerate our progress and invest in our capabilities to better serve customers and profitability grow sales." Our primary focus is on three areas: improving Nordstrom Rack performance, increasing profitability, and optimizing our supply chain and inventory flow. Also, some commentary on their earnings release from Pete Nordstrom, President and Chief Brand Officer of the company, saying, "Looking ahead, we are focused on more effectively balancing inventory with demand while increasing efficiency throughout our network and delivering newness and selection to our customers." The street really liking these results because the shares are up in after hours. There are 22 buy recommendations on this stock, 13 hold and 5 sells, with the average price target at $25.50 a share. Right now, shares are soaring. Emily?
Indeed. Well, thank you so much, Ines, for reporting there. All right, well, we'll keep this earnings bust going with Salesforce also reporting after the bell. For that, we'll bring in our very own Jared Blickery. Jared?
That's right. We can see the stock popping about 4% in after-hours trading, and that's after beats on most of the headline numbers here. So adjusted EPS for the quarter coming in at 84 cents a share, beating the street estimate by about 10 cents. And that's down a little bit from last year of $1.04. But also looking at the subscription and support revenue, that came in at $6.83 billion. That is up 25% year over year, and that's just slightly higher than the estimate of $6.8 billion. Now, total revenue came in at $7.33 billion. That's up 26% year over year. And professional services and other revenue, that broke down to $498 million, beating the estimate of $467.5 million. Also, the current remaining performance obligations, those come to $22 billion. That's slightly higher than the estimate of $21.46 billion. But I think a lot of the estimate here is on their 2023 year forecast. So they're seeing 2023 revenue of $32 to $32.1 billion, beats the estimate of $31.76 billion. Now, adjusted EPS for the year, the full-year guidance, and also the quarter guidance, a little bit short, but that's coming in at $4.62 to $4.62 to $4.64. Estimate was for higher at $4.75. And now finally their estimate for the first quarter adjusted EPS of 93 to 94 cents. The estimate was for higher $1, but they are beating on the revenue number. They're seeing first quarter revenue of $7.37 billion to $7.38 billion, higher than the estimate of $7.26 billion. I do have a quote here from Amy Weaver, their president and CFO, saying, "Fiscal 2022 was a remarkable year for Salesforce. I am particularly pleased with our focus on discipline and profitable growth, which drove record levels of revenue, margin, and cash flow. Confident in the momentum of the business as we build an even stronger company in fiscal 23 and beyond." According to Bloomberg data, there are 42 buys, 7 holds, and 0 sells on the stock. And let's get a quick picture of what the stock has been doing recently. Here it is over the last year, and you can see, like a lot of these stocks, especially the higher priced growth names, it has fallen off considerably from those highs in the fourth quarter of last year.
All right, thank you for that update. Jared Blickery there reporting for us. All right, on the other side of this break, another look at the Russia-Ukraine latest, this time with a focus on President Putin's endgame. Stay with us.
The world continues to monitor the latest on the war in Ukraine as Russia's attacks escalate in some of Ukraine's largest cities. Joining us now to break down the latest on the geopolitical situation is Ian Bremmer, Eurasia Group founder and president. Ian, thank you so much for your time this afternoon. We're hearing now that Russia's attacks in Kyiv and Kharkiv have grown more brutal while Russian forces have been met with increased resistance. Are you surprised, and do you think Russia is surprised with the scale of the response both within Ukraine and from the rest of the world in response to this invasion?
I think they're very surprised by the response internationally. It is clear that the history of Russian escalation has been met mostly with very limited and fragmented response. Think about when they took a piece of Georgia in 2008, when they took two pieces of Ukraine in 2014, when they intervened in the US elections in 2016. This time they've got Biden focused on Asia after Afghanistan, and then Merkel's gone, and Macron's thinking strategic autonomy. They had every reason to believe that the response this time around was going to be a lot weaker, and it wasn't. I mean, this feels like a huge red line that they crossed, and suddenly everyone is piling on. Literally everyone. I mean, you've got in Monaco and Switzerland, you have them cutting off and freezing assets. You've got Luxembourg sending jeeps over and anti-tank missiles to the Ukrainians. I mean, it's astonishing just how angry the advanced industrial economies are at Russia right now. And I think that Putin clearly did not expect that his economy would be devastated as a consequence of his decision to invade Ukraine.
And given these sanctions and the level of Russian isolation that the rest of the world has really put Russia under at this point, how much economic strain can Putin afford to withstand among the average Russian people before he's forced to change course?
Well, forced to change course is a pretty high bar. This is probably going to cost the Russians some 5 to 10% of GDP all in. On top of the underperformance from the sanctions that existed from 2014, which were pretty marginal, but did matter. That's roughly equivalent to the sanctions that the Americans and the Europeans put on Iran. Now, it matters a lot more because Russia's a much bigger economy. It's interconnected with the world economy. It has the potential to have a Lehman Brothers type moment spillover effect. But in terms of the ability of the Russians to survive this, to live with the so-called resistance economy, to say screw you to the United States and Europe, I do believe the Russians will have significant capacity to withstand it if they want to. But the point is that if you combine the decoupling long-term of Europe from Russia, I mean, they're literally going to move their energy dependence away from Russia. That'll never come back. Combine that with the forward deployments of NATO into the Baltic states, probably permanent basing agreements coming, and Poland and Romania and Bulgaria. Combine it with the Finns now talking about wanting to join NATO. And once they go, the Swedes probably will as well. Combine it with the Germans that are now announcing that they're going to send weapons to Ukraine and they're going to spend 2% of their GDP on defense. I mean, you put those things together, this is obviously and dramatically worse for Russia's strategic position in Europe, which you'll remember is a big part of why Putin started this to begin with, than anything that he gains in the best possible scenario for Putin. And we're not there on the ground in Ukraine.
And as you're mentioning, with so many of these countries now getting in on the action in their support of Ukraine, you've said that European governments now realize that their post-Cold War decisions to increase their dependence on the Russian economy was a strategic mistake and should be undone. But when you are this closely connected in this highly ever globalized world, what does that look like in real terms? And what sort of economic fallout could there be then for these countries that do try and cut off Russia or ease off their dependence on Russia's economy?
Well, this is less of an America problem. It's less of a France problem, which gets most of their energy from nuclear plants. And of course, the Germans should be doing that, and they're not. High-level German officials have told me very clearly that Nord Stream 2 is a strategic mistake. The dependence they have on Russian energy is a strategic mistake, and they're going to undo it. Now, there's a reason why the decisions to hit Russia so hard with sanctions do include cutouts for the ability to pay for gas and oil coming to Europe, because it's still necessary for the European economies. They want to, even with their anger, they'd like to still be able to keep their people warm, right? And the Russians want to make that money. But a lot of that pipeline system runs through Ukraine. So clearly there's a big war going on. It's vulnerable to getting destroyed by either side, frankly. And it's also vulnerable to the Russians cutting it off in a fit of pique, even if it means that they're going to take economic costs because they want the Europeans to feel that pain. Now, if that happens, there's no way the Europeans can make up that gap with gas from the US or Japan or Qatar or Azerbaijan. There just isn't enough that's unspoken for. So prices would then go way up, and you'd have to see rationing across many European countries. And you're still in winter, it's still fairly cold, and people would be really angry. You'd see demonstrations, I have no doubt. But I will tell you, I mean, you've got 80% German approval right now for spending 2% of GDP on defense. That's astonishing. I mean, the anger of the German people at what the Russians have done is so far beyond the imagination of where you could have been a couple weeks ago, 5 months ago, 2 years ago. And I do think there's a greater willingness to take hardship. What's basically happened, and it's a very simple way of thinking about this. When the Soviet Union collapsed, we had a peace dividend. The world benefited from not having to think so much about national security, not have to pay so much about national security, instead leaning into globalization. That peace dividend is gone. And it's not just gone for a month, it's gone for the foreseeable future. And the Europeans are the ones that are going to pay the most.
So then when you look at some of these strategic alliances, whether it's China showing some support for Russia, and then you also see the West and their sanctions, it's a question that you don't really want to know the answer to, but militarily, how far do you think Putin is willing to go if he's cornered enough?
Well, there's always the possibility that he climbs down. I mean, you'll remember when the Iranians had been engaged in all sorts of malfeasance in their backyard, including the attacks against the largest refinery in the world in Saudi Arabia. The Americans suddenly decided to assassinate the head of all of their defense capabilities. And the Iranians thought about retaliating and then said, maybe we shouldn't do that. So if Putin is rational in the way that Western leaders are rational, you can see him climbing down when he sees he has no good alternatives. But so far, that's not the way he behaves. I mean, a lot of people would have said there's no way he's going to do a full invasion into Ukraine, and he did that. And a lot of those same people are saying there's no way he'd ever consider using nuclear weapons when he rattles them. I wouldn't say never. So, I mean, I think we have to be clear that just how costly this is going to be for Russia and just how much danger that could pose to Putin himself, where losing power isn't getting voted out, it's you're dead. We're playing with some fairly high stakes. And that might well mean that Putin is willing to directly threaten NATO countries. I saw this from former President Medvedev. The French government said that they're going to war economically against Putin. And Medvedev, who was, a relatively soft-spoken guy, said, don't use those terms because an economic war can become something very different very, very easily. And Lavrov has talked about the possibility of direct military, sort of impact if for the responsibility of all of those NATO countries that are providing weapons that are being used against Russian soldiers in Ukraine right now. The foreign ministry warned the Finns and the Swedes there would be military consequences if they tried to join NATO. Putin himself has said that he's upping the readiness of their nuclear forces, their so-called deterrence forces. So it's not just a one-off. The Russians are saber rattling directly with NATO on a number of occasions. They want NATO to see that they're prepared to go all in. Do I believe that? Not completely. Why would I believe anything that Putin says at this point? He lied directly to the face of every NATO leader about the fact that he wasn't going to invade. So I don't put stock in what Putin says, but their capacity to escalate is real, and they are getting cornered.
And so, Ian, as you've mentioned here, much of the end game, it hinges around the mental state of Russian President Vladimir Putin. How large of a question mark does that remain to as the economic detriment has already started to be incurred? And for whatever the economic detriment is that he is willing to take on for Russia, or on the other side of this, embark on, given the threat of cyber attacks that he's already kind of thrown out there on the table?
Oh, we're clearly going to see cyber attacks more broadly against NATO, not just against Ukraine. I would be stunned. I mean, he stopped supporting the cyber attacks against critical infrastructure after Biden asked him to when they met in Geneva back in June. That's coming back. There's no question. But might there be other sorts of attacks that would be made? Might they cut off all the energy that goes into Europe? Might there be incidents where they're harassing NATO vessels in the Black Sea or aircraft, for example, around the Baltics? Absolutely. And this is a very dangerous environment. So, I mean, again, we have to think about what it means to have this level of confrontation with a country that has 5,000 nuclear weapons and a leader that feels increasingly cornered. Now, President Putin, I mean, he doesn't look like the same president that was, giving these 3-hour without notes State of the Union speeches and taking questions from on every topic from all of these different journalists and citizens. He doesn't have that level of coherence. And the speeches that I've seen Putin give in the last few weeks do imply that he's lost a step or two. I mean, if he were the American president, we'd already be saying his brain was oatmeal, right? I mean, we know what that's like. But a lot of that is taken out of context too. And the fact remains that the Ukrainian government is winning the war on information. They're the ones with the millions and millions of Twitter followers right now. They're the ones with the leader who is considered a folk hero globally. And they're the ones that are doing better in getting misinformation out to try to get people to be more sympathetic. You saw the Snake Island 13. They said they told the Russian warship to F off and they all got killed, except they didn't get killed. They all got captured. But everybody believed that and they were sympathetic to Ukraine. Now, there's reasons to be sympathetic to Ukraine. Don't get me wrong. I'm simply saying that there's lots of misinformation out there that probably paints Putin as an insane person. And I would be careful before I took that at face value.
And so even if there was a puppet government installed in Ukraine, then what after that? Would there be any legitimacy to that?
No, there's no legitimacy
from the Ukrainian
There's no
people
legitimacy.
at all?
There's no legitimacy. Of course, there's no legitimacy. At this point, there's no legitimacy of the Russian government. There's no legitimacy of the Belarusian government. So, I mean, a puppet government, of Ukraine, it's like double jeopardy, no legitimacy. What do you want me to say? But the fact is there will be a Ukrainian government in exile, maybe in the Western Ukraine, if the Russians are incapable of taking it, maybe in Poland, maybe in France. Every Western government will recognize that Ukrainian government. They will provide them with aid. They will provide them with weapons. Those weapons will be sent to partisans who are fighting against Russians on the ground in Ukraine. I was talking to my friend Dave Petraeus the other day. He said that Putin has swallowed a porcupine in Ukraine. I think that's right. I think that there is no scenario where the Russians occupy Ukraine and this goes well for them. I mean, frankly, the Russians should hope that their army loses in Ukraine, because that would be much better off for the Russians economically and strategically in the long term.
Certainly a sobering conversation. We do appreciate your insights. Ian Bremmer there, Eurasia Group's founder and president. Thank you for your time today. All right, stay with us on Yahoo Finance Live. We have more coming up after this break.
Welcome back to Yahoo Finance Live. And we want to get a check of one stock making major moves to the upside during this after hours trading session, and that's Nordstrom. As you can see, those shares are up about 37% in late trading, and that's after the company reported fourth quarter earnings and revenue that topped expectations. Now, taking a look at these fourth quarter results, earnings per share coming in at $1.23. The expectation on Wall Street was for 99 cents a share, and then on the top line, revenue coming in at just under $4.5 billion. Again, that beating expectations for $4.36 billion. Now, taking a look here at some other major stats, digital sales as a share of total sales came in at 44%. That was below what we saw at 54% in the same quarter last year, but still holding up pretty solidly when we think about the fact that last year consumers were still primarily shopping online during the ongoing pandemic. And then taking a look again at gross margin, of course, closely watched here for major retailers, also better than expected at 38.4% versus the 35.9% that Wall Street analysts were expecting. Now, some upbeat commentary coming here from Nordstrom's president and chief brand officer, Pete Nordstrom. He said in a statement this afternoon, quote, "We drove a significant increase in merchandise margin this quarter as we engaged customers through our compelling and expanded holiday gift offering while also reducing promotional activity," end quote. So clearly seeing quite a bit of margin expansion here for Nordstrom because of this reduction of these off-price Nordstrom Rack offerings, because there wasn't as much promotional activity going on here, and of course because there was still quite a bit of top-line growth when it came to sales and customer demand for Nordstrom's offerings overall. So again, seeing those shares moving higher by about 37% in after-hours trading and pairing some declines after falling about 13.6% for the year to date through today's close. We'll be right back.
Welcome back to Yahoo Finance Live. Now, earlier today, Yahoo Finance spoke to HP CEO Enrique Lores about its most recent earnings report and its outlook for the rest of the year. Here's what he had to say.
We had a very good quarter on PCs, very strong quarter. PC business grew 15%. Growth was driven by commercial. And what we see in PCs is that we have seen a tremendous growth of the market during the last 2 years. The market is more than $200 billion bigger now than it was before the pandemic. And we think the market is going to stay now at those levels for the foreseeable future.
Have you had to raise prices on your PCs because of what you're seeing with inflation?
Yeah, we overall are experiencing an inflationary environment. We're seeing cost increases both of components and logistics. and we have reflected them in our prices. And I would say this has had also a positive impact in our results this quarter.
How much is a PC? How much, if I bought a PC now, how much more would it cost me than the one last year because of this crazy environment we're in?
It's around 10, 15% higher. Of course, depends on the model, depends because some models have increased more, but I would say 10, 15% more.
Oh, good thing I bought my PC last year.
But you need to think about buying a new one, Brian.
Oh, yeah, of course, as the CEO of HP. But Enrique, we've been talking to you throughout the pandemic on the supply chain challenges. It feels as though we've been tracking this with you almost step by step. What's the state of the situation now?
I think we have continued to make progress executing the plan that we discussed a few quarters ago, and the results that we show today in PCs clearly reflect that. When we look also at the overall business, this is helping us to improve the mix, to really drive more volume to the categories where we see the strongest demand. And this is really what we have been doing, and we are seeing the results.
Where are the shortages most acute? To the layperson out there, is it, of course, we know the chips in the computer, those are in short supply, but is it screens? Is it buttons on keyboards? Where are you seeing it?
So overall, we have seen an improvement, for example, on screens. That was a big problem a year ago. Now we are in a much better position. The current shortages are mostly in ICs. They keep being in the low-cost components, for example, USB-Cs, that we need for our connectors. This is one of the areas where we continue to see the strongest impact.
The commercial side of the business was very strong, Enrique. Printer sales in commercial up 9%. Also strong in the consumer side of the business too, in terms of PCs up 26%. Why that shift? Does that reflect people going back to office settings and they need those more high-powered computers?
This reflects both more people going to the office and also companies and enterprises investing in improving the experience of their employees. Many companies want now to bring their employees back, and they realize that to get that done, they need to offer a better experience. And therefore, they are investing in both PCs and printers to improve that.
What types of printers are consumers or not? What type of printers are enterprise customers ordering right now?
They usually buy laser printers, and we are seeing a shift from buying large A3 printers, large A3 copiers, to smaller printers that they can distribute more in the office, because this delivers a better experience to employees.
I caught your, as you know, I'm an avid follower of you on LinkedIn and Twitter, Enrique. I caught your post on LinkedIn with regards to Ukraine and Russia. What are you telling your teams right now that are there, and what are they telling you about what's happening on the ground?
Sure, yeah. It is a very difficult situation, and the most important thing for us is really the humanitarian side. We have been in daily contact with our employees there and doing anything we can to protect them, to help them to go through this situation. At the same time, of course, we are following the regulations and the sanctions from the US. We have stopped all our shipments to Russia, and we really hope that peace will be restored as soon as possible to the region.
So let me get that. You have stopped shipments to Russia.
We have stopped shipments to Russia, correct.
How big is that business for you? Is that a big needle mover?
We will be quantifying in our earnings call that this will have an impact of about 3 cents of EPS in Q2. So it's a relatively small business. Remember that our EPS guide is between 104 and 108. So this gives you an idea of the relative size. So it's small business, but still important to do it and to follow the regulations and the sanctions that the U.S. administration has put in place.
Very much a purpose-driven leader, Enrique. And what is it like for you in this environment when there's so much coming at your teams, really across the world? Inflation, fears of a recession, now Russia and Ukraine. How do you keep it all together?
Well, I think the most important thing is to be very close to the teams, to show empathy, because as you said, we keep going from one problem to another, from a difficult situation to another. And the key thing is that they see us close to them. They see that the role of the CEO is to support in everything that they have to do. And at the same time, I have a lot of confidence in the teams. They have shown how to manage very complex situations in the past, and I know they will continue to do that in the future.
How do you think overall this year will be different for HP versus last year?
Well, I think the most important thing is that we are making progress in building a more growth-oriented portfolio. This was our most important strategy that we shared in our Investor Day, and we are really making good progress. This quarter, our growth businesses grew double digit. Some of them grew 20%, 40%, 20%, and we are on the right track for the growth businesses to surpass the 10 billion mark that we shared with investors in October.
Lastly, you also raised your full year earnings guidance. What does that include? Does that include a more optimistic outlook that the supply chain challenges you were just talking about, that does it end? Does it lessen? How do you see it?
Well, this reflects the strong momentum that we have and the progress that we are making also in the growth businesses. And this really is why we decided to raise guide. We delivered a very strong Q1 where we over-delivered by 8 cents, and we are raising both the year and the guide for Q2.
Welcome back to Yahoo Finance, everyone. In finance, fintech and emerging asset classes are offering to decentralize transactions and wealth generation, while for a whole different ballgame, name, image, and likeness deals are looking to decentralize a student athlete's value beyond what the NCAA has historically offered. So joining us now for a wide-ranging discussion, if that lead didn't tell you enough, and perhaps to draw some parallels, is Joe Moglia, who is the former TD Ameritrade chairman and CEO and Coastal Carolina University executive director of football. Plus, joining us for the discussion, we've got Yahoo Finance's sports reporter Josh Schaefer joining us here. And Joe, perhaps we can start off with the obvious, the market volatility amid the Russian invasion of Ukraine here. When you think about to your past life in business and some of the largest asset under management kind of fund managers out there, how might they be managing investment decisions through a Fed tightening and an international conflict environment?
Well, if you're an institutional portfolio manager, Brad, the whole issue is to make sure that ultimately, especially through times of crisis, you're doing a good job of protecting clients' assets. So they recognize, most of us certainly recognize that there's going to be incredible volatility while this whole thing is going on. That volatility, by the way, is not nearly as difficult to decide as what the Ukrainians are going through now. So we certainly wish all of them out very, very best. But you need to make sure that you're in the sectors that are going to get hurt the least in an environment like this. You want to make sure you're aware of kind of what's probably going to happen in interest rates down the road. And you probably want to hedge your portfolio a little bit. Or if you had in the beginning, when all this started to happen and the markets were still going good, that would have been a perfect time to trim. Because there's definite signs out there that there's going to be an issue.
So You departed TD Ameritrade and that amid the Charles Schwab acquisition and competing consolidation efforts in the trading platform industry. Just months later, we had the height of the meme stock saga. Do you expect to see any regulatory action in resolution of that significant early 2021 market event? And what type of protections do you think should be activated for retail investors?
I think the regulator is going to take a long time to figure out what's going on. When we go back to what was taking place then, frankly, I think the retail guys and the Reddit readers and all the different people that put together those initial trades really did an outstanding job. And the institutional world complained a little bit because of that. And there was all sorts of questions of what was happening to Robinhood, and all sorts of questions of what's going on with regard to the individual investor. These are day traders. And that was one of the greatest trades that we ever put on. The concern I have for them, for the day traders, is that when things don't go well, are they educated enough, or are they getting enough guidance, enough education to help them understand? So if you bought AMC at 10 and it goes to 20, you trim there. Like in 2 hours, and it goes to 40, you trim there. So at some point, you've got to understand the market's going to turn around, and how are you going to manage your position in a difficult environment? Today, we're in a difficult environment. Today would be tougher for the day traders than what it was 4 or 5 months ago.
Joe, we have to leave things there on the day, but we want to have you back on to continue this discussion and get to some of the name, image, likeness side of the conversation as well. That's Joe Moglia, who is the former TD Ameritrade chairman and CEO and Coastal Carolina University executive director of football, everyone. We're going to take a quick break and come right back on the other side.
Welcome back to Yahoo Finance Live. I'm Rochelle Akupo, along with Emily McCormick and Brad Smith. Now we're going to chat about what's been happening with Yahoo Finance's #1 story of the day. $10 toothpaste, inflation literally kicking you in the teeth. Now, Reuters reported that the Colgate-Palmolive CEO Noel Wallace recently said that the company's new Optic White Pro Series toothpaste was the type of premium product that's vital to its ability to raise prices and drive profit this year. Now, it currently retails for about $10 to $13. At those kinds of prices, you may as well just keep your mask on and save your money. But we are seeing that the Federal Trade Commission is eyeing these high prices. It's completing a probe March 14th with consumer goods companies that do include Procter & Gamble, Kraft Heinz, and Kroger, and it's asking them to turn over internal documents on profit margins, pricing, and promotions. Now, although strong consumer spending, though, and fewer mask mandates might mean that, hey, maybe consumers are willing to shell out that much more money for a nice smile.
Yeah, taking a look at some of these names here, especially in the CPG sector here, P&G, excuse me, Colgate-Palmolive, all of them ending the day lower here. But I think about one name particularly, which is one of the larger big box and wholesale brands out there, Costco, and how they may kind of benefit from an environment where consumers are looking to buy more in bulk at a time where they know some of the prices on individual packaged goods are going to impact them more largely, perhaps, than if they were to just go buy in bulk and see some of those discounts as a result of membership programs work out for them. I was tracking Costco earlier in the day. Last I checked, shares were higher, but given some of the acceleration that we saw into the close, unsure of where things ended here as I'm just taking a quick look at my screen here to my left. And they did end the day higher by about 0.7%. And Costco has been one of those names that when you do have an economic downturn or at least a hit on sentiment, it's always interesting to track names like Costco, some of those buy in bulk type of names. It's also interesting to track names like Emily brought up yesterday with Dollar Tree and Dollar General, where consumers typically lean into some of those lower cost offerings during times where there is a little bit less confidence, and in this case, spurred by inflation.
Well, Brad and Rochelle, I think when we go back to our main story here about this $10 potentially tube of toothpaste coming from Colgate-Palmolive, the question really is whether consumers actually pay these prices and contribute to this feedback loop about whether companies can continue to raise prices above and beyond the input price costs that they're actually seeing increase as well when we think about their supply chain disruptions and the raw material price increases on that end, the producer side and the wholesale side of the economy as well. Now, of course, as we see company margins expand, this is good for investors in the company stocks, not so good for the general public having to pay these higher prices. And again, to that point, we did have Colgate CEO Noel Wallace saying during the company's latest earnings call at the end of January that some of these price increases likely will contribute to what he called a fall off in volume. That's how he characterized it. So potentially some anticipation that, yes, these price increases are going to drive sales higher, but some of that may be actually offset by the fact that some consumers simply aren't willing to pay these higher prices. So certainly something to keep an eye on here as we have these next earnings reports. But speaking of earnings reports, we want to get one quick check here of Nordstrom, which is one of the companies that reported after market close today, seeing those shares still up about 38.5% in the after hours session. But Brad, I know you're taking a look at shares of Salesforce as well.
Yes, I see we have Nordstrom up on the screen here as of right now, and then we're just taking a look at some of the actuals versus the estimates, where we've been keeping a close eye on the shares reacting positively in after-hours trading, as you were mentioning a moment ago, Emily. The actuals versus the revenue, or the actuals versus the estimate, the revenue coming in at a big beat, $4.49 billion versus the $4.36 billion that was expected there. Shares jumping, as Destiny's Child would say, to the tune of about 38% in after-hours trading. And since you mentioned Salesforce, ticker symbol CRM. This is a company that has been in decline over the course of this year and even dating back to some of the highs that they had seen over the course of 2021 and levels there, moving off of those levels, those highs by about 30%, I believe, at last check. And here on the afternoon, you're actually seeing the actuals versus the estimates. The revenue, that came in at a beat. That was $7.3 billion versus the $7.2-ish billion that was expected. And there you're taking a look at shares. On the immediate reaction, they did move lower. They were down. However, now you're seeing them actually move higher here by about 3.8% in after-hours trading. And so we'll see what the company has to say on that earnings call as well. And the areas of interest for investors that they're going to to be peppering some of the executives about. But particularly, this is a company that it comes back to their sales cloud, of course, and the marketing cloud that they're able to see revenues come in for. And then additionally, this rounds out their full fiscal year 2022 revenue came in at $26.49 billion. That was actually up 25% year over year. And so it's a larger question of what the expectation will be from some of the investors and analysts who cover this name and this stock, especially as when you look across the broader cloud space, it's a question of how much more penetration can they have in their existing portfolio clients as of right now.
Absolutely, Brad. And just diving a little bit deeper into what we saw from Nordstrom, because again, as we continue to track these earnings results and the post-earnings results stock changes that we're seeing for some of these companies, really seeing an outsized move here for this retailer. I mean, the stock's still up about 37.6%. And when we take a look at these numbers here, really strong beats across the board on both the top and bottom lines. Clearly a lot of optimism about that, especially since the stock had fallen by about, fallen for the year to date, really to the tune of about 13.6%. But taking a look at these numbers, we did have net sales for Nordstrom coming in at $4.4 billion, up about 23% over last year. That estimate had been for about $4.36 billion. Again, taking a look at the top line there. And then on the bottom line, earnings per share at $1.23, also ahead of expectations for just 99 cents. But that's going to do it for myself, Brad Smith, and Rochelle Akufo. Yahoo Finance Live kicks back off tomorrow at 9 a.m. Eastern. We'll be back on at 3 p.m. Eastern, so definitely tune in then. But until that time, have a great night.